growth expectations are low, at a time when policy is tightening in India and actually perhaps loosening in China. And so for us, it's less about where the money's coming from. It's just we know the money will chase the fundamental changes. And we've seen that in terms of India's underperformance. It's still a high growth market, but earnings have been coming under a little bit of pressure. The economy is slowing down, and the market has just been lagging as a result.
You were just pointing out the low-income trade, though, and that's just piqued some curiosity for me, because we haven't been talking about China being a low-income country and that being the trade. It's more this consumerism, the middle class in China, and even some of the luxury spend. So why the other end of the spectrum in China to play the trade?
I think if you look at the policy documents that were coming out in the middle of last year, high-level documents, there's very much an emphasis there on things like hukou reform, rural land reform. And I think we're at that stage now where, with the common prosperity push from, let's say, 5 years ago, the authorities recognise that the Gini coefficient, the gap between rich and poor or high income and low income, was pretty extreme. And so we have, I think, moving to the next phase of this, where the government's going to support those low-income groups through structural reform. And that's what the market's not really focused on today, but I think as the year evolves, that's where the opportunities are going to start to appear.
Andrew, for those who want to stay in the herd, who don't want to dip their toe in China, where's the best other country?
Well, the Federal Reserve is pretty influential in these markets. Yes. We've seen a lot of volatility on the back of US rate expectations. And in many ways, it's disappointing because there are other markets in Asia right now that fundamentally are doing very well, but a little bit hostage to the central bank, the Federal Reserve. The interesting thing is we did see the RBI cut today. We saw Bank Indonesia cut a couple of weeks ago, and there's almost an attempt to be a little bit independent, which we haven't seen. So that could be supportive. So from a country point of view, I think Southeast Asia still looks pretty good. And then from a sector point of view, if we are at a moment now where demand for AI services moves from upstream to downstream in everything we do with our day-to-day life, there's a lot of opportunity in Asia for companies to do pretty niche stuff, assembly, manufacturing, that are world leaders, and they've really suffered from a lack of a product cycle for many years now. Not a lot of innovation coming into our phones and laptops and PCs. There's a little bit of a burst from working from home, but it's been a long time since we've had innovation recreating pricing power for good companies. And that, again, I think this is an opportunity that's now emerging in Asia, is good companies starting to get their profit growth back on the back of innovation in AI.
Lovely. Thank you so much. Really learned a lot. Thank you. Andrew Swan, Head of Asia Equities at Man Group. And you can check out more from our Delivering Alpha series on CNBC's website. In the meantime, the Bank of England cut its key rate by 25 basis points, lowering it to 4.5%. All members of the MPC voted to reduce rates, but two of those voices called for a 50 basis point cut, including the former hawk, now a committed dove, Catherine Mann, and the former dove, who's still a dove, Swati Dhingra, underlining how serious some members see the UK's low growth problem. GDP is now expected to increase by 0.75% this year, half the previous estimate. The bank also warned it sees inflation peaking around 3.7%, with low growth and rising prices raising the prospect of stagflation for the UK economy. It also said it is keeping a close eye on US tariffs, warning more protectionism would have a negative impact on the world economy. Governor Andrew Bailey told me that whilst there are still uncertainties around tariffs, the effects will need to be monitored.
In terms of growth in the world economy, if this will lead to a fragmentation of the world economy, that is not good for growth, and we've made that point today in the report. The impact on inflation is more ambiguous because it depends upon what other countries do in response. It depends on what the consequences of those actions and reactions are for trade. To what extent does trade get redirected, and what effect does that have on the price of traded goods? And it also depends upon exchange rate movements as well.
Right, so that was Andrew Bailey talking to me yesterday. Fascinating day on the markets as well. I think the market got overly excited on the first two flashes. I don't think the algorithms looked deep enough into the NPR. I said so at the time when I came out of the BOE on back of the decision, having spent 2 hours looking at this. And I genuinely, I've said to you guys before, but this is, 75 pages long. It's the monetary policy report. And you can't possibly get the nuance of it by just looking at two flashes. The market saw cut, it saw Catherine Mann going dovish as well, and so then the gilts got bought up, the pound got sold off as well. And the fact of the matter is, that wasn't the message I got from spending 2 hours chatting to the wonks, chatting to the people at the Bank of England, reading the NPR as well. Yes, there is no doubt about it. There are enormous concerns about the UK economy, ergo the downgrade on growth. Yes, they think over the forecast period, which is a 3-year period in the NPR as well, they do see inflation getting down to 2%. But bumpy in the meantime. We're going to peak at 3.7% this year. How can you cut rates when you're not sure about the road there as well? That's why they're now talking about gradual and careful. They've added extra words in there as well. Plus the fact that the forecast period works on rates in the market as well. They also see a 4% level by the end of the forecast period for interest rates, which is way higher than the market wants to see as well. Bear in mind that's based on rates currently in the market.
You know, the challenges that the BOE is facing sound very similar to the ECB.
Oh, yeah.
The fact that you've got growth, really a concern for a lot of the governors. They're worried about the impacts here, but at the same time services, sticky services inflation, really standing in the way of more aggressive rate cuts. And if we talk about growth rate of less than 1% now for the UK, and that is even before potential tariff threats or threat of tariffs that could bring more uncertainty, that does cause some heartburn on what the growth story looks like. And I do wonder to what extent Catherine Mann's change, her U-turn here, has some impact on how Keir Starmer is thinking about the growth prospects for the UK.
Yeah, fun enough, you and I have talked about AWE, average weekly earnings, average weekly earnings, I beg your pardon, plus service sector as the two flies in the ointment, and that has absolutely been the case historically. This time around, it was actually the price increases in inflation are coming from two factors. One, higher energy costs across Europe. The second being the regulatory price rises from the regulators such as Ofgem as well. So they think it's going to not have, and this was the key point raising your issue there, not have second round effects, i.e. not going to future wage demands. And actually they see future wage demands, despite the spike we're seeing in the early part of the year, not actually carrying on at certain levels. So they are going to go down to a lower handle over the rest of the year.
Well, that's a sigh of relief, isn't it? Well, coming up on the show, we're going to talk more about earnings. Sales at L'Oreal disappoint with one key market underperforming. Charlotte will have the details.
Standard Chartered Global Private Bank, where your life's work lives.
We empower those who act, those who see the correlation between predictability and probability, those who manage risk by anticipating each movement, flawless execution, timing, and accuracy. Identify the goal, match power with precision, reach new heights. CME Group, where risk meets opportunity.
CNBC. Live ambitiously.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I've been thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
You don't do what Taylor Swift does without understanding how to build a business. It's not just about these songs that you hear on the radio.
Just the peak of all their powers right now.
That's a Taylor Swift effect.
The Swift Effect, this February on CNBC.
Kelly Evans, The Exchange, CNBC.
How this is a major surprise to anyone, but I'll go with the story. Shares in Porsche and Volkswagen seen lower in pre-market trade after holding company Porsche SE said it expects impairments in the luxury automaker to nearly double to between 2.5 billion and 3.5 billion euros, and impairments in Volkswagen to tend towards the top of the previously expected range of 20 billion euros. There's no one been watching this channel. It's like, come on. There are problems in the car industry and at Volkswagen. Quelle surprise, as they say in Germany.
I think some had hoped Porsche was in its own lane, that it wasn't being touched by the transition.
It's not Ferrari. None of them are. Do you know, I told you, I learnt my lesson. There's Ferrari and the rest. Lamborghini, Porsche, Aston, you name it. They ain't Ferrari in terms of how the market treats them.
You're not just saying this for Charlotte because Charlotte has
I'm
joined
not just
us on the
saying
set and she was just at the factory floor
how
in
I
Italy.
ate humble pie because I got the pricing of Ferrari over its IPO and subsequently completely and unambiguously wrong. People treat Ferrari differently.
How was the factory, the Ferrari factory?
It was fascinating. Yeah, it's really interesting. And you saw all the employees walk around with the red suit like the Formula One team, so it's quite impressive, you know.
It's almost like when you work at a ski resort and you get, say, a Moncler or a Helly Hansen or one of those little Prada jackets.
Wearing clothes in a ski
overalls.
resort compared to being at Maranello.
No, some of the staff get given really label clothing to wear for their job, so Ferrari jumpsuits.
But don't you think it's always a bit, I'm going to get so much trouble. I think it's always a bit sad when you haven't got a Ferrari but you wear a Ferrari cap, or you kind of like, or you wear the Ferrari t-shirt, or you have like the Ferrari keyring but you haven't got a Ferrari.
I have the feeling that a lot of people that have all these problems because they don't have a Ferrari.
It's like, yeah, have you seen my Ferrari keyring? It's like, you got the car? Nah.
You get the merchandise for free though, don't you, when you buy the car? That's the difference.
Do you?
I think so. For the top level customers, no doubt. You have a cap, you just bought the Ferrari, you have a cap.
I know the Ferrari
and
have
some
got cease
chocolates
and
too.
desist orders on the people who put in these ridiculous logos and transfers and what on the cars. They basically, if you try to adulterate the product, and there are a couple of social media influencers who put all kinds of, I was going to say a bad word, all kinds of nonsense like stickers on the cars, you know, these vinyls. Ferrari put out seek and desist because they don't want that rubbish on the cars.
Now, we've really steered off course. We're meant to be talking about bank numbers, and Banco Sabadell posted a 75% rise in fourth quarter net profit, boosted by its business in the UK. The Spanish lender reported 532 million euros in net profit in the period, ahead of expectations. For the full year, it reported a record profit of 1.8 billion euros. Speaking to CNBC this morning, the CEO, Cesar Gonzalez Bueno, commented on the bank's efforts to fend off takeover attempts from rival BBVA.
Mergers are good. If they are consolidation, even at national or cross-border, they are good. There's only one limit. When the value is not there and when the buyer is not paying what it should be paying, and second, when the concentration is so large that it creates so big execution risks. Everybody's against this transaction. 79 associations of entrepreneurs and business people have shown against. All the political parties, the trade unions, everyone is against. Why? Because Sabadell is providing services that are extremely relevant for the SMEs. We are the fourth largest bank in Spain, but we are key for the SME business. If we disappeared, the competition would suffer. And that is creating this phenomenal execution risk because it is the result of a social reaction to something that Spain does not want. And of course, as I said at the beginning, on top of that, they are not paying the price.
For more from our interview with the Banco Sabadell CEO, you can check out cnbc.com.
So L'Oréal shares are seen sharply lower this morning after fourth quarter sales missed expectations. Charlotte, again, we ask the same question time and time again. How many times can these companies sell off on China? Or is it just about China and it's the problem expanding?
Well, that's exactly the point there, Steve. Look, the engines for growth for L'Oréal was China, of course, as we know, but North America and luxury. That was the three elements that really had them see this extraordinary growth, particularly after the pandemic. And all these growth engines have basically stalling. And, you know, they said that they expected Q4 sales to be in line with Q3, so up 3.5%. And as you were saying, they came at 2.5%. So below what they had guided as well and below expectations. So North America up 1.4%. That was a big surprise because they're up more than 5% in Q3. So a big deceleration in that market. Also surprising because we've seen other luxury players do particularly well in North America for the ones that have reported for the fourth quarter. So it's a big surprise there. Now, in terms of the luxury division, actually North America did well for this one. They said that L'Oréal is now the #1 luxury beauty player for the first time in that market. But it's a division that has grown only 1%. It is the biggest division. They have the brands like Saint Laurent, Armani or Prada. but it hasn't done very well recently. So that's very interesting to see. North Asia, as we know, China difficult, but improving, down 3.5%. It was down 6.5% in the previous quarter, so things getting a bit better. Very interesting to see Europe doing actually well, resilient, up 5% in the fourth quarter. Say it was the largest contributor to growth this year. So very different dynamics from what we saw a few quarters back with L'Oréal. Dermatological beauty, again, one has been doing very well for them, much smaller, but doing well, like with La Roche-Posay or Vichy, up 5%. So there is a slowdown on that front as well. Some of their creams are a bit more expensive, less pretty bottles, but they look more like a medical one you buy in pharmacy. There's a bit of a slowdown on that front as well.
Yeah, I've been so puzzled by these numbers. If I'm puzzled, I start digging. I wonder whether we're seeing fragmentation in this big segment, because I went looking at Puig numbers recently. We were talking about Sephora, and the reality is that fragrance is still seeing some expansion. Makeup, I wonder whether we have too much makeup, whether there's been too much spending on makeup, and it's only innovative or really edgy products that are moving the needle on makeup. Skincare is still seen as an important market. So I wonder whether L'Oreal is in the right space and whether this is a makeup drag that we're seeing in the business.
Yeah, but they're making a push into fragrance. We know we'll get a conference call soon with the management, so we get more color whether they saw some growth or not. But they bought a stake in Amouage. You know, they make the fragrances from the Middle East, and so that they're pushing that segment. They've actually announced just this morning they have a beauty agreement with Jacquemus. We know it's a brand that's doing extremely well, very popular, really growing really fast. They made an agreement also with Miu Miu. So, you know, they are looking after some of those brands that are doing well at the moment to push particularly into the fragrance segment. We know that makeup for a lot of aspirational buyers has become the bridge to some of these brands. They can't afford bags anymore. The prices have gone up a lot. So beauty has been one of those bridges at the moment. And fragrances is growing, but as you're saying, makeup, well, it looks like for consumer products, you know, where they have Maybelline, for example, there was up 2.7% there, and that has been slowing down. Essentially, when we talk about North America, because one of the champions in the market was Estée Lauder, and we know they're facing huge difficulties as well in the market. They had a change of management recently. So there's some trends appearing in the different markets that are so different. There's such like a divergence in dynamics of those different markets. It is a new thing that we see appearing there.
It does seem like a crowded space, and to your point around the designers, you've got your Hermes, Gucci, Prada.
They all want to slice of the beauty market, absolutely.
Yeah. Charlotte, thank you very much. We're closely looking at the response in L'Oréal stock this morning. It's been a pivotal week in Europe. We've been pointing out that now the stock Strip 600 has outperformed the S&P 500 so far this year. In fact, double the pace. Who would have thought just weeks ago as we're talking about the strength of those U.S. markets and overweight U.S. assets. So as we gear up for trade this morning, we've got this in mind. It's been a fairly steady run, decent momentum taking us to record levels. So we've got a little bit of soggy action anticipated on some of these markets. The FTSE, CAC both seen slightly down, but it's some improvement now in DAX, which we're seeing tilting weaker as well. So we are looking forward to this open as we look to round out the trading week. We'll be back with the numbers shortly.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
When I did my master's, I was having a concentration in the area of artificial intelligence.
So you're secretly a tech geek?
I wouldn't call myself a geek, but I certainly am very interested in technology.
On the next Managing Asia, an exclusive interview with Singapore Airlines' Goh Chun Pong.
I think the most stressful time really during the pandemic was the initial period when we're trying to raise funds.
Looking back, would you have done anything differently?
More of my interview on the next Managing Asia.
Master the art of salary negotiation.
Everybody who walks into a salary negotiation is nervous.
Salary negotiations are really awkward.
The number one soft skill is flexibility,
Preparation.
Confidence.
Learn how to negotiate a higher salary with CNBC Make It's new online course.
I'm going to give you a roadmap for doing the hard work.
Because ultimately, if you don't fight for yourself, nobody else will.
Register right now at cnbcmakeit.com/salary.
Can't miss reporting that impacts your money now. Be here when the opening bell rings. Squawk on the street. CNBC.
Welcome to Squawk Box. It's 8 a.m. here in London, 9 a.m. CET, and stock markets across Europe are opening up for the Friday trade. It has been a very strong trading pattern here in Europe. We've climbed to fresh records on the last number of sessions, and it's individual markets too, pushing ahead from the UK market to Germany to Italy. So in that context, as we digested earnings and pushed the market higher, it looks as though we've got a bit of cooling off taking place for the start of this session. Just pulling back from the outset, again, very slim territory, down 0.1%. It's also non-farm payrolls day stateside. Typically, we can see a little bit of caution ahead of those numbers, Steve.
Yeah, absolutely. And look, you know, my excitement about non-farm payroll has gone down every single month for many years. But I wonder if this one's going to be that interesting. I've got to be honest, I don't want to douse the excitement for looking at CNBC US a little bit later on. But the fact of the matter is, the data as we've seen it this week on the jobs front, whether it's jobless claims yesterday, ADP the day before that, or JOLTS on Tuesday as well, the fact is they're all saying a similar message within a margin of error, that the US jobs market looks all right. Now, I know one could argue, looking at the JOLTS, there's less available jobs out there, but it's still historically a high level, i.e. over one, more jobs available than those who are looking for work as well. But the fact of the matter is, the numbers today on both the headline figure, average weekly earnings, and indeed participation rate, factors such as that, and indeed the headline unemployment rate, they're not going to move the needle too far away, I think, from where we think the interest rates are going to go forward. And that's the key read in from any of this data, but especially the payrolls, is what does it mean for interest rates going forward. But we're going to hear from Neil Kashkari later on CNBC programming. What have we got? Construction materials. I mean, that was probably the most bullish I've ever heard Skanska's Anders Danielsson as well. I thought he was really positive, but especially positive about the United States. I would be very surprised if Skanska isn't one of the names that are involved in that construction materials uptick there as well. Real estate also, again, we saw very, very positive data out from the Halifax in the United Kingdom. What does that mean for the house builders? 3% handle on growth at this stage where the economy is looking a bit dicky, underlying UK economy, that's not a bad figure as well. Retail moving mildly higher, and insurers just chipping in there amongst the gainers. Declining sectors look like this. Healthcare, 1% easier. Household goods, again, that might be the L'Oreal factor that Charlotte's talking about. She's giving me a little nod. Yeah, she thinks so too. Autos, that'll be the Porsche and Volkswagen story. I'll get Anessa for you on that one, or Karen will. And oil and gas, trading around the flat line as well. So there's a lot of different factors into this mix. What are the bourses doing in the round? Well, Karen said at the open they look pretty flat. And by and large, they do. Mild downtick for the London market, down 0.2 as well. How about Zurich? What's Zurich up to? What's Lisbon doing? What's Madrid? And Amsterdam looking like? We don't see many major deviation. Oh, BBVA, Sabadell story. What a great conversation we had with the CEO of Sabadell there. I wonder if that's the catalyst for the IBEX 35. But Karen's going to dig into some more granular detail for you.
I've got the stocks to show you, the big movers, and it is earnings driven. Skanska, as Steve was just pointing out, reporting this morning, and the response is strong. The stock up close to 5%. Danske Bank out with numbers. That's moved the stock almost 7%. So big drivers here as investors digest the fundamentals. We've seen it all week. That's been a catalyst for the stock strip. 600 exceptionalism. Why don't we call it European exceptionalism that we're seeing just this week? It may fade, it may not stick around, so we may as well use the phrase. What we've got in terms of the losers, let's look at the underperformers, because it is, again, its earnings here. Yara, we're talking to the company. It is down 5.8% on the numbers. L'Oreal as well slipping. That is a decent drop of 4%. And, of course, Saab too on its numbers. just moving into the underperformers. I want to get into Porsche. Holding company Porsche SE says it expects impairments in luxury automaker Porsche to nearly double to between 2.5 and 3.5 billion euros. And impairments in Volkswagen to tend towards the top of its previously expected range at 20 billion euros. Let's get out to Annette as we digest some of this big drop that we're seeing in Porsche AG of 7.7%. Annette, the market knows that there are issues around transition. They know that there are issues when it comes to the investment. Why is there such a big wake-up call today?
Because it's the profitability of the company, which is actually really at record low. The trimming of the margin outlook, I think it's crucial for investors because normally Porsche did always weather also economic storms because they kind of were insulated from demand being very firmly in that luxury space. But now it seems that the strategy to electrify the fleet and more or less have electrified vehicle going forward is no longer working out. So what they are doing now is to actually increase the production of combustion engines, to expand the offering when it comes to a traditional combustion engine, also with a new model. So I think what is spooking the markets as well is that they are saying that their revenue guidance for 2025 is also towards a shrinking of sales as such. That would be actually also a very new thing for Porsche because normally they have a constant growing sales volume year to year. So essentially the negative surprise, as I said before, comes from the margin, and it would be actually the lowest margin ever for Porsche since Oliver Blume took the helm of the company in 2015. So that tells you a little bit about the magnitude of the shock for the company. Of course, they can't change course completely during the 1 year, but what they now do is to really cut costs in order to improve profitability, and of course where they will expand their product offering, having hybrid versions and as well combustion engines going forward, Karen.
Annette, we do appreciate the commentary. Thank you very much for explaining that to us. I want to take you to what we're seeing out of L'Oreal because the stock had plunged late last year and then was on a slow rebuild to recapture some of that territory. But what we're seeing today, just taking some of that top off the stock and the action we've seen so far this year as L'Oreal's fourth quarter sales missed expectations, growing 2.5% on an organic basis, the slowest quarterly rise since the pandemic amid weak demand in China and a slowdown in North America. Full-year sales came in just shy of 48.5 billion euros, slightly higher though than analyst expectations. The stock down 3.6% but off close to 25% for the one-year basis. Charlotte, something is not going right. It feels like it's makeup, that it's just not positioned in the right space now.
Potentially, it's interesting to see in the share price there that little spike that we saw in January was because a lot of luxury players that had reported said that North America was showing some green shoots there, some luxury demand coming into play. But what we see there with these L'Oreal numbers is not quite the case, at least for the beauty market. We see North America up 1.4% in the fourth quarter. That was a big surprise and a big deceleration after the third quarter where they had a growth of more than 5% in that specific market. Of course, what we know that China, we're having a growth engine for L'Oreal for many years, has been difficult recently. It's still difficult out there. North Asia down 3.6%, but it's less bad than the previous quarter. So maybe things are starting to get a little bit better. They said that mainland China sales declined by low single digits for the full year. Europe has been resilient. The one market has been resilient for L'Oreal, up 5.2% in the quarter, and the largest contributor to growth this year, up more than 8%. But again, looking at the different divisions, the largest one is luxury, that the brands like Saint Laurent or Armani in that division, and it's been growing very fast just after the pandemic, and that has slowed down quite dramatically, up just 1% in the last quarter. It's a division that they continue to beef up. They had agreements with Miu Miu and Jacquemus that they announced just this morning. So they continue to add brands to that portfolio, but things seems to be slowing down on that front. Consumer product with Maybelline, for example, they're resilient, up 2.7%. And final division there, dermatological, one has been growing double digits after the pandemic, very aggressively with brands like La Roche-Posay or Vichy, slowing down, still growing, but up just 5% in the last quarter. So overall, results that were not as strong as expected, especially after other other luxury players had presented recently, but they said they still see that they will outgrow the beauty market in 25, that they will achieve another year of growth in sales and profit in 25. But the shares down right at the bottom of the CAC, down 3.8% this morning.
Charlotte, thank you very much. I think it's a terrific pivot from a company that has been so well loved in Europe for a long time to see it down 25% over the past year versus a stock in Spain. And don't forget, Spanish banks were not always the top pick for a lot of investors after the cleanup in property many, many years ago. But if you think about the consolidation attempts now, this stock has been up 112% over the past year, which is a stunning performance for a European bank. So I think as you get numbers today, investors are somewhat cautious after the share price appreciation. The latest here is that Banco Sabadell has posted a 75% rise in fourth quarter net profit, boosted by its business in the UK. The Spanish lender reported 532 million euros in net profit in the period. That was ahead of expectations. For the full year, it reported a record profit of 1.8 billion euros. Speaking to CNBC this morning, CEO Cesar Gonzalez Bueno commented on the bank's efforts to fend off a takeover from rival BBVA.
Mergers are good. If they are consolidation, even at national or cross-border, they are good. There's only one limit. When the value is not there and when the buyer is not paying what it should be paying, and second, when the concentration is so large that it creates so big execution risks. Everybody's against this transaction. 79 associations of entrepreneurs and business people have shown against. All the political parties, the trade unions, everyone is against. Why? Because Sabadell is providing services that are extremely relevant for the SMEs. We are the fourth largest bank in Spain, but we are key for the SME business. If we disappeared, the competition would suffer. And that is creating this phenomenal execution risk because it is the result of a social reaction to something that Spain does not want. And of course, as I said at the beginning, on top of that, they are not paying the price.
I want to move on to Skanska. Again, another fascinating company. It's spoken to us a lot over the years as it's battled various different cycles around commercial real estate. The latest story they're telling us today is around the AI infrastructure build-up, which is a compelling one. And you can see the stock price right towards the top of the StoxShip 600. This is the German listing, but still a boost in the stock today. Company beat on fourth quarter profit expectations amid what it says is a gradual recovery in residential and commercial property. The Swedish builder says it sees strength in the US market that will continue, and its outlook for the construction sector remains largely unchanged. Speaking to us this morning, CEO Anders Danielsson discussed the company's efforts to meet demand for tech innovation.
We're building a lot of data centers and for many repeated clients. So that's definitely one sector we are strong in. We have good teams in place and we are successful, and it's a good part of our order backlog as well.
US futures that look like this ahead of the payroll later on. Pretty flat stuff as well. Alex Brazier, who is the Global Head of Investment and Portfolio Solutions at BlackRock, joins us now. Alex, nice to see you.
Morning.
Look, I keep hearing people don't want to talk about the US. I keep hearing that actually we want to kind of focus more on other areas of the world. But just looking at your notes, when you've got the earnings growth and the firepower that's being directed at the market from these corporates, you keep coming back with solid beats on earnings and net income as well, and EPS as well. It's hard to look elsewhere.
Well, firstly, we have had tactical funds who moved at the end of last year towards Europe, basically on the basis of positioning and valuations, and that's worked out very, very well.
Yes.
But looking at the year as a whole ahead of us, we still like the US. I mean, it feels now, what are we on, 7th of Feb or something? Feels like 7th of December, so much has happened already. And actually, but looking through those 12 months, we've got earnings set reasonably fair. We've got a good beat rate, north of 60%. And in Europe, we've got clients who are typically underweight the US and underweight the tech theme, all looking to correct that because it's been a pretty costly underallocation for a number of years now. But here's the rub. It's not going to be plain sailing for the year as a whole. And I think January shows that pretty clearly. Within the tech space and within the broader index, it's going to be a market that demands a pretty sort of granular, precise approach and quite a high degree of nimbleness and activity as well.
So you've got two things going on. You've got your longer-term strategical view, and then you've got your shorter-term tactics as well. The latter takes you into market timing territory, which historically managers and the market are pretty average at, to say the least, as well. Do you feel confident tactically that there is a very clear trade between Europe and US at the moment, though?
Well, there has been.
Yeah.
And our tactical team have been
fading
well
that a little bit, done well out of that. Fading US.
But now looking ahead to the year as a whole, I think tech's an interesting one here. Yeah. And what we saw in early Jan is pretty interesting and shows you how even within a theme, the focus can shift pretty rapidly. So we look to our strategies for pretty active management of the AI theme. And you look at the DeepSeek news, talking to our tech investors on the West Coast who manage these strategies, it's got a number of interesting implications. It obviously raised questions about Mag 7 capex, but that's just the top level. The really interesting thing is really that actually the models are now less profitable, potentially. Non-frontier models have a less well-protected moat, as they say. But actually this opens up new possibilities for software and apps and still requires, as we just heard, massive infrastructure and compute build-out. So the theme rotates a bit. And then at the same time, and this has got less attention, is the nature of the frontier models is really shifting, which is going to change the nature of the compute power that's needed. So all of this kind of tells us that there's opportunities in the tech space for really granular, really nimble returns from just navigating that theme.
Great.
I mean, I've spent all week looking at it, and to me, Nvidia's come back into focus now because the hyperscalers are still spending, $250 billion for this year. So do you want to own the picks and shovels still because that spend is intact? Do you want to own the FANG Plus stocks because they think if they build it, they're going to see the growth down the track? Or do you want to move on a little bit to the other stocks that now haven't spent the money that can just extract DeepSeek values? So how do we think about those three pieces in the pie?
Well, I think it's going to shift through the year. And even in January, the focus has shifted from the model builders, and that was perceived to be where the moat was. Then we've seen huge flows in the US into exchange-traded products focused on software, which actually makes sense given the cost of production there is now so much lower. But also you've got to remember, and this is where the AI real expertise comes in, is this is all about non-frontier models. This is all about making non-frontier models more efficient. And history tells us that value is typically accrued to those who push the frontier out as well. So you need as much focus there on these frontier models as you do on how things are shaping up within the frontier.
There's still a missing equation here. Does it bring productivity gains? We haven't really tackled that for a while, and I've been talking to people using some of the models this week, and they've still got hallucinations in some of the models they're using. The technology is only useful if we can trust it and it's reliable. So what do we see on that front?
Yeah, we're at the very early stages, I think. Talking to investors around the BlackRock platform, it looks like the weight of opinion is that this will lead to some productivity increase over time, but it's highly uncertain where and how much. But I think this goes to how navigating the broader market also calls for a degree of kind of nimbleness here. We're going to see as the AI theme develops, as trade policy develops through the course of the year, we're pretty watchful of rotations in the market. And so we're actually looking to strategies that don't just manage that risk, but actually look to capitalize on it. And we've been developing sort of systematic strategies, signal-based, using AI, to actually try and grab the timing, as your point earlier, as we get those rotations, some of which will be about the application of AI, some sectors doing better than others.
We have to leave it there, I'm afraid. We've got the CEO of Saab waiting in the wings as well, but thank you very much indeed for joining us. I think you really get the message that the subtlety and digging into the weeds on AI is the only really way to play this nimbly at the moment. Alex, lovely to see you. Thank you very much indeed for your time. Alex Brazier, who is the Global Head of Investment and Portfolio Solutions at BlackRock. As I mentioned, coming up on the show, Saab shares actually having a decline this morning in early trade after fourth quarter results. We'll discuss why with the CEO, Mikhail Johnson, coming up next.
In a world of uncertainty and disruption, how will your investments stay resilient? We've been navigating change for 125 years, always looking forward, anticipating risks, and trusted to manage over $1 trillion in assets worldwide. solving for the needs of investors today and tomorrow. That's the power of Nuveen.
CNBC. Live ambitiously.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Frank Holland, Worldwide Exchange, CNBC.
Let's take a look at the decliners in the Stock 600, and very interesting seeing Saab sitting there down a couple of percent at the moment, 5% easier. Saab has lifted, though, its medium-term sales growth target, with the Swedish defence equipment makers saying that demand remains high. The results come as the war in Ukraine grides on, and the President, Mr. Trump, in the US, having floated requiring NATO members to lift defence spending potentially, and it's potentially, it's a bargaining position, let's be honest about it, to 5% of GDP. We're very privileged to have Michael Johansson with us now, CEO of Saab. Sir, thank you very much indeed for joining us. Look, we know for all the wrong reasons in many ways that the defence equipment spending is so prevalent at the moment as well. But just to explain to us why you believe the market is being a bit downbeat on your numbers today, sir.
Well, I don't really want to comment on sort of how the market sort of perceives our numbers, but I think we had a very strong year behind us. I mean, we grew like 23.4%, in the last quarter 29%. We have a very intensive sort of demand in the market. We increased our order intake with 24% last year, almost 100 billion, 97 billion. We continue to increase our profitability, but not compromising investments in increasing capacity and also research and development to embrace new technologies to be relevant in the future as well. And we generated a big cash flow in the fourth quarter now, leading to a solid cash flow position for the full year. So I think it was a very strong year and a strong quarter. That's what I can say.
Michael, I've known one or two things. I've known several people who've actually been up in your planes over the years, one who worked for the Swedish Air Force as well, and they are legendary, the Viggens, the Gripens, what have you. But I just want to ask you a question about the future of manned fighters as well, because it's such an important area for you as well. You will know better than anyone that Elon Musk called the F-35 builders idiots and actually believes that drone unmanned warfare in the air is the way forward as well. How do you respond to that?
Well, I think the direction is definitely in that, it's going in that direction. I think you will see unmanned, sophisticated capabilities doing man-unmanned teaming, so to say, in there. Over time, we will see more and more autonomous systems in there and sort of at sea level and sub-sea as well, definitely. But it will take a while before we sort of see completely autonomous systems everywhere, I think. But the direction will be in that direction, absolutely. More autonomous unmanned systems. But manned fighters will be relevant for a few decades to come, I would say.
And for those of you who don't know much about your business, of course, you're in submarines, you're in ground combat. You are, of course, famous for your fighters as well. How are the sales of the fighters looking overseas? Obviously, the Swedish Air Force is a great customer.
Well, we have a number of campaigns going. We're negotiating as we speak a contract in Thailand for the Gripen E, and we have the campaigns going in Colombia and Peru, and we are extending negotiations when it comes to Brazil. They will add sort of aircraft to their batches. So there is an intensive discussions in quite a few countries as we speak. But those are not the only big campaigns. We have the Global Eye, the airborne early warning aircraft as well, which have a number of campaigns going as well. Those are digital. It's hard to predict exactly in which quarter they will result in contracts. But of course, there is intensive discussions on these things as well in the market, not only advanced weapon systems and sensors and command and control and all that. So it's a mix of very intensive demand in the market.
Good morning, it's Karen jumping in. I was just struck by some of the comments that is in your statement today about the geopolitical security landscape is unusually uncertain. I think we all feel like that we're living through those times, but to hear it from a company like yours that's sort of really at the forefront of defence spending, but you're bringing forward that spending, trying to drive up capacity. What does that look like in terms of some of the constraints you're up against?
Well, I mean, we must sort of increase capacity, and I've said all the time that I'm not sure we're doing enough. So now we bring forward and increase our investment for capacity, specifically in areas like advanced weapon systems, support weapons, and sensors. That's really needed, and we need to have ammunition capabilities and stockpiles in Europe, and there's more needed, definitely. So for this company, it's good for the future, of course. That will put some pressure on the cash conversion in the period of 23 to 27. But we have also said that we will grow compounded annual growth rate over this period 18% instead of 15%. So it's good for the company, but we have to do what we need to do to make sure we can handle the demand which is out there. And we've taken another look at that from earlier, and we increase our pace. That's what we do. And also on R&D, of course, we need to embrace autonomous systems, as we talked about. We need to use AI agents in our systems, so we're doing a lot on that area as well. But the uncertainty is there from many sort of statements and what is happening with NATO now in the summit in Hague this summer. What will the ambition level be? Will it be 3%? That would mean a lot to many countries to sort of extend expenditure on defense spending of GDP to go in that direction. So the demand is high, definitely. That's what we see going forward.
I'm torn between asking you about the defence spending from the Europeans and AI, because you just made a fascinating AI comment there, so I really want to ask you about that. We know DeepSeek is really moving the needle on the market, what the Chinese are capable of here. How are you thinking about DeepSeek and what you need to do in terms of folding AI into your systems of the future?
Well, I mean, we don't really care about DeepSeek, and we have no relationships with China on sort of the AI or anything else for that sake when it comes to business on the defense side. We don't do anything with them. We're more looking into embracing AI technology with the excellent partnerships we have with Helsing in Europe, for example, which is a great AI company, and others. So the European sort of initiatives that we see coming will be important to us, and we are already using AI, of course. It would be impossible to digest all the information our systems are giving us from the sensor side if we didn't use AI to sort of present the situation awareness picture. But for us, it's more embracing it and making sure that we use it in a skillful way in our systems and products to quickly get to sort of situation awareness. That's what we're doing. But we're not using and have no relationship with China in this area.
Important clarity there. Can I ask you about the European spending then? Because what €1 billion is thought to be on the way from this European Defence Fund. What sort of slice of those funds do you want, and what does it do in terms of moving the needle on your research and development, and then, of course, production of key defence of the future?
Well, European Defence Fund is really important. I think, though, that we should spend more together. It's not enough. We have 32, I think, research programs going within the European Defence Funds in the different calls that's been tabled so far. But we need to spend more. Same thing for European Defence Industrial Programme. I saw that the heads of states in EU together with UK had a discussion this Monday on how do we do sort of collaborative ways of doing things together in the European context now. More money needs to be spent into doing things together in Europe. Either it's in the research area, European Defence Fund, or the European Defence Industrial Programme. So I really hope they will politically sort of decide to do more together going forward to create scale in Europe.
And just specifically, last time I bumped into Ulf Kristersson, had a word with him, was actually at the NATO summit in Washington, D.C., Michael. In your conversations with him, Is he putting the meat on the bones of buying more Gripens? I understand that the country has around about 80 serviceable Gripen CD fighters at the moment as well. But Sweden has promised to spend more money. Mr. Christensen keeps saying it. Are they going to spend it on Saab products?
I think we grow proportionally with sort of how the defense spending in Sweden is growing, so that's sort of a piece of the cake. Then there is of course possibilities to add more Gripenese to the Swedish sort of inventory, and also transforming from CD version to E version going forward. But those decisions have not been taken yet. But of course there will be a need for many fighters going forward. So I hope they will take decisions like that, and we have the possibility to support it, but they're not there yet. But in essence, we have a big cake of the Swedish defense spending, and when they spend more, we grow in that area as well.
Michael, thank you so much for joining us today. Michael Johansson with us, the CEO of Saab. Coming up on the show, L'Oreal misses on its fourth quarter sales expectations. We'll have more on this in the wider luxury sector right after the break.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
I started investing a little money for my dad, and I got bitten by the bug. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show, Squawk Box, CNBC.
A warm welcome. It should be the final half an hour of Squawk Box, but I went over, so it's about 25 minutes with Karen Cho, myself, Steve Sedgwick, and these are your headlines. L'Oreal misses quarterly sales forecast, with revenue rising at the slowest pace since the pandemic, and weakness in China, but also North America. The Spanish lender Sabadell announces a €1 billion buyback as it looks to fend off a hostile takeover from rival BBVA. The CEO tells CNBC his answer to the deal is a very clear no.
When the value is not there, and when the buyer is not paying what it should be paying, and second, when the concentration is so large that it creates so big execution risks. Everybody's against this transaction.
Porsche shares reverse in early trade after its biggest shareholder, the Porsche family holding company, warns of heavy impairments. And also Saab shares are easier, currently down 4.7% towards the bottom of the stock 600, despite the Swedish defense equipment maker flagging high demand. The CEO, Michael Johansson, telling Karen and myself defense spending needs to pick up.
We must sort of increase capacity, and I've said all the time that I'm not sure we're doing enough. So now we bring forward and increase our investment for capacities.
It's Friday and European stock markets are flatlining at this point. What we've seen over the course of the week, momentum enough to carry us towards record highs and outpace the S&P 500 so far for the year. But some of that enthusiasm just coming to a bit of a full stop, and it's more about the stocks in the overall market today that are still moving on earnings, some of the fundamentals that are coming to light. And for some, it's encouraging. We're seeing big moves to the upside in some of the earnings stocks, but also moves to the downside as a real reality check is set in that, in fact, some of these companies still face headwinds. And L'Oreal, I think, one of those stocks. Now, what you're seeing under the hood, if we take a look at the sectors, the movers to the upside today, we've got construction materials. Again, Skanska reported. There was a decent set of numbers, a company that's just spelt out its story around building AI data centers. So the market may have been focused on its commercial real estate portfolio and the challenges in REITs, but now it's, of course, building out data centers. So it's another play on the tech story that is moving the needle on that stock in the basket. Insurance names trading up modestly, utilities, food and beverage rounding out to the improvers. Now the weaker trades. Those right at the bottom today, we've got healthcare stocks. It's been a huge week for big pharma, so perhaps just a little bit of repositioning on that story. Don't forget Novo Nordisk, GSK, AstraZeneca all reported this week. Household goods, L'Oreal, it was disappointing today. No way to say that that was a good number, and you've got household goods as a result that, again, houses that stock that is seen as somewhat a safe haven play too on the sector, and it's been down this year, even that not shielding the stock price so far over the course of the trading session today. So we're down 0.5% there. Financial services, technology rounding up the weaker arms. Steve.
Great, Karen. Right, L'Oreal fourth quarter sales missed expectations, growing 2.5% on an organic basis. The slowest quarterly rise since the pandemic amid weak demand in China and a slowdown in North America. Full year sales came in just shy at 48.5 billion euros, slightly higher than analysts' expectations. We've got a great guest on fashion at the moment. Carol Maggio has joined us. I know you want to talk about Kering first.
Yeah, indeed. We're expecting results out of the French luxury giant Kering next week after the company announced the surprise departure of the chief designer of its biggest brand, Gucci. Well, Carol Maggio joins us, head of European luxury goods research at Barclays. Carol, a luxury reporter myself, who covered luxury for a long time too, saw this. And for me, it was no surprise because I thought that they would really struggle to push their quite luxury idea when it was everything about noisy luxury from the previous creative design, enough to create this Gucci effect in markets and put real energy into the luxury market. So you get a cyclical slowdown, you take out key customers like China, then you push overpriced items that's quite luxury. It seemed to me it was not the right strategy. Just talk to us about what you're seeing from the Gucci effect in Kering.
Yeah, true, that's right. It was maybe not a big surprise for many investors as well. I think I was just myself surprised by how fast it happened because, you know, the designer, the Sarno, just arrived in Jan 23, so 2 years ago. So his first collection in September 23, and of course you were seeing, I think, still having the rollout of the products in the stores as of end of last year. So it was, you know, quite fast, like to see him go that quickly after just, you know, a few, I guess, months of his item being in the stores quite fully. But yeah, to be fair, you know, it was not working. We have seen last year maybe the weakest performance of Gucci in a long time. You know, sales have been down in 24 by like 20%, if not more. And of course, you also have seen the margin come down drastically by close to 10 points on a year-over-year basis. So yes, something has to be done. And yet they make a quite a, I guess, fast decision to, you know, call it quits and like maybe go to a new clean path going forward.
The industry is being lazy and greedy. It's going to put it out there. I think the market is putting this down to some sort of cyclical slowdown that the Chinese customer isn't there. But the Chinese customer isn't stupid either. They don't like a whole heap of branded goods with, you know, monograms everywhere when they've already bought these products. This is what they did 10 years ago. And what we got served up from Gucci and some of the other designers is exactly the same thing. Branded goods that have come at a higher price. They're not stupid, and the industry is selling them these products that have put up by, what, 25 odd percent, 30%, and expecting the consumer to buy the goods. There's no innovation there. It is just, to me, lazy and greedy. So the industry needs to step up. Any sign that that's happening?
I see your point, yes. You know, I think lack of innovation, high pricing have been some big pushback, you know, against the companies we cover, like the likes of LVMH, Kering, Richemont, etc. So, of course, you know, we have seen as well, you know, with the macro becoming more challenging for the consumer base, them becoming more and more selective, notably in China. So now they're buying less, but buying better, and of course, focusing on just a few brands who I think fit their criteria of, you know, innovation, I guess being quite trendy. Like, let's say Miu Miu, for instance, is quite a popular brand right now, still in China. But yes, the company have to do a bit more. And I think we are seeing now maybe a few changes happening, across the space. Of course, change of designer, is a big thing, I guess the first way to start if you want to change your business. Of course, Gucci is an example. We saw Dior with the menswear designer leaving Kim Jones a few weeks ago. I think as well some change of the CEO level, like for instance at Burberry, which happened as well a few months ago. So I feel like the sector is now aware of all these issues and is trying to start, to have some solutions. But of course, it takes time, and you can't see like overnight some big impact on your numbers.
The market has been trying to find some safe harbors in luxury. And Richemont, I think, was really interesting because it was never really the standout performer, but its numbers suggested that it was having some success in selling its jewellery and timepieces. So that was a standout. I think makeup's been another area where in recent years you've seen support, but that's come unstuck a little bit with L'Oreal today. What do you make of the safe harbour now, areas that you still like in the luxury business?
Yeah, it's interesting. I really feel like, when you look at the past few months, so last year, 24, the companies who have been really outperforming are the one which is, I think, maybe more exposed to the higher end consumer base. So of course, jewelry has, I think, a higher pricing point to start with versus handbags. So yeah, the likes of Richemont, who has brands like Cartier and Van Cleef & Arpels, have been quite strong over the past few quarters. And I think even more so in the last quarter, so Q4, where they saw a growth, in their core division, jewelry of plus 14%, being up plus 4% the quarter before. So a strong improvement on a quarter-to-quarter basis. So I think these names also like Hermes, who is of course also at the higher end of the pyramid, have also been quite strong, and we expect them to also be up double digits in the fourth quarter, which they report next week. So I think it's definitely
Sorry, Carol. Great board on the screen. We'll keep on that if we can. Second, Roger. Just looking at the Hermes LVMH spread, which is just, great trading pair for many people in the market as well. Has it moved too far out of kilter? As much as Hermes is a quality, amazing company, is the LVMH price just looking compelling compared with Hermes?
Well, we also are overweight on LVMH, and I feel like now we have been, of course, seeing a really defensive space in the sector last year because there was a really tough macro environment, but we could be seeing a rebound, at least a small rebound in the sector in 25, which of course could make names like LVMH also get better because it's a sector proxy. So if the sector gets better, LVMH also gets better in my view. So I feel like, yes, maybe these kind of names like LVMH could see maybe a bigger upside versus the Hermes, who have been very strong already in the year ahead.
Carol, let's go down the road on the M&A wild goose chase that so many people do in this sector as well. Are there any real names that are firmly in the firing line rather than the perennial names like the Burberrys of this world that we just keep talking about?
It's a tough question. It's hard to answer. I think we always have the same kind of debate, same rumors coming on, like as you mentioned, like Burberry's, LVMH, like doing a few things across the space as well, but nothing concrete, I think, is happening right now.
Can I ask a somewhat technical question? If you look at where the luxury names are embedded in ETFs, it's not widespread. For instance, you'd think Kering would be in some of the luxury ETFs, but it's not. And I wonder whether this is why you constantly see an underperformance in some of the luxury names. I mean, LVMH is pretty much in just about every ETF that's like some sort of growth or luxury name. It's very much there. The likes of Ferrari is in there. I mean, so it's not purely household goods, is it? Hermes is in there. So is that one of the technical issues as to why you see some luxury names that move more aggressively? I mean, Burberry's not in there, for instance. So is that one of the features that people who are investing in luxury need to be mindful of? What stocks are in ETFs?
It could be, but we have, to be honest, quite limited debate around that kind of factor. I think the kind of key issue we really see around, the Kerings or the Burberry is those brands are kind of recovery stories, in phase of transition. And right now, this kind of, theme is not working well enough in the luxury space. So you kind of, want to go back, as you mentioned, to your safe haven, the Hermes, the Richemont, and of course maybe the LVMH because they are so big. They're also a bit more diversified. But names like, a Kering or a Burberry, I think a bit more risky right now to play. And so people don't want to, I think, be too much exposed at this stage.
Really interesting. Thank you so much. I just love listening to you two talking about this as well. Thank you, Carol.
Yeah, pleasure.
Lovely to see you and have a wonderful weekend.
You
Carol
too.
Maggio, who is the head of European Luxury Goods Research over at Barclays. Right, some more M&A activity in the banking sector in Italy. The Italian lender BPER used to be called Banca Popolare dell'Emilia Romagna, which I prefer still.
You've been dying to say that for years, haven't you?
I really have. Shall I say it again?
Yeah.
Banca Popolare dell'Emilia Romagna. Oh, just rolls off the tongue. I'm virtually Italian. Anyway, it's launched a 4.3 billion euro bid for Banca Popolare di Sondrio. Yes, with BPR CEO Gianni Franco Papa describing a merger as a perfect fit. Now, the offer represents an almost 8% premium to Sondrio's closing level on Thursday. With BPER's offer comes amid a wave, though, of consolidation in the Italian banking sector led by Unicredit, which is trying to buy Banco BPM.
It's a low bar to becoming Italian, isn't it? You just need to dabble with an app, eat a bit of pizza and pasta, and you're there.
No, not at all. I can only dream of being able to speak Italian. I'm going to say it. I think it's the most beautiful language on the planet.
It's beautiful, isn't it?
As much as I love my French and Spanish friends.
And the food's right up there too, isn't it?
Yes.
I didn't even mention tiramisu. Coming up on the show, Amazon posts a top and bottom line beat, but looks on track for a down day on Wall Street. The details next.
The message for women and for everyone is what my mother taught me. Fear is not an option, and never be a victim, no matter what happens. We don't choose our destiny, but what we can choose is how we navigate this destiny. The mission statement of the awards were inspired by what my mother showed, which was the courage to fight, the strength to survive, and the leadership to inspire. And I think that says it all. It's about getting the award, being able to use the money for your organization. It's getting visibility. You can then go back to your community and people will take you more seriously, and it means a lot. And then connection. You meet people, you talk to people, and then miracles happen.
When you think about Singapore, it has become an innovation role model. A lot of multinational companies that have grown up here are a wonderful set of partners for companies coming in who then want to grow in the rest of Southeast Asia.
Scott Wapner from the NYSE. Closing bell, CNBC.
So excited. Arjun's here as well. Hi Arjun, how are you?
I'm good, Steve.
So excited. There is a massive global sporting event this weekend with an oval ball. Yeah? An oval ball, you know, the main sport with an oval ball. And it's England-France in the Six Nations. Can you believe it?
Unbelievable.
Yeah, I know.
Is Taylor Swift turning up there too?
I don't think so. I don't think she's going to the Allianz, formerly known as Twickenham, as well. Oh, come on, let me be honest. It's a Super Bowl as well, apparently. The sporting world will be training its eyes on New Orleans for the Super Bowl this weekend. President Trump is set to be among the attendees as the reigning champions, the Kansas City Chiefs, take on the Philadelphia Eagles. I'm told by our floor manager, Hava, who knows a thing or two about this, that the Kansas City Chiefs could have a three-peat, which means 3 in a row. And their star players are something called a tight end. Sounds awkward. Travis Kelce, who is the partner of T. Swift.
Most famous boyfriend in the world.
The QB, which is kind of like this, the centre forward, is Patrick Mahomes, who also, I understand, is mildly famous.
Isn't it all about the halftime show? That's what everyone
Who's
chooses.
this?
Kendrick Lamar.
Kendrick
Lamar?
Lamar.
Rapper Kendrick Lamar.
Wow.
Fresh off his beef with Drake.
Sometimes there's been wardrobe malfunctions and things over the years, hasn't there? And all kind of,
Can I ask, what's the most distracting element here, Trump or Taylor Swift? I mean, Trump, first president to turn up to Super Bowl, and of course, don't overshadow her boyfriend, Taylor Swift. Who's more disruptive?
I think, well, I'm pretty sure, if I remember correctly, wasn't it all the cat lady jibes kind of thing from the VP? about... So, yeah, you don't want them two meeting, do you? No. Woo! A record $1.3 billion of bets are expected to be... Only gamble what you can afford, ladies and gentlemen. $1.3 billion of bets are expected to be placed on the game through legal and regulated operators in the UK, according to the American Gaming Association. CNBC's Contessa Brewer has more.
$1.39 billion. That's the estimate of how much Americans will wager on the nation's legal licensed sportsbooks, according to the American Gaming Association. But last year, their estimate was a total of more than $23 billion, because last year's estimate included office pools, illegal bookies, and offshore operators. All that competition, and this year, you also have Kalshi and Crypto.com crowding their way in. Robinhood tried and just this week ditched its effort to accept trades through the predictions markets. Very controversial. And then there's sweepstakes-style gambling and offshore markets that all offer bettors a way to add some excitement to the big game. But what the sportsbooks here really want is not to compete with those operators that haven't paid state taxes, haven't paid billions to lobby, legalize, and license their platforms, that may not even adhere to know your customer regulations, and certainly don't face the same level of backlash with regulators over concerns of problem gambling. Derek Stevens owns Circa Sports in Las Vegas, and he told me, look, it doesn't really make a lot of sense to pay tens of millions of dollars in taxes and fees as a licensee if a legal business model exists without all that expense. That would be the predictions markets. I asked Kansas City Chiefs quarterback Patrick Mahomes whether the boom in gambling is good for the game of football.
It gets people watching. I think that's good for the sport. But at the end of the day, I want people to realize that it's a game that you play on the playground for recess. And it's stuff that you just go out there and give everything you love. And I think that's what we try to do on the football field. And I think that's everybody on that football field.
Around New Orleans, FanDuel has big advertising blanketing the buildings. Caesars has named the Superdome and is unveiling a nearly $500 million renovation in its casino and sportsbook here. All of this for one of the best opportunities all year for customer acquisition. As it stands now in the Chiefs versus Eagles, the Chiefs are 1.5-point favorites. In New Orleans, I'm Contessa Brewer, CNBC Business News.
Sorry, this isn't me who wrote this. There is a pun, apparently, I have to say, according to the team here. Taylor Swift, obviously, her partner, Kansas City Chiefs. Her father is a Philadelphia Eagles fan. So apparently, wait for it, there'll be bad blood between them on this.
Boom, boom.
Wow. Also,
that only works if you understand that she did a song called Bad Blood.
Yeah. You can do some weird bets as well, apparently.
Go on and give us a weird bet.
If you fancy the Chiefs to win and Kelsey then to propose to Swift after the game, you can find odds at 11-1.
That's rubbish odds.
That is rubbish odds.
That's rubbish odds. That's an accumulator. Anyway, not that I would gamble at all anyway. Amazon, apparently.
There's a link here, actually, to Super Bowl and Amazon. So they're actually using a lot of AI-powered analytics for viewers who are punting on the game, but also impact on Amazon sales, Prime Video as well. So real links here between Super Bowl and Amazon. And don't forget the shares down in after hours, despite a beat on the top and bottom line in the fourth quarter. It followed softer than expected guidance for Q1 with Forex effects, including a stronger dollar projected to deliver $2.1 billion in revenue hit. Now, the company projected around $100 billion in capex in the coming year as it continues to ramp up AI spending, as well as forecasts from Microsoft, Alphabet, Meta this earnings season. So I think the point I'm just making here around the use of AI, if Amazon can demonstrate a compelling case for all of the AI investments so far and all of the AI investments in future, then investors might take a different tone from what we're seeing in after hours.
Yeah, there's two parts, I guess, to the Amazon AI story. The one that's sort of, I guess, underspoken about is really AI on Amazon's products when you're using the app or the website. You know, we could probably expect that experience to become a lot more personalized in terms of being able to predict what you might want to buy, etc. Actually, this is something the Chinese e-commerce companies have done very well, the likes of AliExpress and Temu, etc. The other side, of course, and this is really the profit driver for Amazon, is around AWS. And we heard about that $100 billion capex spend this year. AWS is really where Amazon, I think, is going to make the biggest impact if it does in AI. Market wants to see continued growth in this, driven by that. And that, remember, Amazon is the biggest cloud player in the world, ahead of Microsoft, ahead of Google. And so perhaps that $100 billion capex spend, which is higher than the others, matches that perception.
I don't disagree with you about AWS, but let's just think about some of the basics here. Meta, leaning into AI so it can sell more ads and do a better job at it. Amazon, it's in that space as well. It sells more ads, drives up the advertising business, which actually was a bit of a standout in the numbers, but also retail. If it's successful at driving that advertising, the advertising converts to sales on the Amazon platform, double bang for the buck, isn't it? And retail, I mean, stronger sales growth of what, fairly decent amount over the course of the quarter.
Yeah, I think the key for the retail business has always been one of those interesting things where AWS has really provided the profitability for Amazon to support what has been a very cutthroat business in retail, being able to do Prime, sell products slightly cheaper and support those third-party sellers. I think the key is, will AI help to drive profitability in the e-commerce side of the business further? And I think that it's going to be very key. You know, Amazon remains a very, very strong position in e-commerce globally. And so, you know, will the AI recommendations, etc., help to make more efficiencies and really be able to drive profitability, I think is key.
What do we know about this? We know that AI helps supply chains.
Yeah.
Amazon is a big supply chain, right? If it can drive more adoption or more purchases of products, and we're just seeing even from the Super Bowl ads, so they're using AI for the Super Bowl ads, that has driven a noticeable spike in Amazon sales. Yeah. If it gets that link through the business, then that retail number up 7% in the quarter could be stronger.
And I do think, you know, that is actually very much an underappreciated story at the moment. We obviously focus so much on AWS, but that side of the equation is key, as well as the ad business, which continues to grow very, very strongly.
Lovely. That is it for the Squawk Box show for the week. 15 hours, almost done. Thank you very much indeed, Arjun, for being such an integral part of our coverage. Attention, of course, will now be on the US non-farm payrolls later today. Do you want to talk through the numbers quickly? 170,000 jobs created expected, 4.1% unemployment rate, average hourly earnings seen up 0.3 of 1% month on month. Have a look at revisions for previous months as well. A little bit of interest around that. Unemployment seen to remain very stable. Minneapolis Fed President Neil Kashkari will come and talk to CNBC. That's after the announcement, almost immediately after it, actually. Look at that, 13:40 GMT. From Karen and myself and the magnificent team of producers, directors and everyone else who puts together Squawk Box, thank you very much indeed for watching. We'll see you next week.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
CNBC. Live ambitiously.
RFK Jr. has a good shot to be our health secretary, and that's pretty much the only shot he has.
Jimmy has Bill Gates with
I could jump it. I could jump it.
plus Lauren Graham.
Thank you.
And Japanese breakfast this weekend.
Dyson is known for its home appliances, but the company is looking to take that one step further. And all that work starts at its research lab managed by Dyson's robotics research manager.
This setup that we have here has been set up by our capable robot learning engineer. What he's going to show you is how the robotic arm understand the scene, make sense of it, and perform the task of tidying.
The robot has 2 cameras that visually map the scene, and then it decides how it will execute an instruction.
He already provided the demonstrations, and now he's going to give them text prompt instructions to say, okay, now open the drawer.
You think opening just one drawer is simple task, but it's actually pretty complicated when you think about it.
Yeah, it's difficult for my son to do it as well.
I love how this is equatable to your 4-year-old son.
Everything we do is for the consumer at home.
We are seeing more agility in many other territories than the European one. Luckily, the good news is that I think not only we in the foundation, but I think in general in Europe, people have woken up to that.
The 27 different countries, even my home country, Germany, they're way too small to have that seat on the table. And that's, I think, what the European Union missed out on, to have a joint foreign economic policy and say, look, these are the standards, those are the rules, we want to engage together for the greater good of the world. And that's missing, so that basically means that they need to get their act together quickly.
Europe is lagging in growth. The UK is ahead compared to Europe, still not as strong as the United States. But both these economies can use growth. And part of getting that growth is to unleash the capitalist instincts and what we call animal spirits into their economies, which means a better balance between regulation and opportunity.
Live from the New York Stock Exchange, Halftime Report, CNBC.
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. My ambition starting out was to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You'll learn a lot here at CNBC. It's also a lot of fun.
Good morning, everyone. Welcome to Street Times. I'm Sylvia Mardo with your headlines. Amazon shares under pressure in pre-market after the tech giant issues disappointing guidance for the quarter, but doubles down on its capex plans, with spending set to hit $100 billion this year.
When AWS is expanding its capex, particularly in what we think is one of these once-in-a-lifetime type of business opportunities like AI represents, I think it's actually quite a good sign.
The Stock 600 struggles to build on its record high, but European equities looking to cap an otherwise strong week as investors shrug off tariff threats. L'Oreal misses quarterly sales forecasts, with revenue rising at the slowest pace since the pandemic amid weakness in China and North America. And attention turns to the January jobs report, with markets expecting a modest slowdown in jobs growth, keeping the Federal Reserve in wait-and-see mode. Good morning, everyone. Happy Friday to you all. We start today's show looking at the latest in terms of what Amazon has reported. Their shares are down in pre-market, despite a beat on the top and bottom line in the fourth quarter. Now, that followed softer than expected guidance for the first quarter, with Forex effects, including a stronger dollar projected to deliver a $2.1 billion revenue hit. The company also projected around $100 billion in capex in the coming year, as it continues to ramp up AI spending well ahead of forecasts from Microsoft, Alphabet, and Meta this earnings season. Speaking to analysts, the CEO, Andy Jassy, defended that AI spending.
We don't procure it unless we see significant signals of demand. And so when AWS is expanding its capex, particularly in what we think is one of these once-in-a-lifetime type of business opportunities like AI represents, I think it's actually quite a good sign, medium to long term, for the AWS business.
And as always, our very own Arjun Kapal has more on the story. Arjun, it seems that perhaps this $100 billion figure wouldn't have mattered so much if we were talking about it like a month ago. Essentially, has the developments from DeepSeek changed the narrative here for AI spending in America?
It has and it hasn't, in the sense that there's two sides of the debate playing out in the tech world at the moment, and through all of these tech earnings we've heard the same thing. One is that DeepSeek has shown efficiencies and is able to create a very efficient AI model, perhaps on slightly older NVIDIA chips, and therefore the argument goes, why do we need to keep spending more and more and more on infrastructure? That's one side of the debate. The second side, and this is very much where Amazon and where the other tech giants we've heard from this week have spun a similar line, and that is, well, if efficiencies are happening in AI and the cost goes down, actually the technology will become more ubiquitous, more used, and further adopted, and therefore we will need more computing infrastructure. And that's really the side that Andy Jassy sits on, and Amazon and Microsoft and Alphabet we heard as well over the past few days. And I think what was interesting is Jassy's comments about DeepSeek were exactly to that. But I thought he did a very good job, perhaps versus some of the other companies we've heard from so far, in justifying that CapEx spend, because I think the stock would have been down a lot more than it was if the market wasn't happy with that. You know, he said this, as you heard from the soundbite there, a once-in-a-lifetime opportunity. And it's important to put this in context. Yes, the $100 billion figure is more than Microsoft has committed and more than Alphabet has committed, but Amazon also is the biggest cloud player in the world. And so, you know, it kind of, you know, reasons. There's different needs. And we have heard also on the call that there are supply constraints around the availability of chips, and that this CapEx number is really a response to demand. So I think the market was probably okay with it, or you definitely would have seen that stock down further.
Well, let's see what will happen. It feels like we are about to start, or we have started a new chapter here in terms of AI spending and AI discussions, particularly after DeepSeek. Arjun, thanks for that. Meantime, I want to take you to U.S. futures, understand how we're likely to open on Wall Street. At this stage, however, they point to basically a flat start to the trading day, probably because investors will be awaiting the latest non-farm payroll figure, so we could lack some direction in U.S. equities before we get that figure. For context here, however, when you think about Wall Street yesterday, the session was a little bit mixed, really. We had the S&P and the Nasdaq posting their third straight positive session, but looking at the Dow, we ended the session down about almost 0.3%. So let's see what will happen later today and how investors will react, particularly to the non-farm payroll figure. I want to bring you back to Europe and show you how we're moving so far this morning across equity markets. Look at the Stoxx 600. We are flat at this stage. We are lacking also direction here in Europe, with investors perhaps taking a little bit of a breather, really, after such an eventful week. If you remember, we started the week with the U.S. announcing tariffs on Canada, Mexico, and China. Then the tariffs on Canada and Mexico were put on hold for 30 days. China then ended up responding to these U.S. tariffs. And indeed, the investors at this stage trying to understand what's going to happen here, whether all of these tariffs in the end are just a negotiating power move. Let me take you to the different bourses, because there's been some interesting developments, however. We know today, when you think about the fact that investors seem to be lacking a little bit of a strong direction in terms of moves, it's all about earnings. Investors are very much focused on what European companies are saying at this stage. But I want to look at the different bourses. At this stage, we have the Extra DAX and the CAC 100 just marginally positive. Thinking about the FTSE 100, we're down about 0.2%. But here's what I want to show you. Let me show you the week-to-date performance. It's an important moment to do that. It is Friday. It's always a good moment to assess what's been happening. So despite all of these changes in the geopolitical scene, all of the back and forth in terms of tariffs, we are on track to see European markets ending the week higher. Look at the FTSE MIB. It could end the week up almost 1.8%. The Extra DAX over in Germany could end the week up about 0.8%. Perhaps even more importantly, let me show you the year-to-date figures. And I know this February, I know we haven't traded for that long so far into 2025, but look at these figures. We had so much enthusiasm for U.S. equities at the back end of last year, so much talk about American exceptionalism, but look at how European equities have performed year-to-date. On track to see the FTSE 100 up almost 7%, in Germany, the main market up 10%. We have seen particular strength over here in UK as well as over in Germany. Let's see whether that will continue for the rest of the year. But no doubt that these are important figures to keep in mind as you think about European stock performances as well. Now, as I mentioned, this was a week that kicked off with President Donald Trump's weekend trade war declaration on Mexico, Canada, and China. The decision by Trump to impose tariffs on America's neighbors initially led to a sharp pullback in equities and fueled a dollar rally. But on Monday, Trump agreed to pause tariffs on Mexico and Canada for 30 days, giving investors some respite. But he pushed ahead with tariffs on China, provoking Beijing to hit back with its own restrictions targeting U.S. energy in particular. Now, as we approach the end of the week, the immediate trade risk has receded, but the threat of tariffs still looms, with some seeing Europe as potentially in the crosshairs. So let's discuss this with our next guest. Dominic Bunning, head of G10 FX strategy at Nomura International, is joining us today. Good to have you on the show.
Morning, Sylvia. Thanks.
So I want to take a step back. I want to understand, how do you trade currencies amid all of this volatility, this back and forth in terms of tariffs? What is the approach?
Yeah, I think it's a really good question, actually, because I can see people in the market getting really sort of chopped around, and you kind of rush in when tariffs like they're coming on, and then you rush out again. So there's been a lot of this sort of volatility and choppiness. For us, the way we're thinking about it is really to take a step back and say, look, where do we think this currency should be trading if there was no tariff threat whatsoever? You know, if we kind of look at some of the other fundamentals that normally drive currencies, interest rate differentials, commodity prices, growth momentum, inflation, all these things, and we kind of look at that and say, well, this would maybe suggest euro-dollar, for example, if there was no tariff risk, euro-dollar might be at 105, 105.50, that kind of area. We're obviously trading a bit below that. We're 103.50 or so, which is kind of implying the market says, you know, there's like a 5% tariff maybe out there. So really what you then have to do is say, well, look, what's our conviction? Are tariffs coming or are they not? And if you think they're coming, which we do for Europe, we think the rest of the world tariff is going to come, then any chance you get on a move up to 104.50, 105, you should be selling euro-dollar. And actually, but when you get down to, you know, 102, 101.50, that probably is the point at which all of those tariff risks are kind of encapsulated. So it isn't easy, and it is, you know, hard to kind of figure out exactly where you are in that, and it's a bit of a guesswork sort of game. But I think as long as you've got that framework for thinking about it, then I think you can navigate these things. The other thing, of course, is you can just try to avoid the dollar risk and play some of the crosses, which is also what we've been doing.
I want to talk about dollar, but before we get there, I want to pick up on something you said in terms of expecting tariffs on European economies too. At this stage, we don't have that detail. We don't know whether the U.S. is actually going to go ahead with that. But they have announced tariffs on China. There's a school of thought suggesting that Chinese goods will flood into the European market. So with the information that you have at the moment, do you see these tariffs thus far being inflationary or disinflationary for the European bloc?
Look, I think at the margin for us, the tariff risk is probably a little bit more on the disinflationary side. I think both in terms of the impact it has on European growth and some of that sort of import flow and the kind of negative price impact there. So, you know, when we think about Europe, the overall balance of risks in terms of tariffs coming in, I do think it's probably a bit more of a negative for Europe, and that's why we see it weighing on the euro and why people are looking to sell euro on those rallies.
What is the outlook for the euro then? What do you think is the range by the end of this year?
Yeah, no, it's actually interesting. We've been amongst, we've been bullish on the dollar since, obviously since the election. But I think we've been a little bit more cautious about just how far it needs to move, how much of an adjustment is needed before things start to stabilise. So we still don't really think euro-dollar needs to trade below parity, certainly not for any prolonged period of time. Okay. We've kind of got euro-dollar going to around 101, stabilising around there. And then possibly in the back end of the year, you might start to see, a bit of a pickup. And there's also other potentially positive risks right in Europe, which aren't really being focused on. Like what if we start to see progress towards a ceasefire in Ukraine? That's probably going to be more positive for sentiment in Europe. So, look, the outlook for Europe is clearly not great. But I think one of the issues is that everyone knows it's not great. It's fairly well priced in. You don't speak to many people in the market who've got a positive view on Europe, and therefore the hurdle to a positive surprise in Europe is probably a bit lower than the hurdle to a bigger negative surprise. So I do think there's that kind of interesting skew at the moment in euro-dollar, which you just need to be aware of, even if you keep a core view of being long dollars.
Interesting. Let's go back to the dollar, focus specifically on the greenback. I mean, the main narrative has been that we'll just inevitably see a stronger dollar. But how strong do you think the dollar could actually get? Because so far what we have witnessed from a tariff point of view is this back and forth. We don't actually know whether these tariffs will ultimately be implemented.
Yeah, and I think just to talk about the tariffs briefly, to me, we shouldn't get confused at the moment by what's happened in the last week and just assume tariffs aren't coming. I think that would be slightly naive. There are really three objectives that I would think about in tariffs. One is what we've seen. It's kind of saying, look, we want to deal with something else, so we're going to use tariffs as a threat. That's fine. But there are other longer-term objectives. One is, trying to fix the trade deficit, and the other is to raise revenue. And I think if you look at a lot of the more ideological kind of viewpoints that have come through from people who are going to be in Trump's administration, those two things are important. And they're not going to come through that quickly, maybe. We're going to get this report on the 1st of April, or a number of reports on the 1st of April, looking at some of these unfair trade practices and whatever else it is. So I think that point you could start to see those tariffs come through. And, in terms of what it means for the dollar, it probably does mean potentially another 3, 4, 5% upside in the dollar against various crosses. The things that might constrain that rally in the dollar are, one, positioning is relatively long dollars. It's a fairly well-subscribed view. Valuations are quite rich. They are quite stretched when you look at a multi-year horizon. And when you look at some of the other objectives of the administration, Scott Bessent been talking about trying to bring 10-year yields down, or 10-year yields coming down naturally as a consequence of some of the other policies. Well, that acts as a bit of an offset. If you think about dollar yen, for example, very closely related to what happens with US 10-year yields. So if the administration's successful in actually getting 10-year yields to come down, that would act as a bit of a counterpoint to some of that dollar strength.
Interesting. Now, one of the approaches you mentioned was that you're shying away from the dollar to some extent. You're looking at other currencies as alternatives here. So my question to you is actually whether the hegemony of the US dollar to some extent is in a little bit of risk, as countries might seek other currencies, other alternatives, given this uncertainty and the volatility from the Trump administration, really.
Yeah, I think there's two ways to think about that. So for me, the kind of broader view of we're not going to trade using the dollar, I think that's a little bit overblown. I think there's a natural drift where the dollar is not going to be as predominant as a global reserve currency, but it's a very, very slow drift. It doesn't really matter for day-to-day trading decisions. But I think from that shorter-term perspective, you can strip out a bit of the volatility of being purely exposed to that headline risk and say, well, look, which currencies either face a similar tariff risk, but where there's other fundamentals that are misaligned, or which ones have some asymmetry. So, for example, we favour being short sterling and long yen at the moment, because neither of those economies are that exposed to the tariff risk in our view, but we think that the monetary policy story is going to continue to shift, where you might start to see bigger risks of the Bank of England being more dovish, where the BOJ, we think, can continue to push on. And that isn't really fully factored into the pricing as we see it. So we favour short sterling yen as an example of that.
Interesting. Well, let's see how things will evolve. But Dominic, great to chat with you. Thanks for coming on. Dominic Bunning, head of G10 FX strategy at Nomura International. And coming up on the show, private markets are looking to bounce back after a tricky 2024. We'll discuss the outlook for private equity with Sunaina Sia Aldea after this break.
Elevate your portfolio with JP Morgan's Equity Premium Income ETFs. Now with more flavors, global equities, US equities, and technology stocks. Discover now. Search JP Morgan Income ETFs.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
Diane von Furstenberg's name is synonymous with the wrap dress. This iconic piece of fashion made its debut in 1974 and was an immediate sensation, with 1 million of them being sold in just 2 years. 50 years later, the wrap dress is still a bestseller and a wardrobe staple seen on everyone from royalty to celebrities.
I created the dress, but truly the dress created me. So why? Well, first of all, the fabric. The fabric was this jersey that molded the body. Then it was the prints. They always move. It changes your body language. And so the more people notice it, the more happy you are with yourself. Somebody said something very funny once. It's the dress that you get the man in and his mother doesn't mind. So it's both sexy and proper at the same time.
Squawk on the Street, CNBC.
back to the show. Now, last year saw investors offloading record amounts of private equity stakes while fundraising in private markets saw its worst year since 2015. But our next guest says investors will be coming under pressure to make deals and that there is a wall of capital waiting to be deployed. I'm pleased to introduce Sunaina Sinha, the Global Head of Private Capital Advisory at Raymond James. Great to have you on the show. What an interesting topic to discuss this morning. Before we look at the outlook for 2025, I would like to understand if you notice any sort of sectors where investors were particularly falling out of love of last year.
I think the sector that started seeing the most headwinds pressing against it in 2024 was discretionary consumer, especially as you thought about Trump winning the election, then Trump won, and the transition plan that continued to announce tariffs. Anything consumer related started seeing this uncertainty being priced in of, well, what are the cost of goods if we have to think about tariffs, how much, when? And so that sector became out of favor very quickly. I think the other thing in the U.S., the other sector that started getting downplayed was anything energy transition related in the U.S. markets in the second half of the year, again for very similar reasons.
So as we've now started a new year, you're expecting a bit of a change in attitude from private equity. Just explain to us why. What has changed over the last couple of months, really?
I think the most important thing to understand about private equity is that it runs on a clock. These are 10-year-long funds. Maybe they can be extended by a few years, but really you've sold a 10-year product to institutional investors. So that means 4 to 5 years to put the money to work, to go and buy companies. And then the last 4 to 5 years of the fund's life, you're selling companies. Now you have to understand what happened in 2023 and the first couple of quarters of 2024. The market went on a pause. It slowed down quite a bit because of where interest rates were. A lot of market participants either didn't buy a business for a long time and certainly were on hold until the U.S. elections before they started to sell their businesses. Well, the election uncertainty is behind us, both in the UK and in the U.S. And a number of private equity funds have woken up to say, well, they're behind the clock now. And so 2025 is looking to be one of the biggest years in the last 5 years for M&A activity. And M&A activity then spurs those funds to go back and raise more capital for themselves, and around the wheel turns.
It's a bit of a cycle to some extent. Tell us, where do you see the biggest opportunities there for? You're talking about M&A green shoots, but where?
I think the biggest sectors where you'll see them are the sectors of the economy that are going to be most widely benefiting from what's happening around us. So anything industrials related, anything business services related. Tech and tech services remain incredibly vibrant right now. And of course, you can't ignore healthcare and healthcare services, insurance services, adjacent verticals to the healthcare world remains pretty consistently in demand by private equity investors. I think what's also interesting right now is European mid-market in general, because there's been so much of a bearish sentiment around Europe because of what will happen with tariffs and so on and so forth. For the private equity investor that takes a 5-year view to holding a business, it's actually a great time to buy. That valuations on a relative basis, given where U.S. assets are pricing versus European assets, makes the European market really interesting if you're a buy and hold type of investor, which private equity is.
Speaking about Europe, I would like to get your thoughts on the pressure that seems to be building on European officials to deliver on deregulation. Of course, this is a trend in the United States in the wake of the re-election of Donald Trump. But here, there's a lot of talk, but we haven't seen any significant changes towards that, really. Do you think that's actually going to come to fruition, and would that be helpful, really, to see more activity in these markets?
Will it be helpful? Undoubtedly, yes. The question is when, not if, they think about deregulation. Why do I say that? Because markets inherently will put the pressure on the European regulators to think about a different approach. If all the capital starts flooding into U.S. assets, U.S. markets, because they're more competitive, getting more productive, getting more deregulated, the European market forces will have to think about how they compete for capital and compete for resources on a global scale. And I think for that reason, there will be some deregulation. Is it going to be anywhere near the size and scale of what Donald Trump is doing in the U.S.? No, but even a little bit will help make the market more competitive here.
So how does that then actually play out? When you see such a big move from the United States towards deregulation and perhaps a little bit of a move in Europe, what does that mean from a practical point of view? Because then definitely the interest seems to be going stateside.
Interest is going stateside, but remember, when a lot of capital floods into a market, it bids up asset prices, bids up company prices. So the returns you can expect from the U.S. markets becomes a lot tougher to think about how you get top quartile type of return numbers out of the U.S. Whereas when you think about the European market opportunity, yes, everything comes at a price. The prices on a relative basis are going to be better in Europe as you think about the next 2-3 year cycle. However, adding value to those businesses, scaling them, will also be a bit slower than it might be in the U.S. So it's all in what kind of company do you choose, how do you add the value, what are the levers you play. When you think about that relative bet U.S. versus Europe, certainly in the short term, the U.S. has the momentum, but on a relative value basis, you can buy better here in Europe.
Tell us also about Asia, because it's another important part of the world that we haven't yet focused on. What does that mean for Asia, therefore? Because obviously you have these trade tensions, U.S.-China. But then when I was in Asia not too long ago, there was just so much positivity, optimism, which is a totally different sentiment when you're on the European continent.
Absolutely. And I think that it depends on where in Asia you're talking about. I think if you're talking about Southeast Asia, certainly Singapore, Malaysia, and the rest of Southeast Asia, there is a lot of optimism. Then there's a lot to be optimistic about. And they're doing the right and smart thing with their counterparties in the US and Europe to attract that capital in. Singapore, for example, has done an incredible job of deregulation and making their market incredibly competitive and attractive. So those forces have shown that the capital will flow in and will help you grow your economies as a result. I think China still remains really a difficult picture to buy into. Those that have tried to time the bottom and time how much support the Chinese economy will get from the government, these are all guessworks at the best of times. So I think China remains still that one piece of loud noise in the picture when you think about Asia at large, that it's really hard to understand when and where the picture starts to turn, especially with the geopolitical uncertainty now. But Southeast Asia definitely remains much more interesting.
Well, let's see what's going to happen. Hopefully we can speak again if we need to see a lot more activity in this space. Sanina, great to speak with you. Sanina Siha, the Global Head of Private Capital Advisory at Raymond James. And coming up on the show, sales at L'Oreal disappoint with one key market and they're performing. Charlotte will have the details. Join us after this break.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
On a $100,000 margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200, or much more if you're trading big bucks.
CNBC. Live ambitiously.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they all fell for them.
I believe in getting justice.
American Greed on CNBC.
It was a really good quarter.
This growth was driven by transactions.
Before they talked to Wall Street, they talked to John Ford and Morgan Brennan. Closing bell overtime.
Welcome to Street Signs. I'm Sylvia Maro with your headlines. Amazon shares under pressure in pre-market after the tech giant issues disappointing guidance for the quarter but doubles down on its capex plans, with spending set to hit $100 billion this year.
When AWS is expanding its capex, particularly in what we think is one of these once-in-a-lifetime type of business opportunities like AI represents, I think it's actually quite a good sign
The Stock 600 struggles to build on its record high, but European equities looking to cap an otherwise strong week as the investors shrug off tariff threats. L'Oreal misses quarterly sales forecasts, with revenue rising at the slowest pace since the pandemic amid weakness in China and North America. And attention turns to the January jobs report, with markets expecting a modest slowdown in jobs growth, keeping the Federal Reserve in wait-and-see mode. Let's get a check on how we're moving across the equity markets on the European continent. At this stage, we have the Stock 600 below the flat line, down, almost 0.1%. So essentially, we are flat for the time being across the benchmark, as investors are basically seem to be taking a bit of a breather here after such an eventful week. However, also important to keep in mind that several European companies have been reporting today, and thus far that is the most important market narrative for European investors. But of course, we're going to get to the latest non-farm payroll figures stateside later today, and that could be the data point that actually brings a little bit more of a direction to European stocks. Let me show you the different bourses too, so you get a better idea of what's happening on the continent at this stage. It is a bit of a mixed picture, really. We have just the extra DAX trading in the green for the time being. But all in all, though, you need to look at these figures into context, put everything into context, because it has been a relatively strong week for European equities despite all of the volatility around the trade tariffs. But on top of that, the year-to-date performance for European equities has been particularly strong over in Germany as well as here in the UK for the FTSE 100. But let's take a look at one of the corporate stories we're following this morning. L'Oreal fourth quarter sales missed expectations, growing 2.5% on an organic basis, the slowest quarterly rise since the pandemic, amid weak demand in China and a slowdown in North America. Charlotte has been looking at the numbers. Charlotte, at this stage, investors do not seem to be enjoying the latest numbers from L'Oreal. Explain to us why.
Well, we know that in China things are difficult, and that's just something expected. Actually, they're getting a little bit better compared to the previous quarter. North Asia down 3.5%. It was 6.5% in the previous quarter. But they say, look, the mainland China sales decline low single digit for the full year, and that they expect the 25 to be flattish on that market. But the bad surprise, the most negative surprise in this report was the result in North America, because we've seen from previous luxury companies that have reported so far that North America was showing some green shoots there of demand for luxury. And there the sales were up just 1.5% in the quarter against a growth of more than 5% in the previous quarter. So very abrupt slowdown in that market, up 5%. But again, another big engine of growth has been in the luxury division. For them, they have the brands, they make the perfumes and makeup for Saint Laurent, Armani, Prada, and there we've seen a slowdown, which is a smaller division for them, but one has been growing double-digit for several quarters, doing extremely well with brands like Vichy or La Roche-Posay, also a little bit slowing down, up 5% on the quarter. Now, it's interesting to hear from management this morning. They gave us a bit of color for this year. They said they still want to, they will outperformed the global beauty market in 25, but they talked about how they sold recently, and that was in the news recently, a stake that they have in Sanofi. So they freed 3 billion euros with that, and the CFO is saying this morning that it will give them the means for more acquisitions going forward. So very interesting. They also announced this morning a deal with Jacquemus, so this fashion brand, extremely popular and really rising very, very fast. So they have an agreement with them this morning to do some of their beauty. They signed an agreement recently with Miu Miu as well. So they're working, on diversifying their portfolio. Finally, they said they will enter the nutri-cosmetics market soon. That means the supplements. So they said they will make some launches on that front recently, very soon, and that they took stakes in clinics in China and North America to observe and understand the medical aesthetics market. So they give us here some elements of where they're seeing growth potentially coming through. Very finally, Latin America is a market that that is much smaller for them, but growing very aggressively, up more than 7.5% in the quarter. So portfolio going forward, because it looks like some of the traditional growth engine
whether it's Asia or luxury. It's interesting how they're now also focused on the health element of it, because no doubt that seems to be a growing trend. Thanks for the update, Charlotte. Company Porsche SE says it expects impairments in luxury automaker Porsche to nearly double to between 2.5 and 3.5 billion euros. And impairments in Volkswagen to tend towards the top of its previously expected range at 20 billion euros. Now, in the defense sector, we also heard from Saab. The company lifted its medium-term sales growth target, with the Swedish defense equipment maker saying that demand remains high. The results come as the war in Ukraine grinds on, and with President Trump having floated requiring NATO members to lift defense spending to 5% of GDP. Speaking to CNBC earlier today, the CEO, Michael Johansson, said Europe needs greater defense spending.
We must sort of increase capacity, and I've said all the time that I'm not sure we're doing enough. So now we bring forward and increase our investment for capacity, specifically in areas like advanced weapon systems, support weapons and sensors. That's really needed. And we need to have ammunition capabilities and stockpiles in Europe, and there's more needed, definitely. So for this company, it's good for the future, of course. That will put some pressure on the cash conversion in the period of 23 to 27. But we have also said that we will grow compounded annual growth rate over this period 18% instead of 15%. So it's good for the company, but we have to do what we need to do to make sure we can handle the demand which is out there.
And in further Italian banking news, the Italian lender BPER has launched a 4.3 billion euro bid for Banca Popolare di Sondrio, with BPER CEO Gianni Franco Papa describing a merger as a perfect fit. The offer is an almost 7% premium to Sondrio's closing level on Wednesday. BPER's offer comes amid a wave of internal consolidation in Italian banking, led by UniCredit, which is trying to buy Banco BPM. And UniCredit is reporting next week, so we'll have those numbers for you then. In the meantime, let's get a check on U.S. futures. How are we likely to open stateside? We're still lacking a little bit of direction, really, but they suggest a little bit of a downward beat for U.S. equities today. Perhaps what could actually lead to a further direction of travel in U.S. equities today is a non-farm payroll figure. Attention will be on that figure later today, with forecasters expecting a slowdown in the number of jobs added, while unemployment remains stable. That would keep the U.S. economy at what's seen as full employment and the Federal Reserve in its wait-and-see phase. Let's discuss this with our next guest, Michael Eakin, CIO at Phoenix Group. Michael, great to have you on the show. Look, before we think about the Fed, let's talk about the non-farm payroll figure. Last time we obtained the jobs report, they blew all sorts of expectations. They knocked everything out of the park. How likely is that to happen today?
Look, today's non-farm payroll print is a really significant print given the December payroll, where about 256,000 jobs were added to the US economy. We're expecting today to have a more sort of normalized level, so we're expecting the print to come in at about 170 to 190,000 jobs today, but the market's going to be super focused on it. Clearly there's some headwinds that the US economy has faced over the past months. The LA wildfires, colder than usual weather, and that acts as a real headwinds on key areas like construction, leisure and hospitality. So we're thinking a more normalized level of non-farm payrolls print today, around that's 170 to 190K.
I'm still wondering about how you take these numbers into consideration for your positioning, because one report says one thing, the next report says something completely different. Ultimately, now you have the LA fires also playing a role in this figure. How do you read the data in terms of the health of the labor market stateside?
Look, again, it's a really important print today, and it could surprise to the upside and indeed to the downside. If we get more than 190,000 jobs added, then that does increase the prospect of the Fed hiking somewhat. But again, we could get surprises to the downside. We cannot discount the impact of mass migration, the impact that will have on the US economy, and indeed tariffs. So the market's super focused on the print today. we're expecting that 170 to 190, but if we get up surprises to the upside or indeed to the downside, we will see the market move on the back of that.
Everyone at their desks later today to see what that number is. In the meantime, though, talk to us about the other dynamic here, and you've highlighted that already with U.S. tariffs coming into play. What did you learn from this week's events in terms of how tariffs could actually play a role here in the outlook for the U.S. economy and for the Fed? There was so much back and forth, basically.
Yeah, there was. And look, this is going to be a consistent theme of the Trump presidency. You're going to see announcements, then people coming to the table, negotiating, and getting to a place that works for the U.S. and those parties. Look, tariffs globally are not a good thing for global economic growth, and it is weighing heavily on market sentiment. Trade uncertainty on the back of potential tariffs that are coming through is the elephant in the room, and the market would clearly love to see certainty there, but it is absolutely weighing on people's mind.
Let's bring the conversation back home then. One of the guests we had earlier on the show was basically suggesting that the UK is still perhaps one of the geographies that could be a little bit protected in terms of new tariffs from the United States. Do you think that's the case? What could be the impact for the UK economy?
Look, on a localised level, the UK imports about £68 billion worth of goods from the US and exports £70 billion, and it's got a surplus in terms of services. So on a net basis, the US is in trade surplus with the UK. So it would be pretty strange to put tariffs on a country where you've got that situation. Having said that, it's marginal, because actually what will weigh even more on the UK economy is the impact of global tariffs. And even a 10% global tariff will have an impact on all economies, but it will also impact the UK economy as well.
So when you think about what the Bank of England said yesterday, they were very clear to some extent saying that, they are worried about where tariffs are going to go, right? So ultimately, what do you think is the biggest uncertainty from a monetary policy perspective for the Bank of England this year? Is actually these trade conflicts likely to be the main headache for the policymakers?
Look, the policymakers are weighing up many different things, both the domestic economic outlook, the inflation prints coming through, but of course geopolitics plays a very significant role in that. And look, the MPC announcement yesterday, where we saw the majority vote of 7-2 to cut rates by 25 basis points, again, that surprised the market. The market was expecting 8-1, and the market was not expecting two dissenters calling for a 50 basis point cut. So the overall tone is definitely more dovish than the market anticipated. But I think Governor Bailey was very clear in his press announcement following the MPC that they're going to be very cautious and proceed with caution in terms of future monetary policy.
I think they went as far as using the word careful, that they need to be careful this year. One of the discussions we've had on the show in previous shows has been around where the Bank of England is vis-a-vis the Fed and the ECB. Do you think that with yesterday's decision, we actually saw the Bank of England moving further toward the ECB in this more dovish approach?
Yeah, look, again, central bank divergence is something that the market focuses on a lot, and 6 to 12 months ago, that was the topic. There's no doubt about it that the Bank of England's tone is somewhat more dovish. They are very aware of monetary policy and the need to really inject impulses into the economy to get UK economic growth going at levels which will bring about long-term debt sustainability.
Michael, great to have you on the show. Hopefully we can do this again in the short term. Michael Eakins, the CIO at Phoenix Group. Now, coming up on the show, we'll hear from the Monopolies Fed President, Neil Kashkari, today. That exclusive interview is coming up at 13:40 GMT with our U.S. colleagues. And still on this show, the countdown begins to Sunday's Super Bowl. We'll get the latest from New Orleans and dig into what it could mean for advertisers after this break.
Elevate your portfolio with JP Morgan's Equity Premium Income ETFs. Now with more flavors, global equities, US equities, and technology stocks. Discover now. Search JP Morgan Income ETFs.
Ambition doesn't always look like you think it might look. I can remember reading The Economist on my lacrosse bus trips in college. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. I want to democratize access to that high-level information and help explain to every single person out there watching why what's happening in these complex markets matters for their lives today and in the future. That's what drives me. I love being part of this.
The 67th Grammy Awards, big winners were Beyonce and Kendrick Lamar, while the big loser was whoever sat behind Jaden Smith.
Jimmy has Adrian Brody and Idina Menzel. Plus Battle of the Instant Songwriters this weekend.
Kelly Evans, The Exchange, CNBC.
Payroll print with expectations of a slowdown in the number of jobs added. We'll hear from several members of the FOMC, including the Minneapolis Fed President Neil Kashkari, who's speaking exclusively to our U.S. colleagues. Now, eyes also on AI-related stocks as Microsoft, Google, and Meta platforms project combined capital expenditure of at least $215 billion for their current fiscal years, up more than 45% on the year. And it is Super Bowl weekend. The reigning champions Kansas City Chiefs are going to the three-peat as they take on the Philadelphia Eagles. And President Donald Trump is said to be among the attendees at Sunday's game. A record $1.39 billion of bets are expected on the game through legal and regulated operators, according to data from the American Gaming Association. Contessa Brewer asked Kansas City Chiefs quarterback Patrick Mahomes whether the gambling boom is good for the sport.
It gets people watching. I think that's good for the sport. But at the end of the day, I want people to realize that it's a game that you play on the playground for recess. And it's stuff that you just go out there and give everything you love. And I think that's what we try to do on the football field. And I think that's everybody on that football field.
Now, we'll be hearing from a slew of executives across the gambling sector today on CNBC ahead of the big game. And as we're talking Super Bowl, let's get out now to Jay Gray, who is in the host city of New Orleans. Jay.
Sylvia, it's Friday morning. That means it's the start officially to Super Bowl weekend. We're inside the NFL Experience. It's really just an interactive area for fans to have a little fun, get involved in what it's like to be a football player, at least for a few seconds, right? They expect as many as 100,000 fans to pass through this area, all the interactive games, all the displays, and have a really good time through the weekend here. This all ahead of Sunday's game. And there are a lot of fans that show up here, thousands, who don't have a ticket to that game, Sylvia, but they just want to be a part of what's going on in the Super Bowl host city. New Orleans knows how to throw a party. It's been exciting so far. The crowd's really starting to build at this point, and they will through game day. As you talked about, the Chiefs with a chance to three-peat. That's never been done before in the history of the NFL, so it should be an exciting game. It's predicted to be a close game. Sylvia, I think I pulled a hamstring. I am done this morning. Back to you.
Top skills for sure, Jay. Enjoy the game. That was Jay Gray, NBC from NBC News. Now, the game is also said to be an important one for advertisers, with host broadcaster Fox reportedly selling at least 10 commercial spots for more than $8 million each, which would represent a new record. David Jones is the CEO of Brand Tech Group and is joining us to discuss this in further detail. David, great to see you again. I just would like to understand how would you compare this year's Super Bowl versus last year? What has been the biggest difference?
Look, I mean, it's got everything. It's got, Donald Trump, Taylor Swift, Kendrick Lamar. It's going to clearly be a record ever audience. The one thing I say it hasn't got is generative AI, which is fascinating. Now, you could say, but hang on, we've heard that, OpenAI are going to run their first ever Super Bowl spot, not just their first ever Super Bowl spot, but their first ever paid TV advertising. We've got ads from Google and Meta and GoDaddy. But I think the thing that's actually missing so far, and obviously we'll see on Sunday, but no one has actually used generative AI to create that content, which is quite remarkable. Or even bewildering when you think how good generative AI is today at creating content and the incredible progress that's been made in the last 18 months.
So could that be the last Super Bowl where Gen AI is not used for advertising? Is that what you're suggesting?
Yeah, I mean, I think from the content creation piece, I mean, obviously, like last year, you had literally one 5-second ad for Anthropic, and that was it in one region. And now you've got a lot of players present. But I think, interestingly, the Perplexity chief business officer said that they were looking at paying $8 million for a Super Bowl spot, and then they thought it was just going to be packed full of Gen AI companies, so they wanted to stand out. I think the way to stand out is actually use Gen AI to create content, because it's if you look at what creators are doing, and I think it's almost like the advertising industry didn't get the memo. Like the creators today are creating the most incredible content with generative AI, and yet we're not seeing any of that in the Super Bowl.
Let's see whether that will change next year. In the meantime, I want to focus on the numbers once again, because they're staggering. Let me just repeat these for our audience. Fox is reportedly selling at least 10 commercial spots for more than $8 million each, which would represent a new record. My question to you is, where do we go from here?
Well, look, I think, is it the last Gen AI, or is it the last kind of traditional Super Bowl and everyone now from on is going to be generative AI, potentially, but is it the last Taylor Swift Super Bowl? We'll see. But I think if you look at her impact, I mean, the previous game was the record ever audience on a Sunday since the last Super Bowl, 27 million people. That was double what the NBA final got, double what the World Series got, and a 53% increase in teenage girls watching the NFL. You're going to have Trump there, you're going to have Taylor Swift there, Kendrick Lamar. So I guess the question for brands to ask themselves is, if you spent $8 million on a Super Bowl ad, are you going to be overshadowed by all of that and the kind of whole word of mouth that you would usually be expecting? But I think what we are seeing is some amazing creators, and it's a great parallel to 10, 15 years ago. So Perplexity are doing a huge thing with creators. The NFL are bringing in 150 of them. Alex Earl, one of the biggest creators out there, influencers out there, is doing a spot for Carl Jr.'s. So, I think if I think back kind of 10, 15 years ago, everyone said, well, influencers and creators can't create content. And we're kind of there again with, can Gen AI be used to create content? And the answer is yes, and it should be. And I think it's the last time we'll see almost no Gen AI created content in a Super Bowl.
I want to go back to the point you made around Taylor Swift. Of course, she has been important in bringing new audiences into the game, really. But ultimately, why are you looking as to whether this is the last time that she is involved here? And I'm just trying to understand, what does this mean from an audience point of view, and what other audience targets do you think could actually be aimed at in the future?
No, I think it's more just, her relationship with Travis Kelce. They cut to her 17 times in the game against the Jets. And the question is, will the Chiefs get back into the Super Bowl final again? Will it be a four-peat, not a three-peat? And will she still be with Travis Kelce? So I'm being somewhat flippant. But I think, it's clearly going to be a huge audience, and it's going to be fascinating to watch. The only thing I would say is maybe OpenAI will create a TV commercial with their tool Sora. They haven't actually teased their ad yet. Most people have. But I think it's going to be the biggest audience we've ever seen. And it also underscores the point that, yes, in a world of, the attention deficit economy with huge competition and content, big appointment viewing events like this are still going to get huge audiences.
Let's see what will be the headline once the game is over. What will be the peak ad that everyone is going to be discussing. But thank you for your time today. David Jones, the CEO of Brand Tech. And before we let you go, I want to take you to European markets so we get through what has been happening in the equity space today. We have a mixed picture in Europe. We have just the extra DAX above the flat line. We are seeing pressure for other markets on the European continent, though. But But I want to take you to the week-to-date performance. It's Friday, you know, I like to give you the context and think about these numbers. You actually have a lot of momentum for European equities after such an eventful week. We started the week with this new trade war. We saw the United States imposing tariffs on Canada and on Mexico. Then those were put on hold for 30 days. And then, of course, China actually retaliated the moment that they were also faced with American tariffs. However, there's a school of thought that perhaps there's room here for negotiation between China and the United States. In terms of how that has translated into the European stock market, look at these figures. It actually has been a relatively strong week despite all of this volatility. But perhaps what's even more importantly, when we talk about context here, it is the year-to-date performance. Let me show you that as well. Look at these figures. The German market is up 10%. We are double-digit growth so far for German equities. This, however, after what was also quite a strong year for German equities in 2024. So that momentum for the German market continues. This as we are approaching the election later this month as well. Let's see whether that event could propel even more the momentum for German equities. But I also want to tell you about the FTSE, because we have seen the FTSE hitting records in this new year of trading. The FTSE 100, it is up 6%, more than 6% in fact year to date. When you think about some of the dynamics within the FTSE 100, of course, the calls from the new Labour government in terms of building new homes, in terms of bringing more growth into the UK economy is an important narrative. But let's see how the policy action will translate into equity moves as well. When you think about some of the more important stories this week thus far, we have to take you to big tech too. Thinking about Amazon, there has been a bit of a change in narrative here in terms of AI spending. Late last year, as I highlighted earlier in the show, there was so much American exceptionalism, so much bullishness for US equities, particularly big tech. However, we have seen pressure for Amazon. In pre-market trade, shares are down almost 3%, with investors questioning the staggering figure of spending $100 billion in capex this year. When you think about what other big tech players are doing, we're also talking about a lot of money in that field. The question is, after the developments from DeepSeek, is whether this is still a reliable investment to some extent from the point of view that perhaps there's room to spend less on AI and still deliver quite a lot of technological advancements. Let's see what will happen there. I want to take you to US futures too, so you get a final check on what's happening on Wall Street, how we're likely to open. They actually point to a flat start to the trading day. Let's not forget that we're going to get a new jobs report, so all eyes will be on that figure to understand as well what is the health of the US economy. And that number could then provide more direction for US equities. Let's see what will happen later today. That is it for today's show. I'm Silvia Mardo. Have a great weekend.
I think it's really easy to become led by the technology and to think that because you can do something, to quote Jurassic Park, you should do it. And so what I find is a good defense against that is just being obsessed with the client or the customer. So we really try to think, we could do this some cool whizzy Gen AI thing, but does it actually make the experience better for our audiences? Is it something they need? Is it something they want? And if it isn't, don't go there. So for me, I think being really focused and disciplined about remaining that pure marketing concept, is let's be obsessed with the customer, needs to flow through to technology. As soon as we start being led by the technology and what it can do, I think we risk losing our minds a little bit.
ultimate pre-market morning news show. Squawk Box, CNBC.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
We are seeing more agility in many other territories than the European one. Luckily, the good news is that I think not only we in the foundation, but I think in general in Europe, people have woken up to that.
The 27 different countries, even my home country, Germany, they're way too small to have that seat on the table. And that's, I think, what the European Union missed out on, to have a joint foreign economic policy and say, look, these are the standards, those are the rules, we want to engage together for the greater good of the world, and that's missing. So that basically means that they need to get their act together quickly.
Europe is lagging in growth. The UK is ahead compared to Europe, still not as strong as the United States. But both these economies can use growth, and part of getting that growth is to unleash the capitalist instincts and what we call animal spirits into their economies, which means a better balance between regulation and opportunity.
This is a good global debate.
There is no place in the world where we get the kind of access to so many amazing interviews.
To be able to solve problems at a scale that nobody's ever imagined.
This industry is going through its renaissance.
How big a game changer is this?
Let's go.
It is 5 a.m. here at CNBC Global Headquarters. Welcome to Worldwide Exchange. Here is your 5 at 5. Cloud slowdown. Shares of Amazon, they're getting hit, forecasting its weakest sales growth in company history. Data on deck. Investors are looking ahead to the final jobs report of the Biden administration and what it could mean for the Fed. And if at first you do not succeed, President Trump tries again to close a tax loophole that's critical to many on Wall Street. Plus, a CNBC exclusive with the CEO of Snap-on talking everything from earnings and tariffs to hiring. And later, why Wall Street may be rooting against an Eagles Super Bowl victory. We'll debate if they're haters or there's data that supports that thesis. I'm leaning more towards the first one. It is February 7th, 2025, and you're watching Worldwide Exchange right here on CNBC. Thanks so much for being here with us. I am Frank Holland, also an Eagles fan, just full disclosure. We begin with the major indices coming off a 3-day win streak as investors, they really try to digest a mixed week for tech earnings and the long-term implications of tariffs. Taking a look at futures this morning, pretty muted start to the day. The S&P down fractionally, the Dow up fractionally, actually just turning positive a short time ago. The NASDAQ, maybe surprisingly, just down fractionally right now, just about 17 points. All right, we're going to look at the pre-market movers and the big stock story of the morning. That's Amazon near the top of the NASDAQ 100 laggards. You see it right here, down just about 2 3/4%. Microchip Tech, actually the biggest laggard, down over 6%. Rounding out the bottom 5 here, we have Tesla, NVIDIA, and AMD. Again, rounding out the bottom 5. We'll look at the gainers as well. Taking a look here on the other side of the coin, Fortinet, cybersecurity name, up about 7.5%. Take-Two Interactive, a video game maker, up almost 6%. Marvell Technology, Palantir, up over 2%. This stock just seems to be a juggernaut. Booking Holdings also up 2% in the pre-market. Want to take a look at the Mag 7. We just showed you a few of the names, but taking a look right now, we're seeing the Mag 7 moves on the back of that Amazon report. Apple down fractionally. Alphabet also reporting this week down about 0.25%. Microsoft basically flat, but up fractionally. NVIDIA, we just showed it to you a short time ago, down 1.25%. Meta Platforms up almost 0.25% as well. Those are the moves on the Mag 7. And we continue to follow the ETFs tied to China, Canada, and Mexico, the 3 countries involved in those tariff disputes. All 3 actually outperforming the S&P week to date. You see the week to date moves here. The MCHI that tracks China up about 1.5%. The EWW that tracks Mexico up about 3.5%. So big upside move for that ETF. The ECW that tracks Canada also up just about 1.5%. Want to take a look at the Treasury market. Bond yields kind of holding steady ahead of that job report that could have a big influence on the Fed and its rate decisions. Taking a look at the benchmark, coming in at 4.43. Also some questions if investors piling into bonds for safety. That may be one of the reasons why we haven't seen more movements in bond yields. But again, the benchmark at 4.43. And we got to take a look at gold. That is definitely a safety play. Gold hitting another all-time high. You can see this morning moving even higher, up another 0.5%. Week to date, it's up 2%. Again, gold hitting another all-time high. Bitcoin, a very different story. We've seen Bitcoin under some pressure. You see the chart. Week to date down almost 4.5%. Right now, kind of a rebound, I guess, up just over 0.5%, trading at about 97,275 a coin right now. But again, down for the week, just about 4.5%. And we got to take a look at oil. Rebounding a bit this morning, but still on pace for a 3-week losing streak. WTI now negative on the year, but right now we're seeing WTI up almost 1%. Similar story for Brent crude. Brent crude, the international benchmark. Okay, that is your setup now. We want to get to our big stock story this morning. That is Amazon, down big in the pre-market after its latest earnings report. CNBC senior tech correspondent Arjun Kapal joins us now from London with much more on this one. Amazon shares down over 2.5% right now.
Yeah, that's right, Frank. And look, it was a pretty good quarter just gone. If you look, EPS came in at $1.86, way ahead of consensus. Revenue came in at just under $188 billion, again ahead of consensus. But there were quite a few moments that gave investors a reason to sell. Firstly, the guidance of between $151 and $155 billion was below consensus. And at the lower end, that would imply around 5% growth, the slowest growth on record for Amazon. AWS, Amazon Web Services, of course, in focus, which is around 50% of profit for Amazon. Posted revenue more or less in line with estimates. But I think given the optimism around this part of the tech giant story, its business, the market really wanted a bigger beat as well. And of course, all eyes on CapEx. That's the theme of this earnings season. Amazon saying it will spend $100 billion this year, mainly building out data centers and investing in AI. That's bigger than Microsoft reported and Alphabet as well. Now, CEO Andy Jassy on the earnings call called AI a once-in-a-lifetime opportunity as a way to justify to investors that spending. But of course, DeepSeek has sparked concerns over whether such a level of investment is needed and, of course, whether those tech giants will see the return on those investments. There were some good parts, though. Look, Amazon boosted profitability with net income almost doubling to $20 billion, and its ad business continues to grow with revenue up 18%. But, Frank, look, given the sky-high expectation and, of course, the jitters among investors, Amazon didn't quite hit the mark with the stock down in the pre-market.
So, Arjun, again, looking at the chart right now, down about 2.5%. That CapEx spend by Amazon, as you mentioned, $100 billion. Is actually about a 20% increase year over year. Is that one of the things that are weighing on this stock this morning? Do you think this is a reaction to DeepSeek? Again, investors kind of questioning the need for such intense spending when it comes to CapEx?
Yes, DeepSeek changes the game going into this earnings season, Frank, and I just kind of want to try to lay out the two sides of the debate here. One is that DeepSeek has created this really efficient model, cheaper on potentially older NVIDIA chips, and so the question arises, why do you need to spend all this money on this investment? The second part of the equation, and this is very much firmly where the tech giants are sitting and what they're saying this earnings season is, well, if the technology is getting cheaper, actually, it's going to become more widespread, more widely adopted, and actually, that's going to be good. We're going to need to build more infrastructure because there's going to be more demand, so we will need more computing power. And if you listen to all of the CEOs on the earnings calls from Microsoft, from Alphabet, and now from Amazon, they are saying just that it's a good thing for us, the hyperscalers, and clearly that's the debate that's been playing out this earnings season.
You know, I thought you were going to say Jevons paradox. I feel like it was a drinking game on our air right after DeepSeek. People kept on saying that thesis of what you were just talking about, the cheaper it gets, the more consumption we're going to see. Arjun Kapal, great to see you as always. Thank you very much. All right, turning back to the broader markets, rough reports today from Amazon and Alphabet. They seem to be weighing on the major averages, but they're still on track for a positive week, even despite Monday's tariff-fueled sell-off. But depending on what happens Sunday night against the Eagles and the Chiefs, at least according to Wall Street history, we could be in for a fresh round of pain. Joining me now is Ryan Dietrich, Chief Market Strategist at the Carson Group, also the person that sent around these stats about Philadelphia sports teams and the markets, yes. Ryan. So we got a lot of reaction on our internal emails. Let's bring the audience in on this. I'm going to use some air quotes, my man. Research that you did. Yes. What's the thesis here?
Well, first off, good morning, Frank. Thanks for having me in. And I know you're an Eagles fan, so don't get too mad here. There's something called the Super Bowl indicator, right? If the AFC wins or the NFC wins. So historically, There's been 58 Super Bowls. Interestingly, 29 AFC winners, 29 NFC winners. When the AFC wins, stock market's up about 10% on average. When the NFC wins, it's 10% on average. AFC is about 8%, so a little bit better. But the last 13 times AFC won, Frank, the market's been higher 12 of the last 13 times. So playful stuff, disclosure, don't invest in this. But here's where it gets interesting, like we said with your Eagles. Eagles won, Eagles, put it this way, the city of brotherly love. When you win a Super Bowl or a World Series, the Athletics won, there was Athletics back then, 1910, 1911 recessions, okay? 1913 led to World War I. 1929, 1930, Philadelphia won again, World Series, not good times. 1980, the Phillies won the World Series, double-dip recession. 2008, Philadelphia won a World Series. And then 2018, a down year for the market, not that great. Eagles won a Super Bowl. Okay. So listen, maybe, you get it, but just playful way to look at it.
I let you roll this all out. I want to point out something that you forgot. I'm going to go back. Since you're going back to 1910 when the Athletics were in Philadelphia, they're like 3 cities past Philadelphia now.
You're right.
1983, the Sixers win the NBA championship. We're going to show the audience the S&P performance. Up double digits that year. Selective data, Ryan, selective data.
Yeah, I got to admit, it didn't fit the narrative. You're right. It is playful, but we'll see. And I'll tell you this much. Kansas City wins the Super Bowl. Market's up like 16% on average versus the one time the Eagles did, it's down. But hey, we'll see. Good luck. I don't like the Chiefs, I'll be honest. So I'm rooting for your Eagles.
Well, I can't tell by the research you did, Ryan, but let's get down to some more serious business.
There you go.
Looking at the markets this week, are you a bit surprised to see some weakness when it comes to big tech? Amazon's the latest, and the markets are still up for the week. Is that a surprise to you at all? And what does that say about investor sentiment and direction of this market?
Yeah, it's a tad surprising, but honestly, when you look at the fourth quarter last year, Frank, we started seeing technology, semiconductors starting to underperform on a relative basis a little bit. So it's not hugely surprising. We came into this year, optimistic, pretty bullish, but more neutral technology. I guess what's really impressive, like 2 Mondays ago, we had DeepSeek Monday. Yeah, the market was down, but you look, 351 stocks were higher, right, in the S&P 500. Well, this rotation is real, right? The lifeblood of a bull market is rotation. I know tech's a huge part of the market. Communication services with Google today is a huge part of the market. But to see, financials hitting all-time highs, you've got industrials hanging in there. Small and mid caps are doing really well. I know they're a dirty word sometimes. So we're really impressed with this rotation we're having. And we think it probably continues as, again, maybe the Fed cuts a little more than the market thinks. Inflation could improve and the economy's strong. We can get into that, but that's how we see it playing out.
Well, Ryan, speaking of the Fed, we obviously have the jobs report coming up later today. The expectation is 169, a downward move from last month's or the previous month's report of 256. There are some disruptions in there. There's wildfires. There's some other things going on in this report. How do you think the Fed takes this report in light of some of the policies we're seeing enacted by this administration that they've admitted that they're factoring in? What's the meaning of this report in your mind when we're looking at the Fed? How do you think the Fed's going to take it? And how could it possibly influence the rate cutting cycle?
Yeah, I'm not so sure it's going to influence the rate cutting cycle that much. Like you said, there are some one-offs this month. A couple of months ago, we had obviously the terrible storms that went through the Southeast that really did a number on it. I think inflation is what the Fed really is still focusing on. I mean, you talk about it. I mean, yes, they're worried about the tariffs. They're worried about the policy. But we're not seeing spikes in inflation yet, Frank. We're not seeing big spikes in initial claims. I know a little bit higher yesterday. But all in all, the labor market is still pretty solid. I mean, that's the reality. We're not seeing major layoffs. We're not seeing... We actually saw more people quit last month. I mean, when do people quit? When, you're going to quit if things are okay, right? So, I mean, I know it's not a perfect labor market. There are cracks. I think that's going to matter more. And maybe, over the course of the next quarter or so, we'll get a better clue about the jobs data. But I'll tell you, the economy still looks pretty darn strong to us.
All right, Ryan Dietrich, allegedly an Eagles supporter. I can't tell. I just can't tell, Ryan. But always
that's good research, right? You can't tell where I lean. I'm a Bengals fan. Trust me, I have nothing to root for right now. So that's how it goes. Yeah.
Ryan Dietrich, enjoy the weekend. Enjoy the big game and the Eagles' victory. Thank you. Good to see you. All right, this morning, we're also tracking ETF flows. ETF net inflows topping $109 billion year to date, following a record above $1 trillion in 2024. So we're on track for another $1 trillion year. We're also tracking the moves above the 30-day moving averages for the popular index funds, the SPY and the triple Qs. Take a look right here. Monday, we saw a slight bump of inflows during the tariff-fueled sell-off, but then investors, they kind of turned away from those index funds throughout the week. The SPY and the triple Q inflows falling the rest of the week, with the markets recovering on some tariff pause news. And you can see right here, the markets are actually on pace for a winning week if you look at the S&P and the NASDAQ 100. But it was a somewhat volatile week, and according to VettaFi, there was an increase in investors looking for safety with a rise of inflows into government and corporate bond ETFs. The LQD is an investment-grade corporate bond ETF. The SGOV attracts short-term treasuries. All right, coming up here on Worldwide Exchange, we got a whole lot more to come, including why one money manager says investors should get regal with one underappreciated dividend-paying ETF. But first, manufacturing, trade wars, jobs, and earnings, a CNBC exclusive with the CEO of Snap-on. Plus, President Trump weighs closing a tax loophole that is critical to investment managers all around the country. And later, much more on Amazon and why its rough Q1 outlook is not denting my next guest's bullish take. A very busy hour still ahead when Worldwide Exchange returns. Stay with us.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
CNBC. Live ambitiously.
How much would you pay for luxury travel? A week's stay costs almost $270,000.
It's on the list for $30,000.
From secret getaways to one-of-a-kind deluxe experiences and bespoke services all the way.
The next evolution of the luxury traveler is experiences. Experiences really that money can't buy.
This is First Class, only on CNBC.
Want to make some extra money but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today. Live from the New York Stock Exchange, Halftime Report, CNBC.
As we close in on the 6 a.m. hour, check on a few big stories that we are following this morning. Apple is reportedly planning to unveil an overhaul of its low-cost iPhone SE in the coming days and put it on sale next month. The last SE refresh was back in 2022. President Trump meeting with U.S. Steel CEO yesterday as the company looks to salvage its deal with Japan's Nippon Steel. It's unclear what exactly was discussed at the meeting, though the president is set to meet with Japan's prime minister today. The president also meeting with the chairman of FedEx, Fred Smith, yesterday as well. Sticking with D.C., reports this morning the White House is working on an executive order to fire thousands of Health and Human Services workers, with the order being signed as soon as this week, as next week, I should say. The news coming just days after a federal judge paused the deadline for federal workers to accept Trump's buyout offer. Outside of Amazon, two more stocks on the move, including Take-Two Interactive popping in the pre-market despite missing fiscal Q3 sales estimates. Also looking at Expedia, also moving higher after a Q4 earnings beat, and it reinstated its quarterly dividend at 40 cents. Shares of Expedia right now up just about 9.5%. Investors are preparing for the big monthly jobs report before the open. Take a look at futures right now. It's kind of muted all day, or all morning, I should say, ahead of that report. Similar story right now. The Dow up fractionally, the S&P and the NASDAQ down fractionally. With that, let's bring in Simeon Hyman, Global Investment Strategist at ProShares Advisors. Simeon, good morning. Great to have you here in studio.
Thanks for having me.
I think we got to start with the jobs report coming up later today. What are your expectations? How do you see the market reacting to the numbers that we get?
I think the market's going to hold up. You know, we've seen the economy hold up in many ways. One of my favorites is that ISM manufacturing actually beat expectations just a few days ago, and that's a broadening out of the economy. So I think we'll see a decent jobs number. And of course, earnings, 12% year-over-year growth in the S&P 500 with roughly 3/4 of the companies in. That's decent news.
What do you make of what we've seen with mega cap tech this week? We've seen some weakness, and still the markets are on pace for a winning week. Is that surprising at all?
It's an important broadening, but it is also a sign of risk. The tech sector is still in the red so far this year. So that's good news in terms of a broadening, but you're still talking about a tech sector that's over 30% of the S&P 500. We see the Amazon results that are a little bit of a disappointment. So there's clearly some risk there.
You're not the only one talking about that broadening. I think that leads us to your word of the day. What is it?
I'm going with mid caps. It is historically the sweet spot. It has outperformed large and small cap stocks over the decades. If you look at valuations, you're looking at 50 cents on the dollar for mid caps. That hasn't happened to small, even though small has also underperformed. Why? Because mid caps are showing up with earnings growth.
When we're talking about mid caps, a lot of times we talk about small caps. They're more domestically focused, a lot of leverage. What are the characteristics of mid caps that you think are going to make them work going forward?
Well, you also have a similar domestic focus. So you have 75% of revenues domestically. That's really important. But what you have is higher quality than the small cap front. Okay. On small caps, you have losses, you have negative earnings, all those things. You don't have them in mid caps.
All right, you got a pick for us. What's your pick for us today?
REGL. It's our ProShares ETF. It's the S&P 400 Dividend Aristocrats. People think about dividend growth in large cap, but it's incredibly applicable to mid cap. You've got them at a discount. You have a 2.7% dividend yield, and you have higher and stronger fundamentals than the rest of the S&P 400.
So is the idea here people are going to dividends as kind of a flight to safety? You're looking for income with a lot of volatility?
We're looking for quality. So it's dividend growth, not dividend yield. You don't have to go all the way into the cheap stocks, but consistent dividend growth is where you get strong balance sheets, high return on assets, strong earnings growth.
Simeon Hyman, your pick for us today, the REGL ETF. Thank you very much. Always good to see you. All right, that's going to do it for us here on Worldwide Exchange. Squawk Box starts right now.
Good morning. Shares of Amazon, they're down, but paring their losses overnight after some disappointing guidance. We'll show you what the company said about advertising, the cloud, and demand and spending for AI. The Trump administration's buyout deadline for federal workers is on hold. A judge extended that deadline through at least Monday. And it's Jobs Friday. We'll get you ready for the January employment report, the potential market reaction, and the implications for the Federal Reserve and what it does with rates. It's February 7th, 2025, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin on this Friday morning. Right now, it looks like the U.S. equity futures are mixed. That's the way they ended the session yesterday. You did have the S&P 500 and the NASDAQ up for the third session in a row. The Dow was off by about a quarter percentage point. Right now, it looks like the Dow's indicated up by 11, NASDAQ's off by 18, the S&P is down by 2. But, guys, we are up for the week, even though you started the week with so many concerns about what was going to happen with the tariffs. At one point, the futures down by about 1,000 points on the Dow. We'll continue to watch and see where things head, but we are in positive territory for the week. Treasury yields right now, the 10 years at 4.43, the 2 years at 4.23. So again, the 10 years well off the 4.5% and above that we had seen last week. We do have some big jobs report numbers coming up today, and that's something the Treasury market and the equity markets will be watching closely.
Meantime, a federal judge pausing a whole bunch of things they're pausing right now because those buyout offers for federal workers, that is paused now officially less than 11 hours before the deadline to accept the deal. The judge saying his injunction pausing the plan would continue until at least Monday, when he will consider arguments by employee unions challenging the legality of the buyout and by a lawyer from the Trump administration defending the plan. Now, as of yesterday, more than 60,000 people had accepted the offer. Spokesperson for the Office of Personnel Management telling NBC News that they interpret the order as allowing federal agencies to continue processing resignations. Now, that means employees who have already accepted what is known as a deferred resignation package can begin their paid leave. But again, there's about 1 million questions about what happens if you accept or if you don't accept and then they fire you later. I mean, there's a lot.
And there's even questions as to whether they can pay you out over that time, whether Congress has to be the one that authorizes these things, and it is going to get caught up in the court system.
I saw Mark Warner, senator, saying that we don't know where the money's coming from to do the pass. It's tough. I mean, it's not a huge number, I mean, a percentage of federal workers.
2% of federal workers that accepted it.
It's still a small number. And I think everybody would like to streamline things, and you would think that maybe a buyout's better than an outright firing. But,
I mean, I think it gets back to the question that we had yesterday from Ro Khanna, the congressman in California, who just said, look, I'm in favor of a lot of these things, but really they need to be brought to Congress. We have to sign off and approve on it. This is where the judiciary system is going to decide. Is this the power of the executive? Is this the power of Congress to be able to do these things?
Meantime, Treasury Secretary Scott Bessent speaking yesterday about the DOGE team and the DOGE teams, in particular, their access to federal payment systems and the data. In an interview with Bloomberg, he described it as a, quote, operational review, not an ideological review. He said the team's access is, quote, read-only. That's something that we've heard from President Trump before, and that there's been no, quote, tinkering with the department's payment systems. Bessent said he personally vetted the Treasury employees on Musk's team who have the access. That became relevant yesterday when one of the 2 DOGE staffers authorized by a judge to access the data resigned. 26-year-old Marco Eliz stepping down from his role. This after the Wall Street Journal linked him to a deleted, or now deleted, I should say, social media account that advocated racism and eugenics. That account posted in July, quote, just for the record, I was racist before it was cool. I don't know what you make of that. I will say I was happy to hear Bessent's comments about not just the read-only, but really sort of getting granular, if you saw it, into the details of, you know, what they can actually do when they can't do. I would love to see more transparency around the process. I think it's great that they're obviously creating transparency around the spending. So on the main front, you want to know that. But I think for the credibility of the whole exercise, you want to feel and know that however it's being done, it's not being siphoned off into some crazy place or that's going. I think the new worry, which I'm actually less worried about, but I think one of the worries is that a lot of this is being fed into various AI systems to analyze, and then therefore those AI systems now have access to that data. I just think it would be better if everybody knew, almost on a daily basis, frankly, what's going on, given the speed and rapidity of it all.
Bessent was pretty reassuring yesterday with some of the things he said. But by the way, adding that you can't even do that from Treasury. That resists the ability to change those things. Like
the Federal Reserve is the one
level
that does it.
Not at the Treasury.
I remember when we first had him on a couple of times. He was so frank in just the way he does sort of inspire. Yeah, he does sort of inspire. At least you know what you're getting. This person that had to resign I saw some hoopla yesterday out of a funny chyron about.
I saw that too.
Is this a different guy?
I don't know. I was wondering the same thing.
Did you see that?
Yeah, I did. I don't know.
Yeah.
Is that guy still there?
I don't know. I didn't, honestly, I didn't hear the interview. I just saw the chyron. It was on.
And the ones I saw just had the faces of the three people that they were just very unhappy with. But someone said, "Can you believe that someone at Chyron, or at CNN, really had to type that chyron?" People don't know what we're talking about. You can look it up. I'm sure we probably
I don't
can't
even want to say it.
I know. and neither word of the two words.
Well,
I
big.
mean, you're allowed to say big. You're allowed to say balls. You just really can't say them together, I don't think. So, and I didn't. Did I?
There wasn't much of a pause between.
There was I think there was enough. There was a pause that refreshes. Pause that refreshes. Several stock movers to watch. Shares of a firm are sharply higher. The buy now, pay later company reported earnings of 23 cents a share versus an expected loss of 15 cents. Revenue and gross merchandise volume also beat estimates, and the CFO of the company said earnings were boosted by a $60 million gain from a deal back in December in which the company repurchased some of its convertible debt at a discount. And Pinterest shares are sharply higher this morning. Fourth quarter revenue was above estimates, and the guidance range for the current quarter for sales mostly above expectations. And monthly active users grew 11%, all the way to 553 million. Global revenue per user came in at $2.12, and that was 3 cents above estimates. The company CEO is going to be at Squawk on the Street at 10:45 a.m. in a CNBC exclusive interview.
Shares of e.l.f. Beauty are plummeting. The company cut its full-year guidance after seeing a 36% drop in profits and softer than expected sales trends for the month of January. Revenue for the holiday quarter did beat estimates, but earnings of 74 cents a share missed by a penny. The company's CEO spoke to Jim Cramer on Mad Money last night.
There's two things that happened. One is the December period was highly promotional. Sometimes you have like this consumer hangover after they loaded up on a lot of product in December. Now, we're not promotional, but the industry was, and you sometimes have a trough after that.
The CEO also said that promotion on social media dropped by about 20% in January because of the uncertainty over TikTok and the sensitivity of wildfires in Los Angeles. You can see that stock down by more than 27%. Shares of Expedia, though, are rising, with earnings coming in at $2.39 a share. That beat the street's expectations of $2.04. Revenue also beat, and gross bookings came in at $24.4 billion. That was better than the $23.3 billion the company had been expected to hit by Wall Street. The stock right now up by about 10%. Also announcing that it's reinstating a quarterly dividend of 40 cents a share starting in March. And again, that's shares of Expedia up by about 10%.
And coming up, Amazon passing Walmart in revenue for the first time, but the stock down a little bit, falling after guidance was short of estimates. We're going to dig into that story next. Then later, President Trump outlining his tax priorities in a meeting with GOP lawmakers. I thought about you, Andrew.
Yeah.
You finally carried interest. Might happen for you.
He tried to do it the first time.
Yeah.
Couldn't get it done.
Biden couldn't get it done. Yeah.
No, I'm saying Trump tried to do it.
Yeah, I know, but Biden could do it in his last
Did he try?
go-round.
Biden?
Yeah, remember, because Kristen Sinema.
Oh, yeah, that's right.
Great Kristen Sinema.
Right. Robert Frank's going to bring the highlights for hot button issues like carried interest and the salt cap. Squawk Box will be right back.
Ambition to me is the American dream. It's why my mother came over from Taiwan. It's why people watch CNBC, because they want a better future. I was working as an analyst in Shanghai when my company landed in the news on accusations of espionage. I decided right there and then that I wanted to be on the other side,
day, sun-drenched days, turquoise water, and some really tough challenges.
Way more work than living in a house.
And a bit further north, primary school teacher from Texas found happiness and a home in the world's greenest city.
Hi, welcome to our Copenhagen apartment.
Catch it all on Unlocked.
The climate crisis is a gun to our head, so we better get our act together.
We meet those at the forefront of creating a sustainable future.
Our work has been accelerating, and we've now hit 43.7 million people rather than kind of traditional charity. It's more about empowerment.
Climate change is like the internet. It gets bigger every year, it never goes away, and you have to learn to make money from it.
In the last 10 years, we've seen a very encouraging sign of much more products coming online into the market in terms of green and sustainable products.
An issue that affects every generation.
These kids, it's great they're fighting for their right to have a planet to live on. You've got to scream to be heard. You don't just sit politely and go, oh, I can have a conversation about pollution, please.
Soil is not our property. It's a legacy that's come to us from previous generations. It's very important we pass on living soil for future generations.
There is hope for the future, but only if we take action and take action now.
Join the sustainable future only on CNBC.
We just told you Amazon shares under a little bit of pressure this morning, but paring losses from last night. Company provided disappointing guidance, cloud revenue missed estimates, big investments in AI. Joining us now with more on Amazon. In the overall market and the economy, I want to talk about that. Stephanie Link, Hightower Chief Investment Officer. I think we spoke to you maybe before Amazon, and I think either way you would buy the dip in Amazon. We'll talk about Amazon in a second, but you point out about the economy, and you had to actually take a double take at what GDP might be running. It's some ISM numbers suddenly. Manufacturing is hard. We got a jobs report today, so things are too hot or just right, or is it good?
Things are really good, and it's really good to see you, Joe. Welcome back.
Oh, thanks.
The economy, look, the Atlanta Fed tracker, which we know is very volatile, it came in at 3.9% this week. And so maybe it's more like 3, maybe it's 2.5, whatever it is. The economy is doing quite well, and it's led by the consumer. If you look at personal spending and income, even savings. And then, yeah, you mentioned the ISMs. ISM services has been in expansion for over 2 years, so that's no surprise. That continues, but it's the manufacturing piece that's now also doing better. If we got an expansion read this week, which was the first time in 26 months. And I think that ties back to what you and I have been talking about for a couple of years now, which is onshoring, reshoring, data center build out, grid repair. I mean, I also think it might have something to do with Boeing and them getting their act together as well. As we know that they were able to produce more planes, 737 MAX planes in January than people expected. And that's going to increase throughout this year. So really good things across the board. And we care because that impacts earnings. Earnings are running about up 12%, which is really nice too. And what I'm encouraged about, and I know a lot of people are starting to talk about it, is so far we are seeing a broadening out. We have financials, healthcare, materials, all up more than technology year to date. And so that's encouraging as well.
What you mentioned about Boeing, that's a lot of stars aligning there. So 33 of the MAX in January, you think you can get up to 38 eventually. Yeah. So you're buying that stock still pretty cheap on a historic basis. So 184. As a result, Boeing is your favorite stock at the beginning of the year?
Yeah, it is. It's a turnaround story for sure, with a new CEO who has a really good, proven track record, and them just, getting their act together and not having as much in terms of supply constraints. And that's actually what they talked about on their conference call. They can get to 38 planes per month because they can get the pieces for the planes, and that has been a big problem over the last couple of years as well. By the way, GE said the same thing about supply constraints getting better. So, and they're the engine maker. So, I like both those stories.
And you like Amazon still. This is if you talk about Amazon, you could talk cloud, they're going to spend a lot of money on AI. They want to be a major player on AI. There's competition for what, one of their core businesses with Temu and Shein, and then there's the whole tariff issue. You would think that would help Amazon, but they're not immune to it either. But with all those things taken together, if it's down $7, you would buy it and you own it.
I was hoping it was going to be down more, to be honest with you, Joe, so I could get it even cheaper. But it's not down because more than 2.5–3%, because the quarter itself was very good. I mean, they beat on earnings. Operating income was really very encouraging. And retail margins at 8% were the best since 2004. And the growth rate was 10%, and expectations were for 9%. So they're doing really well in the U.S. International margins grew on the retail side 400 basis points. And of course, AWS, which everyone's focused on, rightfully so, it still put up a 19% growth. I know whispers were like about 20, but 19% growth is steady, and that compares to declines seen from their peers. So, and they talked about capacity constraints. Actually, so did Alphabet. So it would have grown more without those issues. And I just think that there's so many tailwinds for the next several years in terms of AWS. And I think the CapEx at $100 billion. Okay, so maybe that lowers your free cash flow to $55 billion for the year, but that's still really quite impressive.
I mean, that was going to be my question, Steph. The CapEx really stepping up more than $100 billion after, what was it, $75 billion last year. And that idea, are investors saying, yeah, we're still behind that. We're okay with going after it and spending as much as you can to capture this demand. We're not worried about anything we've heard from DeepSeek along the rest. This is money that you and other investors want spent.
Absolutely. This is going to be more than $1 trillion total addressable market between now and 2030. And, IBM had an analyst day this week, and they said that 98% of enterprises are working on AI, but only 26% of those companies have processes in place to actually do something. So think about that tailwind for a minute. And they also believe that the CapEx spend of something like $300 billion this year will go to $850 billion by 2028. So a lot of companies are behind this. I'm behind this. A lot of us are, and I think we're in early innings.
Yeah, and we're in that weird I don't even know what you call the first 100 days. It's the old administration. It's the new administration. And whose jobs number is this? This is the Biden administration's jobs number, but there are animal spirits with the Trump administration. It's, I don't know. We just got to go with it and not try and figure out exactly.
Well, there's all kinds of weird things.
Who's to blame or who's to credit?
Weird divisions that are going to be in this, too.
Yeah, it's going to be messy.
It's going to be a mess. I don't know, because this is always the month when the Labor Department goes back and revises everything. They take that jobs number and they add in everything they've seen from the county numbers that are a little more accurate and try and revise everything going back to March of last year. And then the Census Bureau in December really threw things off with what you can expect from the unemployment rate when they sharply revised the number of working people in this country based on immigration that started in full force back in 2021. So a lot of moving pieces that you're going to see in this.
Is there anything that could hurt the market or help the market with the jobs number? Could it be too hot? Are we still counting on rate cuts?
Yeah, well, the average hourly earnings is something that we always look at. So that's going to be something that's top of mind. But honestly, the non-farm payroll jobs, it's backward looking, Joe. You know that.
Yeah, it is.
It's initial claims that's more forward looking, and initial claims are just fine, right? We're running at about 225,000 jobs, initial claims in the last 4 weeks on an average basis. We're nowhere near a recession, as we talked about with the GDP at 3.9. Recession for initial claims is something like 350 to 375,000. So we're nowhere near that, and I think we're going to see a solid number today. And should the market sell off, I think we're getting earnings, and that's what we watch to figure out where we want to buy. And I think you do want to buy if you see a pullback.
Okay, Stephanie Link Hightower, Chief Investment Strategist. We'll see you soon.
Thanks, Joe.
Okay.
Coming up right here on Squawk Box, the Winklevoss twins. They are reportedly considering an IPO now for their crypto exchange Gemini. We're going to talk about all of that after this. Plus, we're counting down to the January jobs report. It's happening this morning. Set your timer, your watch, your alarm, whatever. We're going to bring you the numbers at 8:30 a.m. Eastern Time, followed by reaction from Minneapolis Fed President Neil Kashkari. He's going to take us inside the Fed and how they're thinking about all of this. Squawk Box returning after this.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
CNBC. Live ambitiously.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. My ambition starting out was to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You learn a lot here at CNBC. It's also a lot of fun.
Geopolitical stability, I think, is good for growth. It's good for peace.
Our principles are very clear. No agreement on Ukraine without Ukraine. It is impossible to keep NATO safe, the whole NATO territory safe. Yes, for now, yes, we can do that, but not in 4 or 5 years.
The risk is to the downside when it comes to growth, and we'll have to be very attentive to the data.
The structural weaknesses of our economy absolutely have to be addressed.
I wouldn't have been as successful as I was without my team. And I take that throughout my whole career, and I take it into my business life as well, and also with my family. It's all about my team for me.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange, CNBC.
Welcome back, everybody. The expansion of artificial intelligence in medicine is transforming clinical practices, but it faces regulatory challenges as the FDA may classify these AI tools as medical devices. Joining us right now is Dr. Scott Gottlieb. He's former FDA commissioner, a CNBC contributor, and he's on the boards of both Pfizer and Illumina. And Scott, I am so curious about this because to me this is the greatest promise of AI, the idea that we can work it into our medical system and get way smarter about all the research that's out there and maybe have better end results for patients. How close are we on that front, and what happens or what is happening right now on the regulatory front?
Well, I think we've largely achieved that front. I think AI can be incorporated into electronic medical records, and that's really what's at issue here. The AI tools that would sit inside an EMR and electronic medical record and actually cull information from different streams of data, so clinical notes that a physician may write, radiology reports, lab reports, and try to do interpretation and provide some guidance to the physician about what a diagnosis can be, what a differential diagnosis is, what some potential treatment recommendations are. The physician's still in the loop, so they're still making the decision. The AI would be assisting the physician. What FDA is saying right now is that any AI tool that sits inside an EMR that culls information from different streams of data, so different sources like, laboratory records and imaging results, and also provides the information in a time-critical fashion or is so comprehensive that the physician's unlikely to form their own judgment. They're likely to take the results of the AI tool at face value. That would be a medical device. And that's antithetical to a law that was passed in 2016. The 21st Century Cures Act, which created this category of clinical decision support software, that was software that really provided interpretation and recommendations to the physician, but the physician was still in the loop. We put out guidance in 2018 that interpreted that law, that basically kind of expanded on those definitions. But then in 2022, FDA issued new guidance that basically upended the old interpretation and came out with this new one that basically stipulates that AI tools that would sit inside an EMR probably fall within the domain of being a medical device subject to FDA's regulation.
Here's my concern with it. We hear about the AI that's being used in some insurance companies, and that as a result, the doctors do get cut out of the loop. And, again, artificial intelligence is still only as good as garbage in, garbage out. If you are an insurance company and you are trying to make sure you are getting the most out of Medicare payments or some other place that you're billing things, there's an incentive to force that AI or make that AI look for decisions that are not necessarily best for the patient's care. How do you make sure that the patient's care is what is first and foremost if you're dealing with AI decisions that maybe supplant what the doctor sees with his or her own eyes?
Yeah, I mean, it's a question of who's developing the AI tool and for what purpose. You're talking about AI tools inside healthcare companies that are making automated decisions about denials of claims by looking at medical records and medical information. I'm talking about tools that would be sitting inside the electronic medical records. So they're basically designed by the EMR providers that are in the business of trying to provide tools to assist clinical decision making. So the insurance companies aren't on the back end of the design of these AI tools. And the bottom line is that the physician still ultimately is in the loop. The AI tool isn't automated. It's not making a decision on behalf of the physician. But you could think of an AI tool, for example, that interprets all the medical information that's available in the EMR and offers a physician a list of differential diagnosis, so a list of potential options on what could be ailing the patient. If you go into ChatGPT right now and you put in clinical information, and I've done this, I've taken these vignettes out of the New England Journal of Medicine and put it into ChatGPT to generate differential diagnoses to test the aptitude of those tools. It generates a more comprehensive differential diagnosis and thinks of things that I think a lot of physicians probably would miss. So these tools do have the basis, do have the ability to provide a more comprehensive set of options to physicians. Ultimately, the physician's in the loop.
And your recommendation would be that this regulation may take things too far and may stifle innovation?
Well, I think if you create regulations that prevent the AI tools from being incorporated, embedded in the EMR, basically you're taking away the highest value use of AI functionality in the medical system. Trying to use an AI tool to look across very diverse clinical data that's available in the EMR in a very efficient way seems to be one of the most high-value uses of the AI tools, and has actually data. There was a study in the New England Journal of Medicine about 6 weeks ago that looked at doctors using AI tools, and it showed when the AI tool sat outside the EMR, even though the AI tool had a high aptitude, it was able to make decisions that actually were better than the physicians. The physicians didn't use it effectively because it sat outside the electronic medical record, so it was very inefficient for them. So these tools really need to be embedded, I think, in the electronic health record to maximize their functionality. And this new guidance, which I think doesn't embed the spirit of the law that Congress passed, this new guidance by FDA really prevents that functionality.
How frequently is this being used, this AI being used in a doctor's office? I would imagine there are some places that are cutting edge, other places that are not.
Yeah, I mean, it's a good question because, a lot of these AI tools aren't HIPAA compliant. I think that medical systems are just starting to get instances of OpenAI on their platforms that you can put information into in a HIPAA compliant fashion where it's a local instance of the AI tool, like a lot of other companies are doing. But still, these AI chatbots, for example, are sitting outside the EMR, so they're not very efficient for doctors to use. You are seeing AI tools used on some of the telehealth platforms to facilitate an interaction through telehealth, but a lot of times what they're doing is just helping to condense and collate the patient's information for the physician who's ultimately going to have an interaction with the patient. They're not really assisting in clinical decision-making right now. People are worried about crossing that Rubicon of embedding the AI in clinical decision-making to really assist the physician for fear that they will become a regulated medical device. So they're purposely limiting the capabilities of these tools in clinical practice right now, and that's unfortunate.
Dr. Gottlieb, thank you. We appreciate it.
Thanks a lot.
It is just after 7 a.m. right now on the East Coast. You're watching Squawk Box on this Friday morning right here on CNBC. I'm Andrew Sorkin along with Joe Kernan and Becky Quick. Among today's top stories, it is Jobs Friday. Officially polled forecasters expecting an increase of 169,000 non-farm jobs in January. That is the number to beat. That would be down, though, from a gain of about 256,000 back in December. The unemployment rate expected to hold steady at 4.1%. And a federal judge extending the Trump administration's buyout deadline for federal workers yesterday. The judge now saying his injunction would continue until at least Monday, when he'll consider arguments by employee unions challenging the legality of the buyout and by a lawyer from the Trump administration defending the plan. We're going to hear from the head of the largest federal workers union later this hour about all of it. And Meta CEO Mark Zuckerberg visiting the White House yesterday to discuss the company's role in helping the Trump administration with America's international tech leadership. It's unclear whether Zuckerberg met with President Trump, who spent much of yesterday meeting with Republican lawmakers on his legislative priorities.
We're watching shares of Tesla this morning. Some new data from the China Passenger Car Association showed that sales of Tesla's EVs made in China fell by 11.5% in January, year over year. Deliveries of Model 3 and Model Y vehicles made in China were down 32.6% from December. That stock right now off by about 1.25%.
And checking the futures, which could all change at 8:30 when we do get the jobs report. It's about what we saw earlier. The S&P is now in the green just barely. NASDAQ not doing much. Dow up a little. Let's get to Dom Chu with a look at this morning's pre-market movers. Hey, Dom.
All right, so good morning, Joe, Becky, Andrew. Things are calm for the broader markets, but here are some bigger earnings movers in play right now. One of them is ELF Beauty, or ELF as it's known, plunging down by more than now almost 27% after reporting quarterly results and cutting its full-year guidance. Now, the cosmetics company said the forecast reflects a 36% drop in profits after softer than expected sales trends in the month of January. Morgan Stanley analysts, UBS, Davidson, amongst others, all downgrading the stock this morning, so ELF down about 27%. Another big retail name, though, getting downgraded has to do with an analyst move. Nike shares down by just about 0.5% right now after Citigroup lowered its rating from a buy to a neutral and cut its target price from $102 down to $72. Citi said that after attending an event with the company's new CEO, Elliott Hill, and discussing plans to achieve the turnaround plans there, those analysts no longer believe that fiscal year 2026 will inflect in the way that they had hoped. So buy goes to neutral. Nike shares Dow component down 0.5%. And by the way, for more on that and other calls of the day, just head over to cnbc.com/pro. Subscribers get full access to all the details. And we'll end with the big stock story, of course, of the morning, and that's Amazon. Those shares are still in the red, down by about 3%. That's way better than what we saw at some of the lows last night. The tech giant reported better than expected earnings and revenues for the quarter, but its guidance disappointed some investors. Amazon expects revenue to grow between 5 and 9% in the first quarter, with the low end of that range now marking the slowest growth on record for Amazon since the company went public back in 1997. Amazon's blaming the weak guidance on other things, amongst other things, foreign exchange headwinds. So it kind of gives you an idea, Joe, some of these mega cap tech companies reliant on overseas income will see the effects of the strengthening dollar. I'll send things back over to you guys.
So key things to watch on Sunday, what did Saquon, the Chiefs defense, I mean,
what about the Eagles defense?
The Eagles, yeah, and the Eagles defense. Eagles have had, I mean, when they're clicking on offense, I don't know if Kansas City has seen that, but then Kansas City, Mahomes pulls things out of his thin air that you just don't see that happen. It's almost like he has a horseshoe.
I mean, horseshoes like the cufflinks I have on right now, right? I mean, I'm wearing these horseshoes. But here's the thing.
What's the key to watch? You tell me. What's going to determine the ultimate outcome?
I think for the Eagles, it has to be you got to put points up on the board fast and keep it there. Because I think, what was the stat? The Chiefs have now won 17 or something straight games that have been determined by one score or less.
Right.
So what you got to do is get it beyond one score and then hopefully keep it there. You know, Mahomes has a way of, in the fourth quarter, putting those tight games to bed. And you just got to get a lead, get a 2-touchdown lead and try to hold it there. So.
Should be, I mean, it shouldn't be a crappy game. There have been some bad Super Bowls. This should be really a great Super Bowl. Maybe that's too much to expect.
I don't know. I mean, I've said it in the past. As a diehard Niners fan, I'm kind of indifferent right now on who wins.
They're nowhere to
Super
be
Bowl.
seen this time around. I am sorry, but no one's thinking about the 40. I don't even know where you came up with that. Joe Burrow's in the news.
I really don't care who wins this game.
Joe Burrow's got some stuff I can buy over here at this punch. Did you see that?
Oh, yeah.
The robbers.
Well, they got arrested though, right?
So, yeah, they did. Brought
it here?
Up to New York. Yeah, it's in a pawn shop here. Some of Joe Burrow stuff. All right, thanks, Tom.
When we come back, lawmakers pushing to ban DeepSeek from government devices. Congressman Josh Gottheimer and Darren LaHood introducing a bill amid concerns that app allows China to see user data. They will join us after the break. And later, the CEO of FanDuel joins us ahead of this weekend's big game in the Big Easy. Squawk Box will be right back.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
CNBC. Live ambitiously.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school, and I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
Crucial market coverage, actionable insights, can't miss reporting that'll impact the tape and your money now. Be here when the opening bell rings. Squawk on the Street. CNBC. Want to make some extra money but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
Squawk Box. Amazon shares, they are lower this morning. The tech giant provided weak guidance for the current quarter. This after cloud revenue missed expectations. For a closer look at Amazon and more, I want to bring in Brad Erickson. He's RBC Capital Markets Internet Services Senior Analyst. I want to thank you for joining us. So the numbers are down. I think the other big headline, though, is just how much they are planning to spend. It sort of ends, I think, a little bit of the debate around DeepSeek and whether these models are so efficient that we were going to see sort of a precipitous decline in CapEx spending on infrastructure and chips and the like. So how do you look at this, Brad?
Yeah, good to see you, Andrew. Thanks for having me. Yeah, I mean, Meta started us out, what was it, 60 to 65 billion. Google got us going earlier in the week, 75 billion, and now we're looking at 100 plus with Amazon. These are ginormous numbers. No one had any sort of expectations that the CapEx guide probably wasn't going up last night. But with that said, you know, the story remains the same for, frankly, all these companies, but Amazon included, is people need to feel comfortable that there's a pipeline of demand, there's visibility to demand that they can generate to pay for all this stuff. And I think, you know, Andy Jassy did a good job on the call last night. He basically said, we have line of sight. We don't make these investments without having line of sight. We're there. So I think you can still be comfortable despite the just sticker shock of how high the numbers are.
Okay, so you look at the stock right now. We're going to flip the board around and show folks where Amazon stands. What is your price target on this company? Call it 12 months out from now.
Yeah, I mean, we took our target up last night to $250, and I think, you know, the stock's trading. I think this morning it's indicating a little bit below 30 times on a PE basis, on a GAAP earnings per share. I think this is a situation where that's a high multiple, obviously, for a stock, but they just grew operating income 82% in the last year, and we think that can at least go up by 20 to 30% for the next few years. And so that's kind of earnings growth we call growing into this valuation, could certainly be higher over time.
So you say 250, we're at 232. What do you think the downside is at this point?
Oh, I mean, I think fairly limited. A lot of people obviously own this stock, so there is some crowding aspect of that. But I think, you know, this is it's a very large moving ship, obviously. And it's not going to course correct, I would say, on a dime or anything. So I don't worry about some like big shock to numbers upcoming. It's just a matter of whether they can continue to hit those EBIT expectations, maintain that cloud growth. That's actually another piece I should mention is they grew 19% in the quarter. We think they're actually probably maybe going to decelerate a little bit here in the near term, but they have to keep that growth rate, call it high teens, to continue to give confidence that, again, those AI investments are warranted.
So, Brad, there's sort of three pillars to this business right now, and I think a fourth pillar that's coming. There's obviously the retail business. There's AWS, which we're talking a lot about, obviously. There's the media advertising search business. I don't know what you want to describe that as. But there's this fourth one that's not here yet, called Kuiper, which is the satellite business, but is coming, or at least we think it's coming in the next year. How is that factor, if it does at all, into your valuation?
Yeah, I mean, at this point, it's hard from a revenue perspective. I think from our perspective, we're thinking about expenses there, something in, call it the low single digits, $2, $3, maybe $4 billion of expenses this year related to rockets that are going to start going up in March, as you said. So, yeah, I mean, again, clearly they wouldn't be making those investments if the revenue opportunity wasn't there. We don't really have anything, frankly, penciled into our model as of yet.
Do you think you should, though? Because honestly, you look at like SpaceX, and it's just, I mean, it's killing it. And if they can get anywhere even near that, you're going to create an enormous amount of value out of, I don't want to say nothing, but out of all of these investments, but that's not reflected in the stock at all?
I think it's still a little bit too soon to be able to sort of put that into things. And again, we try and measure these things out, right? We know the expenses, which is nice. And so I feel like we're able to sort of set a conservative bar. If and as that revenue comes in, yes, clearly that would be upside in the stock.
What do you think about the retail business? I mean, that is a huge driver of this whole enterprise.
Yeah. I mean, I think there's a lot of good stuff going on there, obviously. I think one of the things that we keyed on last night was for their fulfillment efficiency, right? So how do they raise those margins on retail? They are working on, they're focusing more in 2025 on same-day sales, right? So faster delivery times. again, I think that actually has a circular effect of holding up more demand. They talk about, and it's not a secret, delivery elasticity, right? It just means when you look at a product and you see you can get it faster, you're probably going to order it. It's favoring their first-party business over their third-party. So that's actually, we think, a little bit of why they missed on third-party last night. But the overall business will tend to hold up better, I think, such that they continue to improve those delivery times. And they're expected to reduce cost of service, cost to serve, I should say, this year as well. So all of that helps.
Brad, I want to thank you for joining us. We will see whether the stock hits the $250 price target you've got for them. And I'm sure we'll
Thanks
talk
for
about it
having me.
soon. Thank you.
And the crypto firm Gemini, backed by the Winklevoss twins, is considering an IPO as soon as this year. That's according to a Bloomberg report that said the crypto exchange is in talks with potential advisors on a listing. The report says no final decisions have been made at this point.
Shares of Pinterest are sharply higher this morning. Fourth quarter revenue came in above estimates, and the guidance range for current quarter sales is mostly above expectations. Monthly active users grew by 11% to 553 million people, and global revenue per user came in at $2.12. That was 3 cents better than expected. The company's CEO will be on Squawk on the Street coming up at 10:45 a.m. in a CNBC exclusive interview. And by the way, that stock up by better than 20% this morning.
Meantime, shares of Expedia, they are rising. Earnings of $2.39 per share, beat estimates of $2.04. And revenue also beat. Gross bookings coming in at $24.4 billion. And that unto itself beat estimates of $23.3 billion. The company also announcing that it is reinstating a quarterly dividend of 40 cents per share. And that's going to start in March.
It is just before 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Among today's top stories, a 25-year-old staffer at Elon Musk's Department of Government Efficiency resigning after the Wall Street Journal asked the White House about his connection to a social media account that advocated for racism. That news coming just hours after Treasury Secretary Scott Bessent dismissed concerns over Doge workers looking into sensitive government payment systems. The Senate voting to confirm Russell Vought as the next head of the White House Office of Management and Budget. The vote for Vought was 53 to 47. Democrats have criticized Vought, who helped author the conservative Project 2025 policy agenda that President Trump distanced himself from during the campaign. And UK security officials are pressing Apple to create a new way for them to gain access to any user's cloud storage data. The Washington Post reports that that includes British citizens, but also any other Apple user worldwide. Sources told the paper that Apple would probably stop offering encrypted storage in the UK in response, but that wouldn't necessarily protect users in other countries.
Meantime, Tesla shares, or I should say sales shares, falling in China last month despite recent price cuts. The company sold about 63,000 cars in January, down 11% from last year's more than 71,000. Tesla's been facing increasing EV competition in China. Local rivals BYD selling close to 300,000 electric and plug-in hybrid cars last month, and that number was up 47% year over year. What do you make of that? It's unbelievable.
I don't know. Yeah, I'm not sure what's happening in China with similar concerns that they've had about other American brands, but it's also
Ford
the EVs.
That number blew me away for Ford, too, when it was $5.2 billion in losses. I don't know what the future holds at this point.
Yeah, I think Ford is also in the position of importing or bringing things back and forth across the Mexican border more than any other of the big three automakers.
Right. Look at the futures. We're going to get a jobs report in right around a half hour. Not much happening so far. Up 10, nothing happening. In fact, mixed treasuries. Maybe more importantly, 440 on the 10-year, 444. All right, now let's get to Mike Santoli at the New York Stock Exchange. Good morning, Mike.
Morning, Joe. Good to see you back. Yeah, the market just kind of hanging on to that January gain. Actually, on the S&P 500, building this week slightly on that, almost entirely due to the rebound in NVIDIA, Meta, Palantir, a handful of the big kind of well-loved names. On the whole, though, you mentioned Treasury yields have come down below that 4.5 on the 10-year. Bond market seems a little bit sensitive to a stutter step in the economic data. We'll see how the jobs number fits into that. But broadly speaking, we've sort of been around this, plus and minus 6,000 level for quite a while. Since the day after the election, it's basically 3% up, 3% down has been the range as we wait and see some of these policy implications. Here is discretionary relative to staples. I mean, you really have no big market-based concern about the state of U.S. consumers. If you look at this chart, it's been, sort of sideways for discretionary for just this last little while. And this is equal weighted, so it's not influenced by the very large Amazon, Tesla type names. But staples have been really for sale, and it's equal weighted, which means you don't get the benefit of the outsized gains in Walmart and Costco, which are in that sector. And so you see, obviously, lack of pricing power. Nobody wants the pure traditional defensive stocks. Food especially been really weak. Now take a look at the volatility index, because for as much as it seems like this kind of headline-rich environment where the market is kind of twitchy and responding to different policy developments and such, it's not really showing up in the index level anticipated volatility. That's because the index itself has been kind of trapped in these opposing currents. There's a lot of divergence among different sectors. Banks really strong. I mentioned staples and other areas very weak. Industrials have actually given up a little bit. Semi's not so great outside of NVIDIA. And yet we're down around 15 VIX. Means we're not really geared up for any kind of a shock that might come along, but it does show you that the market is actually in this sort of calm, if not relaxed state, guys.
I called it too quiet, actually, and the 10-year has me scratching my head, Mike, because okay, we put off tariffs, but March 1st, it's not that far away. I don't know what happens, but yeah, it was such a major concern when it was first announced over the weekend. And the Atlanta Fed at 3.9 or something. So why did rates come down on the 10-year with continuing inflation worries and what looks like a strong consumer you just showed and a strong economy? It's hard to understand.
I think the one interpretation is that the long-term, the long end of the Treasury curve is a little bit more sensitive to growth risks in the short term, whether it's from tariffs or elsewhere, than it is to some kind of long-term increase in inflation expectations. You did also have some relief in the bond market when the Treasury Secretary set out the schedule for debt issuance, and it was not very skewed toward the long end. Some of the market was kind of braced for that. He's basically keeping more or less the mix that Janet Yellen was going for. And as I mentioned, I mean, housing has struggled a little bit, and global yields have really come down. So I think all that stuff together, I mean, let's be honest, we're in this kind of range here. It's not as if it's been dramatic moves. The high was like 4.8, 4.25 used to be considered to be a little bit elevated. So I think all that in the short term is what we're dealing with.
Okay, very good, Mike. Stay tuned, 8:30.
Yep.
Okay.
All right, still to come this morning, that January jobs report they were discussing, that is coming up at 8:30 Eastern time, which is less than 26 minutes away. Plus, an exclusive interview with Minneapolis Fed President Neil Kashkari. But next, Oklahoma GOP Representative Kevin Hern will join us. He was in the room yesterday when President Trump and House leaders worked to try and hash out key spending and tax priorities. Stay tuned. You're watching Squawk Box, and this is CNBC.
I just took a shower above the clouds. You know why? Because this is the Emirates A380.
Watch the markets open. Brought to you by Emirates.
Good money.
Everything seemed legit until it wasn't.
Good times
The lavish lifestyle, the houses that they're used to.
is never enough.
someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fought for them.
I believe in getting justice.
Better investment decisions. San Francisco was built on ambition, a belief that anyone can disrupt any industry and change the world.
Vance meeting with Republican leaders at the White House for an extended meeting focused on the president's biggest priorities and how to pass them. Joining us right now is someone who was at that meeting yesterday, Oklahoma GOP Congressman Kevin Hern. He's the Republican Policy Committee Chairman. Good morning to you. We've heard a whole bunch of things coming out of that meeting, but maybe since you were in the room, you can tell us what you think the president's top priority actually is, given the sort of laundry list that we've been reading about.
I'd first like to say thanks for having me, but it was probably the most productive day I've had in my 6 years in Congress. 5 hours at the White House, another 3 hours, a little over 3 hours last night, regathering together in the Speaker's office to finalize a lot of the conversation that we'd had earlier in the day. There's no question. This president ran on national security and financial security for the American people. That's what we talked about yesterday. That's what these policies are going to be about. Making permanent the tax code, making sure we're cutting spending. I just read where the vice president said there's a lot of ridiculous spending in government. And then when I read who said it, it was Al Gore, some 30 years ago. President Clinton cut 273,000 employees. President Trump has given the same opportunity to government employees to continue to work on shrinking the size of government.
Congressman, there's lots of questions about the math of the taxes, not just extending the current tax cuts, but adding to them insofar as, no taxes on tips, for example, ridding the code of carried interest, which I think was not on everybody's bingo card, at least this time around. How do you, extending SALT, or at least raising the caps on SALT, how much of that you think is going to still be a negotiation, and where do you think you're going to net out?
Well, I'm not going to give you numbers right now. We've got a couple boxes we're going to check today, but I still believe that we'll get to a budget markup in the committee next week and get that committee approval to start the budgeting process to get this done. As you know, senators are meeting with the president tonight in Mar-a-Lago, and Senator Graham has put forward a two-bill approach only because they believe we can't do a one-bill approach. And we're moving forward very quickly. That's what the American people want, and that's what we're going to deliver for them.
Where do you land on that issue? The one bill versus two bill versus, a hodgepodge of bills?
Well, first and foremost, I'm for what President Trump ran on and won on and had a mandate in his winning, which is all the policies you've listed, making the tax policy permanent, securing our southern border, and making sure we unleash the energy in this country so we have global dominance on the energy production. When you look at that, I also understand the politics of the House. I'm the policy chair. I understand great policy, as I just described, but the politics of the House is we need to move them all together so that everybody gets a little bit of something that they can vote on, because no one's going to get everything.
I've got two other sort of larger, almost philosophical questions for you. One is there's almost a constitutional question about money that has been appropriated by Congress for certain items that we know about. And whether you think that the president and the administration can unilaterally spend less, whether they have the choice to freeze those funds if they so choose. Where do you land on that particular issue?
Well, where I land on, yes, we appropriate them to an agency, and it's gotten out of control over the last 40 years. But certainly what the president and the vice president and his team is doing is seeing, are we using those efficiently? Are they going out and they're not being fraudulently spent? That's what you've been seeing happen. He hasn't said he's going to make it permanently stop. He's going to redirect. He's going to consolidate programs so that we make sure we're using the taxpayers of the taxpayer money for the American people in an appropriate way. I don't think you're going to find any American person that's going to say that duplicative spending is okay. This place is out of control on the spending. We're seeing it in the bond markets. The bond buyers are saying we've got to get our future obligations met, and we can't keep doing what we're doing. It's literally out of control. Exponential deficits and debts in this country.
Congressman, by the way, you're not going to get me to disagree with you. I think we need to actually get our handle on all these things, and you want it to be more efficient. There's no question about that. I think the reason I said it's a philosophical question to some degree, or maybe it's a constitutional question, is let's say, and I'll use it as an example, that the Republicans decided they wanted to spend X amount on the border, for example, right? And let's say there was a Democratic president in office who decided that for whatever reason they didn't want to. I don't know. And they said, you know what, we're going to spend half of what Congress has appropriated to do that because we think it's being done inefficiently or inappropriately or incorrectly. That, I think, and maybe that's the construct of a way to think about this, which is what would you say then?
Well, what I'd say is that's happened with every presidency. I mean, I think Joe Biden was, spending upwards of $1 trillion for giving federal debt that wasn't appropriated. So this goes back and forth. That's why we have the three branches of government to adjudicate these issues when they come about. If there's government overreach in any one of the particular branches of government, our founders are brilliant in knowing that we can't have a monarchy. And so when we're doing this, we're going to look and see. If the court challenges this and said it can't be done, then President Trump will redirect and do things that are differently than that.
Hey, Congressman, back to the buyout that's been offered to these federal employees. We did have a member, or the head of the union from one of those unions that came on earlier and said that he doubted whether this could actually be true, that he's warned his union members that they may not get paid out in this way because Congress would have to appropriate that money. Would Congress appropriate it to make sure that the people who have said, yes, we'd like to take the buyout offer, to get paid as promised?
What Congress would do, they'd meet the appropriation requests that have been put forth by the respective agencies. They always have, and they always will. And then the agencies will do what they said that they were going to do with those dollars. And that's what you're seeing right now. As I mentioned, President Clinton did this in '94 when then it was a bipartisan idea to shrink the size of government. It needs to be a bipartisan idea now. The American people are demanding it. That's why you saw overwhelmingly almost 80 million people support President Trump for being a president, because he's going to shrink the size of government. He's going to make it more efficient. There's somewhere, right now, they're thinking of somewhere around $1 billion a day that's being inefficiently spent. And so we're going to look at these. I mean, there are 5 or 6 different agencies that have 5 or 6 different food programs, all because politicians couldn't agree on, let's consolidate those together over the years. And he's going to clean it up in his time in office.
Congressman, there's no question that I think the American, for the most part, the American public would support something like that. One question, though, is about efficiency and how money is used. And I was talking to Becky earlier. We were talking about the PPP loans during the pandemic. And the truth is that it was very helpful in that moment, of course. And Stephen Mnuchin, who was the Treasury Secretary at the time, said, you know what, there's going to be some waste, fraud, and abuse in that moment. But given the speed with which we're moving, we're willing to accept that inefficiency, if you will, meaning we're going to overspend in some cases. How do you think about that in the construct or context of these buyouts, which is to say there are going to be, and potentially many people who are near retirement age or whatnot, that were planning to leave, that were planning to retire, or others that were thinking about leaving anyway, that effectively are going to get paid out to leave, and whether that's an efficient way to use the money, or do you say to yourself that's a cost of doing business, which, by the way, may be a fair trade-off, but I'm very curious how you think about it.
Well, the alternative is you have no way of letting people go to shrink the size of government. If you're going to consolidate agencies, you can't have duplicative employees in those same agencies. The only other option you've got under the current way the government labor unions are written is to give them this offer of a buyout. I mean, President Trump came forward and said, we're going to give you 6 months of payout. You don't have to do anything. You can spend all of that time looking for a job, and you're still going to get your government pay. I know that there's conversation about those folks that are near retirement, that they can accelerate their retirement so that they don't lose that opportunity. And so I think you're going to see some of these. Now that the unions realize that he's serious, meaning President Trump, you're going to see them come together and find a solution to some of these nuances that you just described.
Congressman, I want to thank you for joining us. We hope to have you back as all of this continues to progress. Thank you.
Have a great day.
You too.
All right, coming up, an exclusive interview with Minneapolis Fed President Neel Kashkari. That comes your way right after the January jobs report at 8:30. Stay tuned. You're watching Squawk Box on CNBC.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. My ambition starting out was to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You learn a lot here at CNBC. It's also a lot of fun.
Want to jumpstart your side hustle? Learn the skills to earn passive income online with CNBC Make It's new online course. Expert advice, real-life success stories. Register right now at cnbcmakeit.com/passive income.
It was a really good quarter.
This growth was driven by transactions.
Before they talk to Wall Street, they talk to John Ford and Morgan Brandt. Closing bell overtime.
Now we have just some very slight red ink across the board now on the markets, but it all could change at 8:30. The 10-year was about 444 last time we looked in crypto, just under 98,000 for Bitcoin. It's about where it is right now as well. News that PGA Tour Commissioner Jay Monahan met with President Trump earlier this week. The tour saying that it's now closer to reaching a deal with the Saudi Arabian backers of Live Golf that could help reunify the sport a couple of years after some high-profile players left the PGA Tour for the Live League. In a statement, Monahan and player directors Adam Scott and Tiger Woods said that the tour asked Trump to get involved in solving the dispute for the good of the game and for the good of the country. The PGA Tour and Saudi Arabia's Public Investment Fund announced an agreement in 2023 to house their commercial operations in a single entity, but a final deal has remained elusive. D.C. lawmakers and victims of September 11th and the victims' families have also been wary about a potential deal with the Saudis because of the country's human rights record and the country's alleged complicity in those September 11th attacks. Let's get to Dom Chu with a look at this morning's pre-market movers. Hey, Dom.
All right, so Joe, let's check on some of the big earnings stories of the day so far. Amazon shares still right now in the red, down by just about maybe 3% or so. Pairing losses, though, from last night. The e-commerce giant reporting better than expected earnings and revenues for the fourth quarter, but its weaker guidance is dragging down the stock. Amazon expects revenues to grow between 5% and 9% in the first quarter, with the low end of that range marking what could be the slowest growth on record since the company went public back in 1997. Amazon's blaming some of that weaker guidance on foreign exchange headwinds. Also, sales in its cloud division, Amazon Web Services, came in below some estimates, although revenues were higher this quarter than a year ago. That growth is still slowing down and slower than some of its bigger competitors out there as well. So keep an eye on that. Meanwhile, shares of Affirm jumping up around 12% following a top-line beat for the second quarter. The provider of buy now, pay later services also saw loans a 35% jump in gross merchandise volume year over year. That number topping analyst estimates. The CFO said earnings were boosted by a $60 million gain from a deal back in December in which the company repurchased some of its convertible debt at a discount price. So Affirm shares up about 14%. And then Skechers tumbling right now, down by just about 11% or so after missing on earnings and revenues for its quarter. The company said it saw strong results in the U.S., but headwinds in China continued. The footwear company's first quarter guidance also came in below estimates. UBS analysts are lowering that stock's price target this morning as well. So Skechers down 11% in the news right now, Joe. I'll send things back over to you guys.
Okay. Very good, Dom. Thank you.
Meantime, Meta CEO Mark Zuckerberg visiting the White House yesterday. The company said that he was there to discuss the company's role in trying to help the Trump administration with America's international tech leadership. It's unclear whether Zuckerberg met with President Trump himself, who spent much of yesterday meeting with Republican lawmakers on his legislative priorities. Meantime, Meta, we should mention, on a 14-day winning streak, and you can look at that stock at $714.
It's never done that before.
Yeah.
I think yesterday it was shooting for 13 for the first time, or 2 days ago it was 13 was the first time it's ever gone 13 days in a row. Now this is the first time that they've ever seen this many in a row.
Yeah.
All right, it is just a few minutes remaining until that January employment report. We're going to get you prepped and ready with our jobs panel. Squawk Box will be back in just 30 seconds.
Frank Holland, Worldwide Exchange, CNBC.
RFK Jr. has a good shot to be our health secretary, and that's pretty much the only shot he has.
Jimmy has Bill Gates with
I could jump it. I could jump it.
plus Lauren Graham
Thank you.
and Japanese breakfast this weekend.
My ambition is to get the story and to help the viewer connect the dots, to understand the context so that we, all of us, can actually make our own judgments. Oh, I love what I do. I can't imagine doing anything else.
When I did my master's, I was having a concentration in the area of artificial intelligence.
So you're secretly a tech geek.
I wouldn't call myself a geek, but I certainly am very interested in technology.
On the next Managing Asia, an exclusive interview with Singapore Airlines' Goh Chun Pong.
I think the most stressful time really during the pandemic was the initial period when we're trying to raise funds.
Looking like we didn't have done anything differently. More of my interview on the next Managing Asia.
Majority of our advertisers are using one of our AI products through our Advantage products. It's delivering on average over $3.70 to them. And if they're utilizing it, they're seeing on average about up to a 25% increase on ROAS. So AI at the heart of everything, and particularly generative AI, coming more and more to the fore as well.
At some point, we're going to get to AI systems that are better than almost all humans at almost all tasks. The term I've used for an essay I recently wrote is a country of geniuses in the data center. It's a sort of evocative phrase for all the power and all the positive things and, you know, all of the potential negative things. That's the thing that I think we are quite likely to get in the next 2 or 3 years.
It's both an opportunity and a responsibility. It's an opportunity because it's going to create better productivity. It's going to create more innovation and definitely growth.
surveys, household revisions. I think that I'm going to shy away from that. I'll let Leisman and some of the others look at that. I'm going to concentrate on this as a standalone report. And in my opinion, I think the most important issue here is going to continue to be average hourly earnings, whether it's month over month or year over year, and the unemployment rate. I do suspect that the unemployment rate will remain at 4.1, but should there be any movement there, that will be key. And I also think that the threshold of earnings that we should pay attention to is whether it comes in at 0.3 as expected or moves back up towards 0.4. And the same could be true for the year over year. 3.9 in the rearview mirror, many of us think it's going to be a little bit less. If that does move to 3.8 versus staying at 3.9, all of that is going to be significant, especially in my opinion, considering how much flatter the yield curve has been since the last report was out, or how much lower interest rates are since the last report's out. And I think that's a combination of Fed issues, probably less easing, and questions about the longevity of the strong labor force and how much growth we should expect, even though we had a pretty decent first look at first quarter GDP.
Right. You are doing your pregame.
Yeah, I'm really interested in this idea that you've had the 10-year yield has come down. Take a look at the probabilities of the Fed. They have also come down for that second rate cut. I'm not exactly sure what's happening here. The market's dialed back its expectation for those December rate cuts. They were more 60 plus for December. Now they're down towards 50. What interests me here is, first of all, I think Rick is right. This report needs to stand on its own to give us a sense of what's happening. There are some areas where you're going to have some changes in terms of normal firings for January retail. You had some fires out in California. There's those probabilities right there. It's inching now. Not a huge move, but a little less confidence in those rate cuts that are coming. Could be tied to fiscal policy, could be tied to inevitability or possibility of tariffs, be tied to all sorts of things. But maybe it's more the commentary from officials. They're in a very serious wait and see mode until they figure out how all stuff shakes out.
I think I have 30 seconds to be Sarah. What's most important for you?
I think most important is going to be average hourly earnings because the 10-year peaked on January 14th, right after CPI came out and was 9. So it's going to be important this strong number. I think we've been at 200K.
Betsy?
I'm always looking at whether people have jobs and whether people are participating in the labor force. So I'm looking at the labor force participation rate.
Yeah. Extremely noisy, obviously, because of all the revisions, which are going to be much longer than normal, both surveys. But what I think to look at in terms of those revisions is where do they occur? In other words, we're losing all the jobs on the front end of the economy was not actually as we thought we're losing them on the back end. The last few months of this benchmark could be the first quarter that would be the economy may have been stronger previously and turn around. That's important given the fact that the business employment dynamics, which was released of 2 days ago, of roughly
negative more.
Yes, big. Thousand is a last month from 56 to 7 going back to March. Given today, I'm holding my hand. Is 8 minus 1,000. This we're 5% equals 24. Way, way back. For your earnings, for equal number go February last year, 34.1, 34.1. Even 34 ever. Now, 4% will make the and that was smart. Please work at the under dirty easy. Opinion economy. Paper interest rate black process if they were even everybody we form the legal immigration system in effect. In terms of overall, I think it's a good number. Retail trade and what happened there, hiring in December. I don't know how many folks were ended up in there. I did focus on the revisions. Up. Right.
And an average economy with inflation, it allows for
doesn't easier.
No.
It's a challenge. I think the flying average percent. This makes tech earning the tech sector here over in the monetization and these tactics could accelerate inflation for the economy. So what does the market see? I think we have the same two themes that we had year to date so far. While market moves away from tech will no longer be the only with Europe outperforming the U.S. year to date. And second, is retail buyers, in the market themes continue and investors be broadening out their business globally and not just U.S. tech stocks.
Betsy, what now that
the revision, things like the revisions in the population control, it brings some end of the Biden administration is telling us actually how many jobs are added. It's been a pretty good job growth. Revisions in the we're going to subtract, over. Steve mentioned as we thought, and then when we add in the population controls, there was a lot more than we thought, and we'll see as a labor market operating full employment. And so going forward, full employment. That's the unanswered mention pressure there. With that pressure going on, what's the Fed going to have to do to we can keep?
Great. Okay. You the blank of what you're hearing about as well from the.
Well, one of the things I had said earlier was the fact that this is incredibly noisy, that large, but also which is being revised right now. This data also really problematic. The Census Bureau already said recently that the data is less reliable than usual, and so I have very little faith, frankly, that these numbers are not going to see versions in the future. The Biden administration of this benchmark only goes through March of the year. In other words, eventually going to get benchmarked. Again, if you look at the Bureau of Labor Statistics, job growth in the second quarter of last year, Reserve Bank of Philadelphia is saying the same thing. The benchmark is 100,000 jobs, and that's just for a quarter. So this how the numbers are in low. So again, we have to realize that that's just not going to be the case. Now, going forward, one of the things to consider is the fact that, unfortunately, the market is still facing a lot of winds, not the least of which the fact that and much of the higher end over the last years based on it's going to have to eventually get repaid, and if of what you might call nominal repaid, a lot of has already been paid for by that hit.
Here in the day, spreads to one. And I don't an opportunity yesterday to respond to this. It's a hard of how
and big, obviously, inflation. It's not I rhyme very close. I think it's very that the unemployment rate. Those are issues the Fed's going to have to contend with, and it makes a longer, at least in the positive data on a labor market. And I think all of that shows in 2-year, 30-year rate. And the short end is going to be how the Fed sees that, how they act on that. And central banks, there's a bit of a on. You know, whether you look at the UK, whether you look at the ECB, Japanese rates are going up, the Chinese economy is leaking everywhere. They have unit overcapacity.
First, all the maybe see that's Becky. I'm sorry.
I heard about this.
Never mind. And I was emailing her at the time. Now, real quick, when it came to tariffs, of potential tariffs, they're delayed now for 30 days. How does that affect you were thinking of?
My colleague basically have said information about what's going to be announced. We have a little more information now on that. We really have information about what actually implemented and how other countries are going to respond. And then just very, very good place to just sit here and get a lot of information on the immigration front, on the tax front. All of those are going to be important.
So what's the point you're watching for? Or is it going to down?
Well, setting aside policy, big question. In the first quarter of the last couple of years, is that going to be repeated? Or are, if you look at the 9 months of inflation, quarter of 24 very high. Is that going to be repeated? Or that go off? Inflation data continued. In numbers.
So can you inflation down?
What the rate that's for hard what more our job employment very good data on the long that I think would don't know about inflation coming down quickly.
Their complaint is, hey, will you fiscal policy under the Biden administration? Perhaps a double standard here. Why are you holding powder now with Trump didn't really seem to react to when Biden actually asked.
Obviously the huge influence we had all almost a decade, and the concern was, could we get inflation up to 2%? Big inflation surge. Inflation is still about around 2.5% right now, and everybody's to the top.
Things do affect, right? Yeah. I mean, what are we still up? We're still up to in prices, are we not?
Me too.
Overall levels up a lot, and that's why America's frustrated, and I share their with that. But our job is to get inflation as you know.
It just our real effect what we did. We forgot it for 40 years. It's like we thought anything.
Well, I think we had not the supply-driven inflation in a long time. And given all of the geopolitical uncertainties in the world, could there be supply shocks that hit us again? It's certainly possible. We're certainly much more aware of that risk than I was 5 or 6 years ago, and so we shouldn't forget that.
Yeah. Give us your best guess of how policy is out here. Do you think you end up the year lower than where you started? And will inflation be coming down, hitting this year, next year?
I think inflation on dynamic are coming down. We have a lot of confidence. I think it's looking at the new leases and how many, it takes a couple of years for that to roll through the actual inflation data. So that should be helping us bring inflation back down. Bar something
reading The Economist on my lacrosse bus college. What is help explain to every single person out there watching why this matters for their lives today and in the future. That's what I love being part of this.
Tons of stuff to be done. The clear issue that we have, that our trends, certainly our political leaders, that it's not just about just growth and inclusive growth, but you have to have growth in the first place.
We are not, respectfully to Larry, a museum. We are at risk of becoming a museum. But who develops the latest vaccines? I mean, a lot of the innovation is actually happening in Europe. Yeah. We have a huge amount of startups. Issue is that they start here and then they go to the United States.
We still have a significant part of our revenue in Europe. That is our traditional stronghold, even though we have grown our American footprint, we've grown our Asian footprint quite a bit over the years. But investors see our exposure to Europe, and I think there is skepticism about this. And the environment as it relates to global trade is complicated.
A final check on the markets following that softer than expected jobs report, but the unemployment number was also lower at 4%. So a lot of moving figures here. It looks like the markets digested it all with pretty much a bit of grace on this. We're now indicated up by about 38 points for the Dow, up by 2 points for the S&P 500, up by 3 points for the NASDAQ. And we've watched Treasuries, I think, moderate to some bit. 448, that's a little higher, and 425 is where the 2-year stands on these things. It's been a wild week. It's been a lot of fun, and Joe, we're very glad to have you back.
No, I'm glad to be back.
Yeah.
I am glad to be back, but I'm thinking 5 days next week.
It's going to be a long week.
I got to bone up. Because I'm not totally back. I will
Join
say
us for that. Hope you feel better over the weekend.
Thank
Right now, it's time for Squawk on the Street.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Sarah Eisen at Post 9 of the New York Stock Exchange. Kramer has the morning off. Futures do lose some opening gains as yields pop on this hotter than expected wage number in the jobs data, although we're back in the green. Biggest year-on-year rise since last February. 10-year just south of 4.5. Our roadmap begins with big tech's big AI spend. Amazon calling it a once-in-a-lifetime opportunity. Meta shares continue their record run, eyeing 15 straight days now of gains.
Plus, Doge may be stalled. Federal courts are blocking Elon Musk's team from accessing some Treasury payments data, and they are delaying the federal worker buyout deadline at least into next week.
And energy's trade war risks. We are joined by the brand new U.S. Energy Secretary to discuss it all this hour.
Let's begin with market reaction, though, to the jobs number today. 143 is a little bit shy of the 170 we were expecting, but the unemployment rate does fall to 4.0. The wage number, 0.5, looking for 0.3, and then the year-on-year at 4.1 did cause some reaction in treasuries.
Headline number a little bit softer, but details beneath the surface show a strong labor market. I think that's your headline this morning. What's the bond market reacting to? Well, wages with that 0.5% monthly increase, as you said, was the most we've gotten in about a year. So now we're at 4.1% wage growth from last year. It's a little bit hot. If you go beneath the surface where the jobs are, where the jobs aren't, look, I think, you see it in the services sector for now. Government, I noted, added jobs. Government sector employment rising 32,000. Which is actually strong and could be the last of the strong reports if, some of those federal buyouts go into effect. Healthcare did the most hiring as far as sectors, retail, trade, social assistance, all strong. Jobs were lost in mining, quarrying, oil and gas extraction industry. Education and health, big part of the jump. And manufacturing added 3,000 payrolls, which actually jibes with the tick up we've seen in manufacturing lately, although it could be preparing for tariffs. There's been a lot of burst of activity in effect. Bottom line, doesn't change anything for the Fed. Fed's on hold, and the Fed's got to feel good about being on hold after this number because, there's some risks in here, like a hotter wage number when it comes to their inflation story. And while the headline number was a little bit weaker, it's nothing too dramatic. You still have a 4% unemployment rate, and that is a fact, and it's very strong.
Not to mention the positive revisions last 2 months up almost 100K. Interesting, you're right about the vertical. Leisure hospitality down 3,000. We have seen some negative months for leisure and hospitality, but it's not that common.
No, and that's been a huge job gainer post-COVID. So, we're still trying to figure out where the baseline is after COVID on some of these sectors and consumer spending behaviors as well, trying to adapt to what's going on. The other, this was kind of a weird one because there were so many revisions and population estimates right now. The household survey for January has these new population estimates, and it looks like a big jump in the size of the overall labor force, more than 2 million people, which is only to say that it reflects here incorporating the increased estimates of immigrants that economists have now been talking about, and it's finally starting to show up in these population estimates. We'll see what happens to that, of course, as well, as we've seen this crackdown. But overall, nothing to worry about.
maybe you don't need quite as much compute power for training, and obviously training is sort of coming off to a certain extent. They've kind of run out of data. They're now talking about synthetic data to help train these models. But inference is where it's all at. I mean, think about the 0.3 model that's out from OpenAI, back to them as well. And what you're going to need in terms of compute power for that seems to be unaffected. Take a listen to Jassy on the call last night, where he was talking about sort of some of the assumptions that have been made over the last couple of weeks after DeepSeek.
One of the interesting things over the last couple of weeks is sometimes people make the assumptions that if you're able to decrease the cost of any type of technology component, in this case we're really talking about inference, that somehow it's going to lead to less total spend in technology, and we have never seen that to be the case. And I think that is very much what's going to happen here in AI, which is the cost of inference will substantially come down. What you heard the last couple of weeks, that DeepSeek is a piece of it, but everybody is working on this. I believe the cost of inference will meaningfully come down. I think it will make it much easier for companies to be able to infuse all their applications with inference and with generative AI.
Of course, a continued question, again, given that OpenAI valuation now $300 billion, is the large language models, these providers, Anthropic, OpenAI, DeepSeek, Gemini. Are they offering the same thing, and what will distinguish them? You clearly have to believe it's going to be the applications, and that their engineers are going to be able to come up with applications, not just for the consumer, but perhaps even more important, for the enterprise.
That's what Alex Karp said of Palantir. He's been using the word commoditized to describe the large language models. It is interesting how every different company, whether it's IBM or Palantir or even in Amazon, has pointed to DeepSeek and said, actually, this is good for us. This shows that our strategy and what we've been doing is bearing fruit, right? ARM said it yesterday on this show. So wake-up moment, and I feel like there was a lot to get off their chests, these CEOs and these companies, after the freak out that we saw in the market.
Right. Yeah, there's going to be some free riders who are building their LLMs on other people's hard work and money, and so it's going to be up to the latter group to establish, as David said, what's special about that. When we come back, the latest on the Trump administration's buyout offer to federal employees, as that deadline is now pushed to Monday. Also an exclusive with the president's new energy secretary, Chris Wright. Brian Sullivan's going to have that interview. A lot of movers to get to on this last batch of earnings for the week. Take-Two, Elf, Affirm, Pins, Expedia, futures hanging on to green. Stay with us.
I believe that without real economic growth, you cannot have prosperity and you cannot have peace.
These are amazing times because we're at the beginning of a new industrial revolution.
It's the future that is going to be interesting, the future that is going to be full of opportunities and risks.
We need a sustainable energy development plan. It's affordable, it's secure, and it's efficient.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Sometimes there's a fine line between ambition and impatience. Don't be in a rush. Take time. Be patient. The way to thrive at work is to have a good work-life balance. That's really an example that I want to achieve for my kids.
longest daily win streak ever, aiming for a 15th consecutive session of gains. We know Mark Zuckerberg visited the White House this week. The B of A desk, I love this. The most glaring observation of the week, the Mag 7 have been whittled down to the Mag 1 because Meta is the only member to rise on results.
It stands in contrast to what we've seen in some of the Tesla action this week on some fundamental news on the Microsoft and the Alphabet reactions to earnings, and now Amazon too, which are all a little bit weaker. I don't think any fundamental stories are changed. They're all spending tons of money on capital expenditures. They're all going all in on AI. We don't know what Zuckerberg is talking about in the White House, but he's very active in conversations there.
Yeah, no, Meta's outperformance is notable in many ways. Obviously, it's been a long period here in terms of first the year of efficiency, then followed by just significant announcements since then. Even with being all in on CapEx, the way so many of their competitors are. Obviously, they've approached the large language models with Llama in an open source way, different than some of the competitors. And then there's the Ray-Bans, Carl, which they're going to be making a big deal about, apparently, at the Super Bowl as well.
Oh, yeah. We'll talk about some Super Bowl marketing, as I think the going rate for 30 seconds is almost $8 million, right? Pretty much in line with last year.
OpenAI is going to have no trouble now. They're raising all this money from Masa, as we report. They're going to advertise too.
Let's get the opening bell on the CNBC Real-Time Exchange. The big board, it's cement maker Titan America celebrating an IPO today. CEO Bill Zarkalis will be on the exchange later on. At the NASDAQ, it's good projects helping families in Washington, D.C.'s largest housing project. As we look for some moderate gains here at the open, we'll keep our eye on yields as 4.5 continues to be a big focal point for at least the bulls. Sarah.
Yeah, I mean, people are excited a little bit. The bulls on bonds, lower yields, and what they've seen is broken through some key trend lines, and below 4.5% is a big deal, considering where we were in mid-January, which was bumping up against 5% and 4.8%, and people were worried about higher for longer. It's significant that the Treasury Secretary, Scott Bessent, wants lower for longer, and he's focused on the market, and he's focused on inflationary dynamics and fiscal, tightness to do that rather than pressuring the Fed. Fed's on hold. And I think that just further evidence from today's jobs number is that that's the right place for them to be. Again, softer headline number, but strong internals like an unemployment rate, like more job participation, like hotter wages. We got a 0.5% increase on the monthly wage number, which was the most in a month. So all of that, I don't think changes anything for the Fed. So it's notable to see the bond market absorb it pretty well, and stocks too. I mean, there's no worry, like outsized worry that there's job weakness or that there's inflationary pressure. I think you've got a picture of a little bit of both and not enough to move the needle.
Right. Interesting note out of Michael Hartnett at B of A today, sort of looking at why European stocks are outpacing American stocks so far for the year. He argues investors are trying to outrun what he calls an end to U.S. exceptionalism. And it is strange that Germany's the DAX all-time highs, even though the economy is barely growing.
UK too, yeah. All-time high, economy barely growing. Look, two reasons. They're getting weaker currencies, which is helpful for their competitiveness and their exports, and they're going to get more central bank easing, which we know the market likes, and that's been a case. I mean, the other reason is just that everyone was so bearish and positioning is so lopsided, and so, in Davos it was like so much pessimism. Christine Lagarde even used the word existential crisis when it comes to Europe and as an investment destination, because they're just not competitive with things like AI right now, but also economic growth and lots of regulations.
I mean, new highs, yes, but the multiples, Carl, are still, when you look at Germany, are still incredibly low, reflecting, of course, a lot of the challenges. I mean, the German automakers, we've talked about it many times, whether it's their input costs in terms of energy and what that looks like. China, where they obviously relied a lot on high-margin product being sold, and it's just not as strong. Tesla also not seeing as much strength in China with the latest numbers there as well.
Yeah, down 11. People are starting to tabulate these monthly declines on sales. In Spain, down 70 plus. We mentioned France and Germany yesterday, down 60%. Registrations in California down for 5 straight quarters. And there's no good empirical data on why, but certainly Elon Musk, who, by the way, is on the cover of the new cover of Time.
I saw that.
Behind the Oval, the Resolute desk in the Oval Office, whether or not his insertion into political and government IT systems has anything to do with this remains to be seen.
Yeah, I mean, I think in China, it's probably just more actual competition in the same way that Apple sees it to a certain extent on the handset side. We talked often about the ability of the Chinese automakers to offer a product at a very compelling price that has got a lot of the bells and whistles, so to speak, that buyers expect. And so BYD and so many others there really have an ability. Obviously, they flood their own market and then they flood the world's markets because they're making so many more automobiles, frankly, than certainly their own domestic consumption can rely on.
Yeah, but again, is it fundamentals when it comes to Tesla, or is it the self-driving future robo-taxis? I think that's always...
I mean, Musk changes the conversation away from sales. He has to, because it's not a particularly pretty picture, right? So it's full self-driving and robots. That has served him well, and the stock has hung in there despite what, in a different environment, I guess you could argue would be a different reaction to numbers like the ones we're seeing, which obviously point to a much lower growth rate in terms of Tesla automobiles sales.
Speaking of reactions, I mean, every day there's this like big winner off earnings. Today it's Expedia, which is at the top of the market right now. Solid room night growth of 12%. That was 4 points ahead of consensus. I mean, good earnings numbers as well. EBITDA was ahead. The analysts expect continued margin improvement. And then the CEO sounding very bullish, saying travel demand remained healthy in Q4 despite price increases in hotels, vacation rentals, and air. Like last quarter, international demand was stronger than the U.S., with booked room nights growing high single digits in the U.S., low single digits in Europe, and high teens for the rest of the world. That stock being rewarded up, I don't know, 16% right now.
Wow.
It jives with what we heard from Chris Nassetta at Hilton yesterday, who was also very bullish, didn't want to talk about any sign and decrease in demand on the business side, on the leisure side, on international. It didn't say that even the geopolitical stuff that used to sort of plague the industry and travel wasn't happening.
Yeah, same story with Royal Caribbean, and we'll get Marriott next week, but it's pretty clear the travel thesis has not bent much at all lately.
No, everybody seems to be happy to continue to spend. Another stock worth mentioning this morning is Pinterest. I don't think we've gotten to it, up 20% after earnings, again, being applauded by much of the street. Morgan Stanley has a note out this morning calling with a question mark, but saying the next gen AI beneficiary. The pipeline of ad and GPU-enabled products set to come speak to Pin's opportunity, they say, to drive durably stronger than expected engagement, revenue, and free cash flow. And you can see sort of some of the reasons behind that. Sarah, I don't know, do you use that platform at all?
I really don't, and I am curious what people use it for. All my friends that are like interior designers or wedding planners, I mean, that's their go-to market, but increasingly young kids. Bill Reddy, we're going to talk to in the next hour. I spoke to him in Davos a few weeks ago. They were in a quiet period, but he's just really trying to become a positive example of social media. Like, it doesn't have to be that the algorithms pick up on negative, harmful content and distribute it out. He wants to be a place for this, and so they've really led the charge, for instance, in trying to get phones out of schools and that sort of thing. Also, just in terms of the stock price reaction, a lot of the commentary suggests it was a big surprise, the beaten and raise from Pinterest, and it had been a stock that had underperformed over the last year, especially if you look at competitors like a Meta, if you want to call that a competitor.
Right.
So potentially that's why you got such a good setup and a big reaction.
Keeping an eye on shares of Amazon, as Sarah mentioned earlier when we were taking a look in the pre-market, it is down, but not as much as it was directly after numbers. As we've said, the current quarter, the quarter that was reported was quite strong. It was guidance for the current quarter, and AWS, which does contribute most of the profitability at the company, obviously does not support a growth rate as high as that of either Microsoft or Google in terms of their cloud efforts, but is still chugging along at high teens growth rate, which which is not bad given the level of profitability as well. Not to mention their advertising business, which we don't often stop at. The numbers are extraordinary to think that barely existed any number of years ago, and now they're doing, what, $18 billion or so a quarter.
Third largest ad company.
Yeah, third largest ad company.
Nothing. Out of nothing. Amazing. And we talked about some of the expectations yesterday, but certainly got blown away, especially on CapEx. You know what's not working today is makeup. Elf and Ulta, huge losers. The Elf guidance was no good, several downgrades today. And the things that they attribute the seasonal softness to: consumer distractions, the wildfires, the worry about TikTok going away, the opportunity to present in social media. There just was less room for it.
This is a social media brand.
Yeah.
I mean, it's a brand that is built, and makeup has been that. We saw that early on YouTube and now into TikTok. So clearly that's having an impact. I don't know, the wildfires. Also, tariffs has been a big deal. I know they have diversified their supply chain away from China, but still, they have significant exposure there, and there's exposure everywhere. So that's got to be an uncertainty that's been weighing on this stock. But overall,
there's nowhere to hide, though, here. Estee Lauder obviously has been a poor performer for a long period of time, in part largely on China weakness for some time.
And Asia travel, management changes.
But this had been one of the seeming beneficiaries for some period of time, at least in terms of their market share loss, hadn't it, or no?
Yes, because it was really working and viral and lower price points. And actually, I will say, Tariq Amin, the CEO, did talk about the tariff situation on the call, and he said, look, last time around, if we have to raise prices by $1 or $2, we still do well, we still compete, which has been some of what we've heard from the likes of other low-cost producers. It's 10% across the board, so everybody gets hit.
Speaking of that, let's get to Washington, where Brian Sullivan has a special guest for us this morning. Hey, Sully.
Hey, Carl, thank you, and good morning. Yes, we are here in a CNBC exclusive with the new Secretary of Energy. That is Chris Wright. He's a former CEO of Liberty Energy Services, the founder as well, former board member of nuclear company Oklo. And we appreciate you giving us this exclusive, Mr. Secretary. Thank you very much.
Brian, thrilled to be here with you.
All right, we're going to talk about oil, we're going to talk about tariffs, talk about nuclear, talk about all that stuff, but I've got to talk about what everybody's talking about here in D.C., which is this cost-cutting brigade, this Doge group. There was reports out that there was 23-year-olds poking around computer systems here. Nobody seems to know what's going on. Can you give us, on the record, clarity about who these people are and exactly what they're doing in computer systems? Because literally, I want to talk about what matters, but this is all anybody else seems to be talking about.
Yeah, well, let's address that. Look, I'm excited about that. Look, the government is old and maybe a little bit stodgy, and we've got some young kids. Think young gun management consultants coming in to take a critical look at how things are run. Can we do things a little bit more efficiently? Are our systems as efficient as they should be? I've heard these rumors, they're like seeing our nuclear secrets or all that. None of that is true at all. They don't have security clearances.
What is true? Who are these people and what are they doing?
They're part of a team assembled by Doge, friends in Elon's broader circle, that are very good at IT and very good at systems. And they're just doing a critical evaluation of how do we do things today and come up with some ideas about maybe how we could do things better.
We know who they are. You said they have badges.
Oh, absolutely.
They're in the systems. They're not random people on the internet that are I want to be clear on who these people are, because there is a fear like they have my social security number. They might have access to the codes, as you said.
They don't have anybody's proprietary information, but I know exactly who they are. We have 3 people in our building run through, checked by our security, and they have access to look around, talk to people, and give us some good feedback on how things are going. I think nothing to be worried about here.
Okay. We'll move on from that, get to the topical issues, price of oil. The president says, drill, baby, drill. You're a guy that ran a fracking company. How do we balance out bringing down the price of gasoline, adding to U.S. production, but yet not destroying the oil and gas investments as well that the CNBC audience talks about and looks at every day?
Yeah, of course, it's a business, and prices are dictated by supply and demand. But we've had 4 years of an administration that's done everything it could to raise the cost to produce a barrel of oil. We're not sure if you can get a permit, to drill here, or it's going to take 18 months. You've got uncertainty. You've got to build pipelines or gathering lines to move that product to market. Well, we're not sure if you can do that. You got to do another study, another this. So when you add the costs, of course you hurt the economics. Now we're going to have a more efficient operating environment. I think we're going to see some efficiencies from scale, some efficiencies from certainty, and more credible capital markets. We've tried to starve the oil and gas industry globally, somehow thinking that's going to help climate change. There's been a lot of nonsense, and I think the agenda of this administration, this president, is to bring back common sense.
Can we have lower oil and gas prices and still have stocks that are not much lower than they are right now?
Oh, absolutely. If you lower the cost of operations, there's a lot of fat in the cost of operations. If you lower the cost of operations, that's going to flow through to lower prices, but not necessarily lower profits.
And that margin, you think, can remain steady and thus hold up, because you are the CEO of a publicly, or were, of a publicly traded company, and on the board, which you have now left, of another publicly traded company.
Absolutely. And look, it's capitalism in businesses driven by profit motives that have driven innovation, that have driven efficiency, and driven improvements in our system. And that's exactly what we want going forward in nuclear, in natural gas, in oil, in geothermal, whatever it is.
Sarah and David and Carl, right before we came to this interview, talking about tariffs and the impact they were showing. Elf Beauty stock down 25%. We know there's a pause on the potential Canada tariffs. 4.4 million barrels a day we bring in from Canada on average. Much of that going to where you're from, the Rocky Mountain, the Denver area, the upper Midwest. What is your view on potential 10% tariffs? What, if it does happen, what is going to happen to U.S. oil and gasoline prices?
Well, look, obviously the Canadian energy system is built integrated with the United States energy system. Those pipelines come to U.S. refineries that are tuned to refine that heavier, more viscous crude that Canada produces. I don't think we're going to see that change. As the president has said, this is a drug war. This is about concerns and security at our border. This is to get everyone's attention and focus on how can we reduce criminals and fentanyl and drugs that are a threat to American security coming in our borders. I think things are moving in a productive direction.
So it doesn't sound like you think the tariffs would ultimately occur.
I don't know what the future will bring there, but I know we've got very productive dialogues right now, and we're going to see a reduction in criminal activity coming across our borders.
Because I'm sure you have many friends in Canada, as do I, and they're angry about this. They're saying, well, you know what? If they want to tariff our oil, let's just ship it to Vancouver, and we're going to sell it overseas. I would call that the nuclear option. Do you see anything like that occurring if the tariffs were to occur, Mr. Secretary?
It's hard to build new pipeline capacity. Canada does have a West Coast pipeline, which is running today and exporting oil to Asia, but that's 10% or less than 10% of Canadian oil production. Yeah. But look, this president is aggressive. He doesn't like the status quo. He wants to change things and improve things. We had a lot of noise and sound and fury last time he was president about tariffs and inflation. Inflation averaged less than 2% in the 4 years he was president. Yeah. His agenda is to lower prices and better American lives. I don't see any reason to believe that's not going to happen.
You mentioned climate about a couple of minutes ago. Coming into this administration, one of the big question marks is what is going to happen to the loans and the grants and the IRA, Inflation Reduction Act monies that may be already committed to wind, to solar. This matters to CNBC's audience, the stock market. A lot of these companies have seen their share price decline by a lot. What is your view on the Inflation Reduction Act and wind and solar projects and the monies that are required to produce them?
So look, I'm in this chair 3 days now. One of the things we are doing is looking at all the projects that are out there. Where are the commitments? Where are the uncommitted funds? What's the best use to grow the supply of affordable, reliable, secure American energy? Tremendous opportunities there. So there's upside here as well. But one thing I will say, Brian, that we will not do is follow the German model. And I think the last administration wanted to go down that road. Germany spent $500 billion, made their electricity 2 to 3 times more expensive, and they produce 20% less electricity today than they did 15 years ago. We're not going to go down that road. We want affordable, reliable, secure energy and reindustrialization of America, not deindustrialization of America.
Well, it's something that I've obviously personally reported on many times for CNBC, been over there, seen what's happened. So just to be clear, because let's be honest, a lot of Wall Street makes a lot of money investing in wind and solar and even nuclear. You're on the board of a nuclear company. So final question, should we say that it's possible big wind and solar projects are still going to be okay they're not going to be starved of funds under this administration. What's the money situation regarding some of these renewable wind and solar and nuclear type energy programs?
Look, I think you're going to see continued development in the United States of all of these energy sources. But obviously, a flow of funds from this administration is all going to be about not what the energy technology is, but will it increase the supply of affordable, reliable, secure energy? Will it better the lives of American consumers and encourage businesses to build things in America?
Well, finally, on building things, the first nuclear plant in the United States just opened up last year in Georgia. It took about 20 plus years to build, way over budget. You're a nuclear guy. You're on the board of ACLO. You resigned that seat. What is the future of nuclear in the United States? Some say it's the future. Others say way too doggone expensive up front. Doesn't pay off.
I think the future is very bright, very bright. It's an energy-dense technology that gives reliable energy at all times with a small amount of land and a small amount of materials. Do we need innovation? Do we need some government out of the way to make it work economically? Absolutely. But that's what America's about.
Exclusive interview with the new Secretary of Energy on day 3, Christopher Wright. Thank you very much for your time here in Washington, D.C. We appreciate it. Carl, back to you.
Brian, great stuff. Thank you. Brian Sullivan down in D.C. As we go to break, watch bonds. As we said, the 10-year trying to revisit 4.5, just south of it around 449. We got that jobs number at 143K, a little south of estimates, but UMISH and some inventories coming up in just a few minutes.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I've been thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
A CNBC original exploring equality.
My quote since the beginning was, don't change yourself, change the game.
If you want to be more innovative, more creative, come up with alternative ideas to solving problems, you've got to be more diverse.
And LGBTQ rights and our acceptance are on the line all over the world.
We have something to bring to the table for the solution that we can find together in this fragmented world, and music is always at the center of it.
Real lives, real stories, only on CNBC.
Reuters is reporting that Shein is poised to reduce its valuation of potential initial public offering in London to around $50 billion. I can tell you guys, according to a source familiar with the company, that's not true. There's been no talk of valuation cut at this point. The last valuation reported was over $60 billion. And yes, it is presumed that they are on this road to an IPO in London, waiting regulatory approval. But there has been no discussion of a valuation cut. Why is this happening now? Why would such a report come up now? Well, because with the new tariffs on China, President Trump also got rid of the de minimis rule. This is this obscure loophole in the U.S. tax code called de minimis, which allows packages that are less than $800 of merchandise to ship to the United States duty-free. Who benefits the most from that? A Shein or a Temu. In these small packages that are shipped directly from the Chinese factories to U.S. consumers for very cheap merchandise. It's why they've had an edge, for instance, I mean, for many reasons, but one edge they've had over, say, an Amazon or a Gap, which merchandise comes from overseas, but it ships in bulk to U.S. warehouses, so they have to pay all the duties and the tariffs. So does that change the business model of Shein? Look, I've talked about this before with Donald Tang, who's the executive chairman. We just spoke a few weeks ago in Davos, and they've been prepared for it. This has been a political football, and I think the perspective of the company has been, it won't hurt us. We still have this edge when it comes to our algorithm and when it comes to our manufacturing and when it comes to our also compliance, which they've been very big on and trying to improve as they go public. They feel like as long as it's applied to everyone, including competitors, like a Temu, for instance, that they still will have a pricing edge and an edge in their business. And so nothing that I can report in terms of valuation cut talk at this point.
This is why we were watching PDD yesterday in the wake of these United States Postal Service headlines, which were halting shipments and
so
not. Has that been cleaned up?
I don't know. I mean, they were halting shipments from Hong Kong, I know, and also there were reports that these retailers like Shein and Temu were immediately hit with an extra 30% levy on goods imported to the U.S. from China and Hong Kong because of these tariff hikes. So maybe they have to just figure that out between they have these brokers when it comes to paying duties and shipping intermediaries that have to sort of smooth it out in the process. But PDD bouncing back a little bit today.
Meantime, you mentioned this downgrade of Nike that we got out of Citi going to neutral. Met with Elliott Hill, talks a lot about inventory control, but we no longer have the patience or conviction to wait another year. And we've talked about early chapters of the turnaround story now.
It's all about timing, and that's why the analysts are less than enthusiastic at this point in calling an inflection, because I think, Elliott Hill was in New York this week, the new CEO of Nike, meeting with all the sell-side analysts, including with the CFO. And the takeaway is, he was very well liked, and a lot of the analysts talk about how he recognizes some of the problems and has to fix it, but it's a heavy lift. And it will take time. And so for Citi, the note is about how this year is not going to be an inflection year. And potentially that's already in the stock, which has been sort of moving lower in the last few months. It's down another 2.5% today. But I think the message was they get it. They get the problem. They don't have the right merchandise, and that takes time. And they don't have the right inventory, and that takes time. And they have to improve the culture, which has been broken at Nike. And I think there's a lot of recognition of that coming from leadership right now. The question is this a one-year story? Is it a multi-year story? And that's why some of the analysts are either on hold or, as Citi says, I think downgraded to hold because it's going to take some time.
Right. That's the first trip below 70 since COVID. You got to go back to March of 2020.
Well, there's macro pressures, too. I mean, with the strong dollar, with tariffs, that doesn't help right now.
Meantime, though, market managing to hold its own here. It's doing quite well. Financials, David, we're going to get some financials conferences next week, but can't turn a blind eye to what Goldman and certainly JP Morgan have done last few sessions.
No, they've had a very strong start to the year. The stocks have, of course, coming off what was a very strong earnings season. I will say, and, this figures more prominently for certain firms than others, first month of the year, M&A, not what had been, at least there was so much enthusiasm for what an incoming Trump administration would mean for mergers and acquisitions. We have not yet seen it, certainly in January as we head into February. That enthusiasm perhaps waning a bit, but I think we'll have to wait and see what comes from DREG and from obviously lesser enforcement perhaps of the antitrust laws.
Meantime, getting some economic data crossing the tape. Rick Santelli's got it. Hey, Rick.
Yeah, Carl, watch equities. We were just talking about they were making new highs. They reversed a little bit. Interest rates, they might move up here. Some big surprises in our December final read on inventories, but I'm sorry, on our preliminary Feb read on Michigan. 67.8 is the headline. Way lower than the 71, almost 72 we were looking for. 67.8. That'll be the weakest level going all the way back to November of 23. Now, if we look at current conditions, also significantly lower, 68.7. This follows 74.0, and I understand it's a preliminary. 68.7, that would be the weakest going back to, well, November of last year. And then finally, if we look at expectations, what lies ahead, 67.3, well below 69.3. And here's where it even gets crazier. One-year inflation moved from, get this, 3.3% to 4.3%. I'm staring at it thinking maybe I picked it off wrong off the wires, but 4.3, that would be the highest surveyed inflation on the one-year front in this report going back to November of 23. And if you look at the 5 to 10-year inflation, it came in roughly as expected, but 1/10 hotter. Instead of 3.2, where we've been spending some time, it moved up to 3.3. To find a higher number, you're going all the way back to June of 08 when it was 3.4. We basically gone from 3.2 to 3.4 with regard to history. Now, very quickly, these final on inventories wholesale remains down 0.5, down 0.5%. And on the trade sales, this is a fresh December number, 1%. 1%'s pretty strong. We haven't had a wholesale inventory up at that level since July of 24. But you watch interest rates here and pay particularly close attention to 4.5% on that 10-year, especially on a closing yield basis. Sarah, back to you.
That's not a good pairing, Rick. Lower confidence and significantly higher inflation expectations.
Yeah, definitely not what we were looking for. And my guess is that should put some extra steepness in the yield curve at some point here. And that's what I'd pay closest attention to.
Okay, thank you, Rick Santelli. Watching the market here, S&P dipping negative. We're about 30 minutes into the trading session. Here are three big movers we're watching. Amazon is under pressure. The company giving a disappointing forecast, expecting revenue growth between 5 and 9% in the first quarter, which would be the weakest growth on record. But Q4 revenue did overtake Walmart, interestingly, for the first time ever. Stocks down 3.5% off the lows that we saw after hours yesterday. Expedia shares soaring on strong results. The travel site also reinstating its quarterly dividend, and Pinterest also rallying double digits here. The company reporting its first billion-dollar quarter and says monthly active users hit a new record high. The CEO, Bill Reddy, joins us exclusively in just a few minutes to give us his outlook for the company and tell us about what's working right now. So those confidence numbers are kind of a damper, because, you know, consumer confidence had been looking up, actually, since the election. We know that there's a little, you know, that's always a little bit politically tinged, but I think also the inflation jump in terms of expectations is something worth watching. We know the Fed watches it. You know, previously in the last inflation spike, Fed Chair Powell did mention inflation expectations at one point. Now, obviously, it's the market expectations and the overall inflation expectations have been in check. There hasn't been anything worrisome, but let's pay attention to that. It comes on the back of a jobs number where, you know, if you look at the inflationary component of the jobs number, that would be wages, and they did come in hot. 0.5% increase on the month. That was more than expected. It was the most we've had in about a year. So the overall wage number goes above 4.1% on the year. Look, it's good when people make more money, but it does stoke some concerns, Carl, about inflation. So that's something to pay attention to, I think, on the back of those rising inflation expectations in the confidence survey.
We sometimes at least try to compare what the Michigan survey is doing versus the Conference Board survey, where consumer confidence is down 2 months in a row and is at about a 4-month low. But you got to imagine that there's some element of the tariff discussion that is feeding into these one-year expectations.
Maybe that definitely could be a part of it. Higher oil prices, you know, oil prices have come up a little bit, so that's something that consumers are sensitive to. As far as jobs, you know, the headline number a little bit weaker, 143,000 jobs added, smallest gain since October. However, strong unemployment rate, it went down to 4%. That was a bit of a surprise. Here's where the jobs were. Healthcare, retail trade, government, 32,000. That could be the sort of end of the strong numbers on government adding jobs, given what's happening in Washington right now. Social assistance, manufacturing with a notable gain of 3,000 jobs. It had been a job loser in previous months, so that was a good sign. But we did have, you know, for instance, in mining was a little bit weaker. And overall, we got a lot of revisions. One to mention is that it was a stronger revision for the prior few months, so it makes, you know, the January give back a little more interesting.
This is one of the arguments where you're beginning to hear more that the job market is not as strong as it seems because government has been contributing so much and because a lot of the cyclical industries like manufacturing and construction are not adding jobs like they were when we were coming out of COVID.
That's true. So, and it's hard to predict where we're going from here because we just don't know how big of an effect the you know, what's happening with federal workers, what's happening with immigration. We got the population estimates, which were revised higher by 2 million more people in the labor force. Presumably that's because of all the immigration. So there are definitely some question marks over jobs, and the market's sensitive to it because the Federal Reserve, Fed Chair Powell has said if the jobs market weakens, we can always cut rates. But I don't think that this number suggests that that's what's happening or that's what they're going to do, especially because they're going to have to be on guard for inflation. As far as the commentary from the companies, again, mixed bag. A firm was pretty bullish on the consumer. We're going to talk to Max Levchin next hour. Consumer's really healthy, he says. They're shopping. They're paying their loans back. The economy is basically fully employed, which is really solid. We're not afraid of higher for longer because we've been able to operate at these rates quite successfully. I think that's been a positive surprise, especially on buy now, pay later. Skechers did have a disappointing guide, good quarter, but disappointing guide. And they did say headwinds and uncertainties like foreign currencies, which you're hearing more about and seeing, the emergence of the global minimum tax regulations, and the depth and length of the continuing macroeconomic weakness in China. So nothing specifically around the U.S., but that's what happens with a global business there. And then how about Amazon? You know, we've been talking a lot about CapEx and cloud, but 10% year-on-year revenue growth in North America, 9% in the international segment, excluding the foreign exchange rates. Our continued focus on expanding selection, lowering prices, and improving convenience drove strong unit growth that even outpaced our revenue growth. And David, one thing that analysts are calling out in a good way on Amazon is the profitability in the North American retail business, which I think they had their highest margins ever and could be a good story on all this AI investment.
Yeah, absolutely. Despite obviously what is also significant spending there, as Andy Jassy said on the call, most of the increase and the CapEx will be going towards AI, but they still spend a lot on that retail business to it. How many times do you drive now? And if you don't see an Amazon truck, it's a rarity.
Yeah, it's double parked.
Yeah, or anywhere on the highway.
Yes.
Yeah.
Meantime, take a look at Amazon shares if you haven't already. Stock is slipping on the back of that revenue forecast. Rob Sanderson joins us today. Loop Capital Management, a senior internet analyst, joins us with a buy rating, target at 275. We always talk about their forecasts being often wide enough to drive a truck through. Did you see last night's as weak?
A little bit soft on the outlook. Yeah, I mean, we're a touch surprised, not terribly surprised. We sort of know that the spending environment is just sort of so-so. There's, unit growth is good. There's a mix down to lower ASP, everyday essential type products. We were really encouraged by the trends in the cloud business, obviously, and the retail margins, as mentioned. I think that's a real big piece of, what why we're bullish on Amazon for the next few years is there's a lot of room for upside here as they get their cost to serve back to historic levels. Although they are hitting all-time highs in retail margins, that business is much richer from a margin perspective than it was historically because the advertising side is so much larger and the margin upside is still pretty significant as they get cost to serve back to historic levels.
Right, and that's a continuation of that margin story from some prior quarters. So does that allow them the wherewithal to be aggressive on things like CapEx overall?
Oh yeah, and a lot of that CapEx obviously is cloud related, and that's a different subject. But yes, they've got lots of capacity to spend. The earnings power in the model getting back to historic levels. They say their true north is 2018. That's something like $40 billion higher in operating income if they can get all the way there on our next year's numbers. So that's going to take a few years to get to, but there's a lot of upside in terms of earnings power in Amazon.
The advertising business, I'm just curious, Rob, because it's becoming a more and more important component, I would think, of profitability. What are we talking about? $17.3 billion of revenue for the last quarter, 18% year-over-year growth. And to put it in perspective, they're running at what, almost $70 billion annual run rate, which is double what they had 4 years ago. How important is that to your overall thesis?
Very important. It's a real big piece of the margin driver. I think the larger piece is getting, again, back to historic levels on cost to serve, but that advertising business is a juggernaut. And they've been really successful at understanding shopper behavior, shopper data, surfacing that for brands and merchants to target users. They've been really good at doing that on site. But all these efforts with their DSP and the connected television and the investment in sports and all of this ad network is extending that beyond the site and across the whole internet. So there's a really powerful long-term story still ahead for Amazon in the advertising space.
What about retail? I mean, are they underestimated on the retail story? I just mentioned the better profitability there. Or do you think the market appreciates it?
I think the market's missing how profitable the retail business overall is. Another way to say that is how poorly the unit economics on fulfillment have fallen. It's been masked by the subsidy, call it, from advertising and commissions, which is essentially, mostly margin. So I think it's that what people are missing is how bad the unit economics and fulfillment had gotten, and therefore how much better it can get as it returns to normal.
Rob, important print for sure. Thanks for the help with that. We'll talk soon. Rob Sanderson over at Loop, talking Amazon.
Thanks.
As we head to a break, let's give you a roadmap for the rest of the hour. SoftBank is close to finalizing a massive investment in OpenAI. We'll give you the details on that coming up.
Plus, shares of DraftKings up 15% this year, heading into the Super Bowl. CEO Jason Robbins joins us to tell us what's at stake this weekend when it comes to betting.
And Pinterest chief Bill Reddy joining us in a CNBC exclusive after the first $1 billion quarter and some record user numbers. Stock is soaring right now as we've lost some ground on the back of UMich. A big show still ahead. Stay with us.
Elevate your portfolio with JP Morgan's Equity Premium Income ETFs. Now with more flavors, global equities, US equities, and technology stocks. Discover now. Search JP Morgan Income ETFs.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought that was the end of it.
To the C-suite.
I started on the factory floor, and here I am 35 years later.
The economist and author Dambisa Moyo.
A lot of boards, many of the ones I serve on, went back to the drawing board to say, well, we need to do better here.
He turned a dream into a global brand.
Join the conversation on CNBC.
We are seeing more agility in many other territories than the European one. Luckily, the good news is that I think not only we in the foundation, but I think in general in Europe, people have woken up to that.
The 27 different countries, even my home country, Germany, they're way too small to have that seat on the table. And that's, I think, what the European Union missed out on, to have a joint foreign economic policy and say, look, these are the standards, those are the rules, we want to engage together for the greater good of the world, and that's missing. So that basically means that they need to get that back together quickly.
Europe is lagging in growth. The UK is ahead compared to Europe, still not as strong as the United States. But both these economies can use growth, and part of getting that growth is to unleash the capitalist instincts and what we call animal spirits into their economies, which means a better balance between regulation and opportunity.
Big game Sunday, of course. Sportsbooks are in fierce competition for Super Bowl wagers. Contessa Brewer joins us. She's live from New Orleans ahead of course, the game on Sunday and has a special guest for us. Contessa.
Hi, David. Good morning to you. Listen, I'm already hearing a lot of trash talking around the streets of New Orleans where the Eagles fans and the Chiefs fans are taking aim at each other. A lot of talk about the ticket prices plummeting down more than 40% on the resale market, according to StubHub from last year. And maybe a little bit of Chiefs fatigue, like we've seen them here before. With me now is CEO Jason Robbins of DraftKings, one of the big giants of legal sportsbook wagering in the United States. Are you seeing, in terms of the wagers coming in, Chiefs fatigue?
Actually, the money's pretty even right now, so the spread's only 1.5. So people are typically not taking the spread if they're betting on the favorite side. So you're seeing a little bit of money line shift there, and then you're seeing, the spread going the other way. So it's pretty even right now if you look at the overall money.
Chad Bainan, who's the gaming analyst at Macquarie, said his estimates are $1.7 billion legally wagered in the United States with the sports books, and that the ideal outcome here would be, he says, KC win and under total, because everybody wants to have a high-scoring game, and that would translate to about a $365 million gross gaming revenue for the market. He says, in the most extreme scenario, DraftKings could see plus or minus 3.5% for the first quarter revenue. Is one game, even the Super Bowl, that important?
It can be, I think, in this case, because the money's pretty evenly distributed. If it stays that way, it won't be. Right now, the biggest thing is going to be the touchdown scores. So does Saquon? I think we're all kind of assuming Saquon Barkley is going to score. So everyone, our head of sportsbook said, look, I'm just penciling in a Saquon score. So I'm hoping Jalen Hurts and Kelsey stay out of the end zone. And that actually, at this point, will make a bigger difference in our numbers in the overall game. But there's a lot of time between now and kickoff, so that could certainly change.
When you look at the way that the wagering jumps for the Super Bowl, you're talking like, I think Optimove said something like 765% more wagers than even the finals for these games coming in. When you're thinking about that and putting that in perspective of what we already saw with fan favorites winning during the football season, we know that had an impact. How do you factor that in when you're trying to tell investors and analysts what to expect for the coming year?
Well, I think everyone understands that there's some volatility based on sport outcomes, and investors have become accustomed to that. So that's something I think the market understands, and over time it evens out. Really, as the numbers get bigger and the types of bets become more diverse, it's going to continue to be more normalized, less volatile. For example, I mentioned the touchdown scorers. We have a lot more money on player props now than we did a few years ago, and so now game outcomes aren't nearly as impactful to us as they once were. They still are obviously very impactful, but it's been muted a little bit. So I think that also will help kind of make things less volatile as time goes on. But that's just part of the nature of the business, and most events aren't like this. The NFL is sort of unique in the amount of volume, and the Super Bowl is obviously the biggest one of all.
Bank of America's analyst John Cowley says $1.15 billion in total volume on Kalshi and Poly markets. Those are the predictions markets. You're competing with these new entrants at a time when Ohio and Maryland are proposing doubling your tax rate. There's a lot of competition and a lot of money outgoing. Talk to me about balancing that.
I think those numbers show you how big this is in states that don't have legal state authorized betting. If you take the illegal market and add that into the numbers you just said, you're talking orders of magnitude larger that's going to be wagered in the legal market this year. So that's still very much a big part of what's out there. Even in states that have legal betting, especially ones that have high tax rates where it's been harder for us to market and promote as much, those big legal sites are still out there. And I don't think people realize the size of those.
Jason, thank you so much for joining us. I know you've got a busy weekend ahead of you. Appreciate you spending a few minutes with us.
Thanks for
Sarah?
having me.
Okay, Contessa, having fun out there in New Orleans ahead of the big game. Still to come, Pinterest CEO Bill Ready here to break down the latest quarter with that stock surging in early trading off earnings. After the break, Goldman Sachs chief economist Jan Hatzius joins us at Post 9 on today's jobs report and this consumer confidence number we just got as well. We're back in a minute.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. My ambition starting out was to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You'll learn a lot here at CNBC. It's also a lot of fun.
So usually when people think about drone filming, they will imagine a drone high up in the sky, like aerial photos. But I can also fly indoor and close proximity flights, close to people and close to objects safely. Wearing a goggle, it gives you a more immersive experience where